Squawk Box, a sports betting player, FanDuel, partnering with derivatives marketplace CME Group in a predictions market platform that's now set to be released next month. It's going to allow users to bet on financial metrics and sports outcomes, even in places where sports gambling is illegal. Now, prediction markets are federally regulated and considered trading platforms, not gambling platforms. The CEO of FanDuel's parent company telling Jim Cramer that the sports prediction product won't be available in areas where users can access FanDuel sports betting. The state of Nevada disagrees, considers sports prediction markets a form of gambling. That state's gaming control board now announced that FanDuel has surrendered its license to operate in Nevada as a result of all this, and said DraftKings has also agreed to withdraw all pending applications for sports wagering in the state. Neither company offered their online sportsbook in that state, but FanDuel had a license as an information services provider. It's very complicated, a lot of different component parts here, and DraftKings has a license application as described as, quote, inactive at the moment. Now, in a statement, the regulator there calling the foray into sports events contracts unlawful and said this conduct is incompatible with their ability to participate in Nevada's gaming industry. So you have sort of two forms of gambling. You have what used to be the traditional form of gambling, which was state regulated, like Nevada. Now you have this prediction market situation. Some of these guys want this all to come together. So what I always thought, by the way, would be the ultimate outcome, given that there's so many...
Basically what they've just said is, like, forget it. We'd rather be able to operate in the predictions market than be able to operate in the state of Nevada.
Exactly. And so this is going to get very complicated very quickly, but it also means I would think that maybe Polymarket, maybe Kalshi, maybe any of these guys either all get merged up, either Polymarket and Kalshi ultimately get into the sports business, gambling business, or the sports gambling guys get into the prediction market business, and it's all one thing. I can't see how there's like a separation.
Well, it's interesting to watch this trickle down. In Nevada, the traditional casinos are feeling threatened by this, by the sports books, by the FanDuel and the like. They're feeling threatened now by the predictions market. So it's, iterations and steps, and kind of pick your regulator too.
I thought there was zero, I didn't think there was zero, but I thought illegal gambling, no one needs it anyway, you need a bookie.
Right.
Until the recent stories that there's the same four families are still involved in all the...
But that's like rigging, right?
I know, but what is how much is left?
The bets that you can't make somewhere else?
Bets that are bookies still in business around the country? I never had one. Some of my friends did have one.
My grandfather used to have a bookie.
Yeah.
And we would go, and the guy would literally sit at the bar at lunchtime. I won't say where.
Why?
He's no longer alive. I mean, my grandfather isn't.
Why don't you say which bar?
Well, because who knows? Maybe these people are all, maybe they're all still in business. Oh yeah, the place is still open. Anyway, and then you go.
Off camera.
And there'd be an envelope that would get exchanged, one way or the other, depending on what was going on that week. And my grandfather would bet on usually the football games on the weekends.
There must be
Monday or Tuesday there was
I'm sure there's
transfer.
there's a number by some Wall Street firm that follows the gaming industry that knows exactly what the percentage of illegal gambling is left. What would you guess? 50% is left? 10%? 80%? What is left from that business?
I don't know.
It'd be tiny, because you can do everything.
I would think it would be tiny.
You know what there's not a lot left of? pennies.
But not a
The
lot of
last
penny.
one, they've minted the last pennies yesterday.
It costs 3.5 cents to make a penny.
3.7 cents.
3.7.
Yeah. So,
By the way, it still
no more
costs-
pennies, but all of a sudden, seeing this makes me want to go out and hoard pennies.
So you brought that up because you know that's basically what I'm betting on a lot of these things.
By the way, a nickel costs more than a nickel to make.
Yeah, that might be nice. Tens of it. Does anyone use cash anyway?
No, that's what I mean. I
They gave me
have to
some-
go find
They
pennies.
gave me some change the other day. I'm like, just keep it. And then you put it in a little thing that's like, I don't know what. Yeah.
Okay.
Yeah.
All right, when we come back, why we may never get the economic data that was missed during the shutdown. And then in the next hour, Oscar Health CEO Mark Bertolini on the rising cost of insurance coverage and his ideas for improving the nation's healthcare system. This is what Congress is going to be digging down into right now. Mark's a very smart guy. I talked with him last night a long time about this. Of course, he's also the former CEO of Aetna. He's put some thought into these HSAs, these health savings accounts, how they might work, how you might be able to kind of finally arrest some of the rises in the insurance cost. And he's going to talk to us about all of those things coming up in just a little bit. First, though, before we head to a break, take a look at yesterday's S&P 500 winners and losers.
Five things to know ahead of the opening bell. There's probably many more, but we picked these. President Trump signing a bill to fund the government, reopen operations after that 43-day shutdown. And White House Press Secretary Carolyn Leavitt says that economic data that was missed because of the shutdown may never be released. This includes the October CPI, and the jobs report. The Bureau of Labor Statistics couldn't collect the data that goes into those reports. And the Supreme Court says it's going to hear oral arguments on January 21st in the case challenging President Trump's authority to fire Federal Reserve Governor Lisa Cook. Alibaba is reportedly preparing to overhaul its flagship AI apps to be more like OpenAI's ChatGPT. Bloomberg says that the eventual goal is to make the apps into fully functioning AI agents. In the U.S., ending the production of the penny. After more than 230 years, the final coins were struck at the Mint in Philadelphia, and that's it.
I have to save some for my grandkids.
I have
Future
I
grandkids.
have some coins from
Like
silver
the
ones.
oddities. Yeah, like $2 bills I used to have
Yeah.
when I was a kid.
Yeah.
Yeah.
Okay, as we mentioned, we got a lot more coming up. We may never get some of this economic data, if you believe this, that we missed so far during the government shutdown. But Steve Leisman, he is on the case. Forget about that government data. He's got some other data for us. He's going to join us next on what would have been the CPI day. Squawk Box, come right back. Welcome back to Squawk Box. Tencent reporting better than expected results after the close in Hong Kong. Revenue growing 15% year over year. Separately, Bloomberg reporting that Tencent has reached a deal now for Apple to handle its payments and take a 15% cut of purchases in WeChat, mini games, and apps. The It's pretty interesting. The companies had been sparring over loopholes that allowed Tencent app creators to funnel users to external payment systems, cutting out Apple's typical 30% commission. So interesting little wrinkle in that whole saga.
All right, it is CPI day. Although this time we're going without the CPI, our senior economics reporter Steve Leisman takes a look at what the alternative inflation data the Fed is kind of surveying at this point, what choices they have among those. Steve, we're probably never going to get that CPI data.
No, the White House said yesterday the CPI and the jobs data from October may never happen, or at least are unlikely. But among the alternative data that Fed Chair Powell is looking at, that he said he follows, was State Street's price stats. That scrapes millions of retail prices off the web and calculates the change on a daily and a monthly basis. It has crept up, you can see here, slowly since the president put tariffs in place, gaining nearly a full percentage point since May and underscoring the caution of some Fed officials, more about that in a second, about cutting interest rates. The good news is it's been stable, you can see there, for the 2 months. The bad news is it doesn't include services. Well, the data series itself, you can see, tracks pretty closely, or the BLS headline pretty closely, though it has run a little cooler than both since the pandemic. Yesterday, Atlanta Fed President Raphael Bostic said he opposed the December rate cut in part because of survey data from businesses that his bank gathers showing intentions to boost prices. Bostic, who is not a voter and announced his intention to retire in February, said he also saw inflation spreading to those core services. CNBC now counting half of the voting members of the FOMC as either outright against or cautious about a December rate cut. Let me go through it here. Boston Fed President Susan Collins, she joined yesterday KC President Jeff Schmidt, who is likely against the December cut, having dissented at the last meeting. That's on the left there. Presidents Goolsbee and Musalam and Governors Jefferson and Cook, they've all suggested going slowly or a cautious approach to a December cut. Governors Myron, Bowman, and Waller, they're pushing to favor a cut, perhaps along with New York Fed John Williams, though he's less certain, and Fed Chair Jay Powell, I'd say right now, is unknown. Well, before Collins spoke yesterday afternoon, markets had a 64% probability on a December cut. That's now fallen to a coin toss. There's still a 69% probability of a cut by January. So what's it going to take? Likely clear data on a weakening job market and stable or declining inflation to convince the hawks to cut in December. Becky?
You know, Steve, that's kind of fascinating. I saw her comments yesterday. I did not realize it was going to kind of kick the market's probability down so low to the idea where it's just a coin flip at this point. I mean, we've been steadily moving lower after Jay Powell said that it's definitely not baked in for their cuts next time around. But this is a Fed divided at this point. Is it that unusual at an inflection point to see this much disagreement on the Fed?
I think it's pretty unusual. I think the lack of data, and by the way, one of the things you find in the market is the market doesn't agree on what data matters. And I think different Fed officials are looking at different things. Stephen Myron has his own count where he sort of insists that there is no tariff inflation. I can't quite get the backup data on that other than a paper that he cites that was issued a while ago. So I've asked them for that data. But they're looking at different things. And you're right, Becky, that Susan Collins speech yesterday really put it over the top. We have this running count that we do, and I looked at it and said, wait a second, that's now 6 of 12 voting members that are either cautious or want to go slowly or are outright against this cut. So it is an unusual split. And it has to do, I think there's some politics involved, maybe on both sides, and there's also different takes on what the risk is. And so I think this is really the key here. What you have is you have some officials that want to cut, that they acknowledge the inflation. They're just saying we need to look through it. Others are saying, no, we've been above our target for 5 years now, and we should not be looking through it. And there's a lot of concern among those members that the Fed's target is not going to be taken seriously, and that the market's going to get the impression that it's not 2% anymore, that it's 3% now.
I was going to just suggest, Steve, not definitively, that even if we had all the data that we're missing, I don't know if it'd be that much different. Really, I still think that there's so many, differing forces in what's happening. It's always uncertain. They never know for sure what to do. but it even seems like that there's more reason. I can easily make arguments that everything's going to be fine on both mandates, and then I can make arguments that it's just the worst we've seen since the misery index of long ago. Right now, that we've got major problems in both things. So I could argue either one, with productivity and AI and all these different forces. Is it different this time? Is that what I'm getting at?
If you're personally divided, how do you expect the Fed to come to a decision?
That's what I mean. Even if they had the data, I think they'd be.
When I'm asked about this, Joe, I say very definitively that it takes a definitive jobs number. You need to show a really weak jobs report. I think would take some of those who were slow and cautious, bring them over to the rate cut side. A solid jobs report. The other thing we don't talk about a lot is that the data that is being gathered and estimated suggests the economy is fine. And there are several of them. I think Susan Collins was one of them who said, wait a second, the stock market is a tailwind for this economy. And it's hard to look around, several officials have said this, to look around the economy and say, well, which part, other than, of course, housing, is really suffering from rates being too high? I think there's a concern here that they go too fast and they end up fueling inflation.
Okay, Steve, I want to thank you. We got some news, literally as you were just speaking, results from Disney. Here's what's going on. We got adjusted earnings of $1.11 per share. That's 6 cents better than estimates. Revenue coming in at $22.5 billion. Now, that was slightly below expectations. Entertainment revenue was $10.2 billion. Experiences generated $8.8 billion. Both of those metrics were also slightly below Wall Street consensus. Sports revenue was nearly $4 billion, and that was roughly in line. Disney Plus paid subscribers increased by 3.8 million over the prior quarter. They're now up to 131.6 million. That number above the estimate of 129.7 million. So shareholders are probably going to like that number. Hulu paid subscribers were 64.1 million at the end of the quarter, and that also topped estimates as well. Now, some other headlines out of this release, because there's a whole bunch of things going on here. Disney doubling now its buyback target to $7 billion. It is also raising its annual dividend to $1.50. That's from $1. So that's up big. On guidance, Disney now seeing, and this is the important part, double-digit EPS growth for 2026 and 2027. And we're going to get to go through all of these numbers and more with the company's CFO, Hugh Johnston. And we'll do that live at the top of the hour. Of course, we'll also talk about the big fight that's going on with the folks at Google who own YouTube TV and what that all means. So a lot going on this morning. Coming up.
Down again. It was up.
Now it's down again.
And the yield was 0.85, so
right.
That goes to what, 1.2. Not really a yielder, but pretty big boost.
And then there's this, folks. A group of Starbucks workers planning to strike on one of the company's busiest days of the year. Before the break, here is the AccuWeather travel forecast with Bernie Rayno.
How about a little tranquility on your Thursday across the central and eastern part of the United States, although there will be some gusty winds around New York City and Philadelphia this afternoon. The AccuWeather exclusive forecast calling for soaking rain in San Francisco, heavy rain in Los Angeles Friday night into Saturday. That rain will be causing delays in and out of San Francisco, gusty winds with some minor delays around LaGuardia, Newark, and JFK. To help you make the best decisions and be more in the know, make sure to download the AccuWeather app today.
Welcome back, everybody. The Starbucks Workers Union launching an open-ended strike in dozens of cities. It comes on Red Cup Day, which is one of the company's biggest sales days of the year. The union says that the strike involves more than 1,000 baristas in about 65 stores. But Starbucks does have close to 18,000 company-operated and licensed cafes. That strike follows a failure between the union and company management to reach a collective bargaining agreement. That stock right now off by about 7 cents.
And coming up, new tech versus old tech. That debate getting more oxygen as AI names take a bit of a breather. Sparkbox, right back. Well, the AI-related stocks have been pulling back a little, while some older tech names doing a little bit better. Diverging. Joining us in the latest in the tech, or all the latest in the tech sector, Ray Wang, Constellation Research Chairman and AI Forum co-founder. How you doing?
I'm doing great. How you doing?
This is our. It's like episodic. People wait for you, like, you know, instead of when you can't binge something on streaming, you know, then you have to wait every week. I think that's sort of what happens with you, right? People are like, when is Ray going to be on again? I'll tell you something, though. You don't believe there's an AI bubble. You point to $380 billion in data center spending, but then you say the top 10 tech stocks are $25 trillion, and the U.S. economy is $30 trillion. I mean, that sounds like a lot of concentration that it could be. Those seem to be opposing viewpoints there. Sounds like a bubble, but you say it's not a bubble.
It's a great point. And what I'm trying to say here is what we see in the old tech side of the house, you see in the public markets. What you're seeing on the new tech side of the house, it's in the private markets. It's in the valuations of OpenAI and Anthropic and Perplexity. It's in the evaluations of Midjourney and Cursor and Replit. These are companies that have not come out. But the one thing that they have that's different in an AI native versus the old companies is that these companies are running super efficient. It could be 20 people doing 200 million ARR, 10 million people doing 200 million ARR. But the numbers are staggering in terms of the revenue per employee, if you're thinking about what they're doing, profit per employee, and the amount of digital labor. They look so different compared to the way we report metrics today. And it's the old companies and the old guard that actually is going to have to conform to what the new metrics look like in terms of the percentage of digital labor, in terms of how they actually look at growth. It's not a 20% growth or 30% growth. These companies are growing at 10x, 100x in terms of their ability to deliver. And that's what the valuations are going to look like very differently going forward, which is why on one hand, you look at staggering numbers. On the other hand, you're like, these numbers are just the beginning.
Yeah, and it's like a pond or a rock in a pond. It goes out like this when you throw it. And all these companies out here that you don't even think are AI companies, it's going to benefit just about everyone in your view. Cisco, we had Lisa Su on yesterday. I mean, look at AMD. We thought, NVIDIA was the GPU master, and I think it's up 17,000%, we said, since you took over 11 years ago.
It is, you're definitely right. And AMD showed that there's money to be made despite NVIDIA's dominance in GPUs, 35% year-over-year growth. That's what she's forecasting for the next 3 to 5 years, which is incredible when you think about just growth in general. And you look at Cisco's beat on the street, they finally had 4 quarters of revenue beat in a row. And what's driving it? It's really the data center part of the business, but they also have networking with NVIDIA with an Ethernet switch based on NVIDIA silicon. And you look at other companies that are growing at the same pace. You look at IBM in the business. You look at Oracle coming back on the data center side. This is just the beginning of that. But this is more than a boom in just 5 to 7 stocks. It's going to be a boom that spreads out to the rest of the tech sector as they go through the modernization program as well.
Would you be moving out though? Is this what we've seen in the last couple of weeks? Does that make you think you need to go deeper into the weeds with AI and maybe not with the 5 stocks you consider when you think of AI?
Well, if you're looking at diversification, you would definitely be looking at the software side of the house. And that's where you're going to be hearing a lot more about agentic AI revenues. We had classical AI, which is 2 + 2 = 4, 100% of the time. Then we got the generative AI, which is 2 + 2 might equal 4. Now we're in the agentic world where 2 + 2 = 4. What do you want to do with it? And it's really about business outcomes. It's about collapsing decisions and trees. It's about automation so that you can make faster decisions. That's where companies are starting to head to, and that's where the Salesforces, the ServiceNow, companies that are really pushing on being able to deliver that. There's private companies like Moveworks, which ServiceNow made an acquisition for, Boomi. These are companies that you're building the agents on, and what it's doing, it's driving business outcomes. Can I actually close books faster automatically? Can I actually reach out and touch salespeople more quickly? Can I resolve a customer service issue in less time with better resources?
All right, Ray, we're gonna end it there. Thank you. We'll see you next time. Week or 10 days, whatever it is. Thanks.
Okay, coming up in just a little bit, Disney's CFO is going to join us on the company's 4th quarter results that are just out. That stock moving this morning. We've got so much to Welcome back to Squawk Box. It is 7 a.m. on the East Coast, and you are watching the one and only Squawk Box right here on CNBC. I'm Andrew Ross Sorkin, along with Joe Kernan and Becky Quick. We got a whole bunch of big stories to tell you about. The longest government shutdown in history. It's finally over, folks. President Trump signing a funding bill, furloughed federal employees headed back to work, or at least we hope, and we'll start getting those missed paychecks. Meanwhile, talk about folks getting back to work. The FAA saying that flight reductions at dozens of major airports, they're still going to be capped at 6% instead of rising to the planned level of 10% by the end of the week as they try to get everything sorted over there. And shares of Cisco Systems, they're moving higher. The company reported better than expected results and provided strong guidance. And CEO Chuck Robbins is going to be on Squawk on the Street with that gang at 9 a.m. Eastern Time. Joe.
Let's check on the markets right now. There's the futures. You can see down a little bit. They were up, I think, earlier, but they're right off an all-time high for the Dow. And we were actually talking, I thought someone wrote the book in 1999, Dow 50,000. It wasn't. We used to talk about it all the time. It was Glassman and some guy named Esset. It was insane at the time. Dow 36,000.
Not Kevin.
No, not Kevin Esset.
Dow
And the difference is that it was Dow 36,000.
What was the
and
time frame that they put in?
I guess it was not 20. I don't think they actually, that if you're a decent strategist, you never do time and price. But that we thought was crazy, and now 50. And I thought it was 50. I don't know, someone else wrote a book about Dow 40,000. So here we are. That just to give you some perspective on how far we've come. And the S&P is just below 7,000, which was a lot of people's year-end targets. Then they switched them after April and went back down to 6,000 after Liberation Day, or whatever we call it. And there's the 10-year, which is 4.8. Disney might be down a little. That might be why the Dow, that might be why the Dow is a little bit negative.
We've got him. Disney reporting fourth quarter results just moments ago. We're going to get to walk through all of this. Here's what happened. Earnings at $1.11 a share, 6 cents better than estimates. Revenue coming in at $22.5 billion. Now, that was slightly below expectations, and as Joe mentioned, the man is here, joining us first on CNBC. Hugh Johnston's the Disney CFO. Also with us, our own Julia Porter. Good morning, good morning, good morning. Okay, so there's a whole bunch of things going on in this earnings report. There's some beats, there's some misses, there's buyback plans, dividends. Let's walk through it.
Yeah, in some ways, good morning. It's, I think, important to take a little bit of a step back. And so how are we doing over a longer period of time? For the year, we delivered 19% EPS growth, which is, I think, pretty darn good. And in the context of the media and entertainment space, I think is very, very good. And over the last 3 years, we've actually delivered 19% EPS growth per year for the last 3 years. So overall, the company's strategy seems to be working awfully well. Diving a little bit deeper into what I think are some of the most important metrics for the analysts. Number one, DTC, terrific quarter. 12.5 million sub ads, 40% operating income growth, hit $1.3 billion this year compared to $100 million last year. And then the experiences business grew revenue 6% and grew operating income 13%. So overall, we're leaving the year with a lot of momentum, both on entertainment and on the experiences business. And as a result of that, we guided to double-digit EPS growth for the year, doubled the share repurchase, 50% increase in the dividend. Overall, we feel good about being what I refer to as an earnings compounder. And I think eventually investors are going to get conviction around that as well.
I know everyone's got questions at the table. What was the dividend choice, meaning to do this?
A number of things. Number one, obviously, when you commit to a dividend, that's a commitment forever. So it's awfully hard to cut the dividend unless some dramatic crisis happens. And we wanted to send a signal. Our cash flow is strong, and it's going to be strong for a sustained period of time. Same thing with share repurchase. To double the share repurchase to $7 billion, that's a signal that says, look, we expect cash flow not to be strong just for this year, but for a number of years going forward.
Give us some insight into what's happening in the streaming division. You added more subscribers than expected, but you also had the Charter deal, and you also launched the ESPN app. What are you seeing in terms of putting all your ESPN content on streaming due to the value of the bundle?
Yeah, it's actually doing very well in the things that we find most important. Number one, reducing churn, and number two, increasing engagement. If you look at the sub increase in total, as you mentioned, about half of it, and this was expected, was the Charter deal and those wholesale subs. But the other half was retail, and with that retail, over half of that was international, which is strategically quite important for us. And the balance of it was the bundles that we're doing with Disney Plus. With ESPN, one of the things I think we're most excited about is fully 80% of those new retail subs on ESPN are actually bundled subs, which again should contribute to engagement, should contribute to retention, and frankly make the service more valuable over time.
And then in terms of the parks division, can you give a little bit more color to what you're seeing in terms of the health of the consumer?
Yeah.
Whether it's bookings, the hotel rooms, the consumer spending. Is the consumer resilient? Are they making plans for the holidays and beyond?
I think they're being more choiceful, but when it comes to something as significant as a Disney experience, you don't want to cheap out on that. You want to, when you're taking the family, you want to go all in. So a couple of facts on that. Number one, bookings for the first quarter are up 3%. So we feel good that we've got continued momentum there. Number two, per caps, so the amount spending per head at Walt Disney World was up 5% for the quarter. So again, people are spending. And then number three, cruise ships, despite the fact that we've added a lot of capacity in cruise ships, we're selling out at the same rate that we had been previously. So that added capacity is filling up quickly. So overall experiences, our consumer is operating in a very healthy way.
Hugh, I made the point yesterday, this should be the best time in the world for media companies. I would think. And Dow's at an all-time high. There's a lot of wind at the back of a lot of business in the United States, and it's just not happening. And I made the point that if anyone looked set up for success in media, I mean, all the assets that you have seem to help each other. You build a brand, you put it in a theme park, you have great content from studios, you put it on streaming. All these things work perfectly.
Yeah.
You're at the $200 billion market cap, and Netflix is 500. Came out of nowhere with only streaming.
Yeah.
What does media look like? Why
Joe, I think you make a great point. As I just opened with,
Why is it like that?
19% EPS CAGR for 3 years says to me, we are an earnings compounder and we're a great cash generator. In addition to that, to your point about the Disney ecosystem, let's use Lilo and Stitch as an example. So it was $1 billion movie for biggest movie this year, Lilo and Stitch, looking phenomenally good. In addition to that, we put it on the streaming service, had 14 million views in 5 days. All right, so super content.
I mean, you're making a great case, but my point was, why is it down from a much higher level?
Yeah, well, you have to take out.
Is it mispriced, the stock?
I believe it's underpriced. I really do. I believe investors are going to build conviction in it over time, and we actually see some investors doing that right now. But I think we need to continue to prove the case that, you know what, as we go through this transition, we are going to emerge one of the winners. In fact, we're already one of the winners.
So all those other things are additive, they're not a drag on.
No, I actually think quite the opposite. I think that integrated ecosystem works really, really well. This whole idea of splitting up assets and all that, that's when you do what you do when you don't have a great business.
You know,
When you have a great
Netflix is showing everyone, making everyone think differently.
Look, well, they've got a great business too, but they're very narrow, but they're deep on general entertainment. Our strategy is different. We run broad in terms of DTC. We have news, we have sports, we have broad scale entertainment, kids entertainment. Who knows? Ultimately on the service you may see gaming and things like that as well. So I think it's basically the portal into all things Disney, and with the IP that we have, we're going to monetize it well.
Okay, yesterday we had Tom Rogers on, and he said that this battle that you're in with YouTube right now, the idea that you've stayed off for that long,
Right.
And that it hasn't been broken even though we're in football season and all these other things that you would normally see, both sides come together and reach a deal over. And he said that shows some of the problems with the legacy broadcasting and how the power has really been diluted. Do you think that's the case? And where do things stand with YouTube right now?
No, I think that's an exaggeration. With all due respect to Tom, I know he founded CNBC, but I do think that's an exaggeration and a bit more than is a reality. We're in the middle of negotiations right now. Things are live, they're happening. Obviously, as we entered the year, we knew this was going to be a challenging battle, and we prepared ourselves for it, and we're ready to go as long as they want to. So,
but I think
beyond that, I'd rather
one of the
not comment,
concerns,
you imagine.
one of the concerns, I think, is that Google, oddly enough, given how small a piece of their overall business is YouTube, from a leverage perspective, they may not care as much as somebody else.
Yeah.
And so what does that say? I mean, this is what you can have leverage if you care a lot, and you can have a lot of leverage if you don't care at all.
Yeah. I think at the end of the day, financially, I understand what you're saying, but this is ultimately about your customers. And right now, YouTube customers are suffering without this critical content for them, right? Sports in the middle of football season is about as important as you can get. So I think from that perspective, we perhaps have some leverage as well, because there are other places people can go to get that sports.
Beyond just the fees involved, there's been discussion that there's other elements to this deal that are sort of in play. Can you speak to that?
I'm just not going to comment on the various elements of the negotiation. It's a negotiation. There's back and forth. They want certain things.
Right.
We want certain things.
How do you
We
feel?
both have
Let me just
power.
ask one related thing.
Yeah.
The idea broadly of ingestion.
Yeah.
So in the business, there's a question mark right now. You can use the apps to get a lot of content,
Yeah.
but a lot of folks like YouTube, if they're going to try, they want to sell the whole package, and they would like to ingest, if you will, a lot of the content that's on the direct-to-consumer apps into their own systems. How do you ultimately feel about that longer term?
Yeah, anything that we have, we actually would prefer to run through a lot of our own distribution channels, but that's not just Disney owned as well. So I think we're going to just let the negotiation play out, and we'll make a call on these things as we negotiate.
You, Joe, just compared your market cap to Netflix, and we heard Netflix talk about how they're using AI to cut costs. Paramount Skydance just reported, they talked a lot about how they're focusing on tech to cut costs. How are you thinking about AI right now as a driver of potential profitability?
Well, it's a big deal for us across a variety of areas. If you think about it right now, number one is obviously in the DTC service. Right? It just can make you much more capable. Similar to what Netflix is doing, we're going down those same paths. Number two is in our experiences business, both for guest management as well as for cast management. We have the opportunity to leverage AI to become a much better experience for people. Number three is in video production, right? Post-production, design tools, and all of those things. If you think about it, what Walt Disney did literally 100 years ago was he was a technologist, right? The animation he created didn't exist anywhere else, and we've continued that. And then the last piece, of course, is the office, which is what everyone talks about. How can you make your office workers much more efficient? We've got a ton of active initiatives on all of those, and I do think it's going to drive the profitability of the business over time.
Yeah, there's also been a lot of talk in the industry about what Paramount Skydance has been doing in terms of its attempts to acquire Warner Brothers Discovery. How does that all that consolidation impact Disney?
Yeah, it's a great question. I mean, number one, obviously, I don't comment on M&A. That said, if you look at what they're talking about doing, it's really what we did 10 years ago. Whether it was the Fox deal or the Pixar deal or the Lucasfilm deal, bringing more IP into the house is something that we did a good long time ago. As a result of that, we don't really need to participate in these things the way perhaps some of the
Well, let me
other
ask you a separate
companies do.
related question, which is there's always discussion about what regulators would allow or wouldn't allow in terms of companies that might pursue deals or other deals. There's a view that if David Ellison were to pursue this deal, that the regulators would let that fly through. There's other views that if Brian Roberts, of course, who runs Comcast, were to do a deal, that maybe the president has other views about Brian Roberts or other things that would make a deal tougher. There's questions about if an Amazon were to jump into the fray, for example, and want to buy just the studio business and the streaming business, whether that would be too much consolidation. If, in fact, the regulators were to call you, because they often do in these circumstances, to call the competitors and say, is this good or bad for competition, you would say what?
It's going to depend on who the competitor is. It's going to depend on what the circumstances of the deal are. So in general, look, I'm generally in favor of the market deciding things. That said, we'll see what the specific situation is, and then I'll answer at that point.
Okay. Hugh Johnson, thank you for coming in this morning.
Thank
Appreciate
you.
it. Really
Great to be
good.
with you guys.
Thank you. And of course, we should mention you are a member of the CNBC CFO Council.
Absolutely.
An illustrious
And have been for a long time.
Yes. Thank you.
All right, when we come back, Bausch & Lomb's vision for future growth, the eye health company hosting an investor day today, and the CEO, Brett Saunders, will join us to talk about what to expect in today's presentation. And then at 7:30 Eastern Time, Oscar Health CEO Mark Bertolini, a wide-ranging interview on the state of the nation's healthcare industry, what we might be able to do to try and arrest healthcare insurance cost increases. Squawk Box will be right back.
Time now for today's AFLAC trivia question. What state is home to the largest aquarium in the U.S.? The answer when Squawk Box returns. answer to today's AFLAC trivia question. What state is home to the largest aquarium in the U.S.? The answer? Georgia. The Georgia Aquarium in Atlanta holds over 11 million gallons of water and is home to more than 500 aquatic species.
Welcome back to Squawk Box. New this morning, Bausch & Lomb outlining a 3-year plan for profitable growth and affirming its annual guidance. The global eye health company hosting its investor day here in New York City. And joining us right now, first on CNBC, someone we have not seen in quite some time in person. Brent Saunders is here. Good morning.
Thanks for having me, Andrew.
So, the biggest message of this day, you got a whole day.
Whole day.
Whole day. What's the first thing you're going to tell everybody?
First thing is financial excellence.
All right.
We're going to lay out a 3-year plan to grow above the market and, very importantly, improve margins, about 600 basis points of margin improvement over the next 3 years. So fairly significant.
And how are you going to do that?
Well, a variety of things.
Let's walk through how this is all going to happen.
So we kicked off a program earlier this year we called Vision 27,
Right.
to really
Clever.
focus on, to play off of our heritage, to really focus on a lot of discipline across our OpEx, our manufacturing network, and then most importantly, product mix to really move to the higher margin products through our pipeline and R&D.
So right now, though, but let's just understand it, because there's a mix of businesses here, right? There's consumer, there's the pharmaceuticals, there's surgical. What does that look like?
Yeah, so the biggest contributor will be surgical from a margin expansion. It also has the most opportunity, and that really is about both moving to our higher premium intraocular lenses or implants, and we've launched those already, so that's happening.
Right.
And then second, really modernizing our manufacturing footprint, which has been somewhat antiquated. We're a 172-year-old company, so there was lots of opportunity to create efficiency in the manufacturing and supply chain. The combination of those two create very powerful margin expansion for that business.
I think of you as an M&A guy of some sort, a deal guy.
I get it.
You get that. What's on the horizon?
So not much M&A. We have a very disciplined capital allocation approach. We're also committing today to trying to get to 3.5 times leverage or better by 2028 and get that investment grade credit rating. And so really for us, it's more about small M&A, small business development and licensing, mostly intellectual property to develop medicines or products for patients.
Are the tariffs hitting you in a meaningful way?
They are. It's about 40 basis points of our margin this year, so about $20 million. We have a very global manufacturing footprint, but really what hurts us, we're a big U.S. manufacturer. In fact, we're one of the few companies to make all of our medicines for the U.S. in the U.S.
Okay.
So does that get you an exemption?
It does, and it gets us reciprocal tariffs. And so we're a big exporter to places like China and Europe from the United States, and so the reciprocal tariffs are where we see most of the impact.
Have you talked to the administration about that?
We have, and we've worked through various trade associations, but not a lot of relief quite yet. You would think there'd be more incentives to reward the people who have built and expanded their manufacturing footprint in the U.S., which is what we're doing, but because of the way we operate, we can start to shift some of that production to Europe and Asia for Europe and Asia over time.
So the tariffs and then the reciprocal tariffs are actually causing you to move manufacturing out of the United States?
Well, shift. So we're going to shift. We already have those plans, so we're going to
Okay.
shift to more. We used to, 15 years ago, we moved to global manufacturing by product, and now we're going to go back to regional manufacturing.
So give me my related question to this. As a CEO who's dealing with tariffs right now, do you say to yourself, this is the forever tariff? This program, the way this is, we're in this for the next 20, 30, 40 years like this, and we have to basically plan around that?
Yeah,
You say this is a 10-year operation? You say this is a 3-year operation? What do you think?
Yeah, so I think, to be fair, we're baking it in, right, as a new baseline for 26 and beyond. And I think if you really step back and think about it, once we get used to it, it's called roughly 15% tariff revenue. I've not seen many politicians in either party want to give up revenue.
Right.
And so I don't see it going away for the foreseeable future.
The 170-year-old company business. So Bausch and Lomb used to have an ampersand,
It did.
and now I know when you were coming out, we're stressing it's now a plus. And I'm just reading what branding experts said, and whether they came to you and told you this, and whether you
So,
bought it, and how much it
sure.
costs. So listen to what it does, Brett. The plus sign, this is modernize a company's image. The plus sign carries a strong medical and health association, signaling partnership, innovation, and a deeper commitment to working alongside medical professionals
What
and clients.
AI are you reading?
Does it? It doesn't matter which one it is. It comes from the company. But who convinced you that? How does a plus do all those things versus an ampersand?
So I'll tell you the real story, because I was here when we changed it in 2010. I was CEO here. I left to do Allergan, and I'm back again. And so we changed it in 2010 or 11, somewhere in that period when I was.
I didn't even know it had been that way for that long.
Yeah, and the point I was making, we were private equity owned at the time, and the company had really been stuck in neutral for about 30 years. And so I was just looking for a refresh. I wanted to reset culture. And so it was largely symbolic, but it served a purpose.
How much did it cost, that idea?
We were private equity. We didn't spend a lot of money. We weren't allowed to spend a lot of money on
I might do
rebranding.
Joe plus Kernan. Just
In fact, I wouldn't let them change the sign or the stationery or the cards till you ran out.
I have a broader question for you, which is, do you think in a day and age when we're all going to be wearing some kind of glasses, that have different things in them, there's this other view that not only will the glasses have, a display, a heads-up display, but that the glasses themselves will be able to actually change your vision for you. Do you see that as competition?
I don't. I think, if anything, we could participate if that happened. We happen to be.
I know this is a very
quite good at-
future
Yeah.
forward situation.
We're pretty good at optic designs. It's one of our core specialties, and particularly in R&D. But one of the things I do worry about is myopia from kids, particularly staring at screens, and that's a global epidemic. We're going to announce some programs around that today at Investor Day as we unveil our R&D
And
pipeline.
what kind of programs? What can you do?
Or are you talking patching? Like what?
No, so what we're working on is a contact lens designed specifically for kids that build the therapeutic correction right into the design of the lens. And so the kids, and we're using our latest technology,
But
super
how young?
comfortable.
I mean, it's hard to put contacts in the eyes of kids.
It is, but the way it works, and we have experience with this, it is happening in Asia and China in particular today. It's so bad that you just work with the kids, and after a week or so, kids get pretty used to putting them in. But that initial period, as a father, I know, is a very tough.
All right. Brent, I want to thank you for coming in this morning.
Thank you for
Wish you a lot
having
of
me.
luck.
How young?
Come on back.
Yeah, just how young of the kids do you put the contacts in?
Oh, so I think you're going to be looking at kids somewhere, roughly 5, 6 years old.
Holy cow, does that just tell us we need to stop our screen culture?
I think we have to limit it, right? And so, you need to your eyes are like a muscle, right? So if you're staring close to your face all day long, stop, look away, get kids outside where they're looking to the distance where they really exercise their eyes.
New fear unlocked.
Sorry.
That's okay.
Thank you for having me.
Thank you.
Go ahead. Coming up, some solutions on how to fix the nation's healthcare system. Mark Bertolini of Oscar Health will be our special guest. As we head to break, check out the crypto market. Squawk will be right back. Shares of Firefly Aerospace are jumping. Revenue rose nearly 37% in the most recent quarter, nearly double the previous quarter. And the company also raised its full-year guidance. Before today's gains, Firefly was down, though, about 70% from its IPO back in August, following a disappointing second quarter and an explosion of one of its rockets during a ground test.
When we come back, efforts to solve the nation's healthcare crisis. Oscar Health CEO Mark Bertolini is going to join us with his thoughts on trying to improve the marketplace for consumers when it comes to health insurance. It's a hot topic right now. It's being discussed in the halls of Congress, or would be if they were there. We're going to dig into what the potential solutions are with Mark Bertolini. He'll join us next. Squawk Box will be right back. Welcome back, everybody. Workers across the nation are in the thick of changing, renewing, or signing up for certain healthcare plans under the current open enrollment period. Millions of people could, and actually very likely will, see their insurance premiums rise pretty sharply next year. Joining us right now with insights on the current state of the health insurance industry is Mark Bertolini. He is the CEO of Oscar Health. He's also the new chairman of Verizon and the former chairman and CEO of Aetna, a longtime friend of the show. Mark, thank you for joining us.
Great to be here, Becky. Thanks for inviting me.
We spoke earlier this year when you came in about the problems in the healthcare industry. Nothing changed, nothing happened, but here we are, and we're probably at a moment where it's going to be getting a lot more attention because of what just happened with the government shutdown.
Yes.
There's a lot of confusion out there about premiums going up and how much of that is related to the subsidies ending, how much of that is related to a broken healthcare system that sees inflation far outpace inflation in other arenas.
So what's happening currently in the Affordable Care Act and the enhanced subsidies is that there's a lot of rhetoric about who's getting access to these funds, like $1.5 trillion being spent on illegal immigrants. Not true. 50% of American small businesses use the Affordable Care Act. Small businesses are 50% of our GDP. They're the engine of our economy. 27% of farmers use the Affordable Care Act, and the average farmer makes $60,000 a year gross. Their current premium is $75. With enhanced subsidies, it's going to go up to $300. So $225 a month more out of $60,000 gross is going to pretty much make it difficult for them to do other things like put food on the table, buy seed, do all those other sorts of things that operate their farms. So we're talking about the very basis of our economy and the people that make our economy work. 75% of the people in the ACA today are from red states. 100 million Americans don't have access to employer-sponsored health insurance in this country. And so with all of those characteristics come together and the high cost of healthcare, drug development, skyrocketing healthcare costs in facilities everywhere else, we have a system built 80 years ago that has built into it inflation. They're not price sensitive to their benefits for the most part. And we build hospitals in every nation in the country, or every city and state in the country, so that we created a demand pull into the system that has driven costs up inexorably. Now, what the Affordable Care Act has done that most people don't understand is it's reduced uninsured from 15% to 8%. That has saved $10 billion a year in uncompensated care and charity costs that used to go to hospitals. $10 billion a year. That will reverse to an $80 billion problem over the next 10 years if we start moving that uninsured rate back up.
The answer isn't simply subsidies, though.
No.
There are so many broken things in the system and so many reasons that healthcare costs go up annually with or without the subsidies.
Exactly.
So how do you get at that, and what kind of problem solving can we actually do in the next, 2 months?
So we should create a qualified account, and there has been some concern about fraud, waste, and abuse in the system. There has been some, not as much as people would put on the table. 2.4 million was the number last year. People that are cheating the system, it was really 450,000. At Oscar, it was 27,000 people out of 2.1 million people that we cover, so it was 1.3%. When we got down to the actual understanding of each of those people, well, let's create a qualified account that is the basis, the doorway to employers, government, or individuals putting money into a qualified account that allows them to spend healthcare their way. So if we put consumers in charge of buying the product, you're going to have an impact on price. Every time consumers get control of what they purchase, they have an effect on the underlying costs and the price of the services they buy.
When you say an HSA account like that, an account where money goes in, I think of a defined benefit going to defined payouts on what you can see with some of these things, much like we did when we got rid of pensions in favor of 401ks. It puts a lot more of the freedom in the hands of the individual buyer, but it also puts a lot more of the potential burden if you mess it up, that there's no safety net there to catch it.
Currently, 95% of people that buy in the individual market today use a broker who have the tools to help them understand which plans they should pick. So I think the first order of business is, do we have the technology and the support to be able to help people pick the right plan, have money left over after they pick their plan, and turn around and be able to pay their out-of-pocket costs.
Is replacing Obamacare or in addition to Obamacare? Would you use?
I would redo the whole thing. I would use the individual market as a single risk pool. I would use the risk adjustment that's used to allay all the critical costs or catastrophic costs that go through the system. It's spread over many more people than it can happen to any one employer.
This is the Republican holy grail, what they want to try to do. It sounded like you started with making an impassioned plea for Obamacare, but you'd really like to do what Republicans would like to replace it with.
We would like to allow people to get subsidies where they need it. The farmer, the small business owner.
But couldn't they get subsidies and then buy the HSAs?
Yes. Well, no, you put the subsidies into the HSAs.
Right.
You put the employer money from your employer into an
The
HSA.
HSA, right.
Right? And you can put your own money into an HSA.
And then when you own it, you're not going to be, well, you don't care about what anything costs. You're going to watch very closely what everything costs.
That's exactly right. And 40% of Americans last year, 2 out of 5 Americans borrowed $74.9 billion from banks to pay their out-of-pocket costs for healthcare. It's a giant suck on the economy. And so if we allow people to buy the network they want, because in the individual market we have narrow networks, I can find my network instead of my employer deciding what it is. I can buy my benefits. If I'm gonna have a family, I want better obstetrics.
Right.
If I'm gonna have surgery, I buy my benefits using the funds that are in my account, leaving me money to either pay my out-of-pocket costs, depending on the plan design I pick, or to buy other products like dental, vision.
But Mark, Obamacare is a sacred cow. You're never getting rid of it at this point.
All we have to do is evolve it. I don't care what you call it. Just use the concept of the network of the risk pool.
But this is what Republicans have been saying, and people just roll their eyes that that's what they want to do.
Well, nobody's actually put a real plan on the table.
But they say HSA, find your own, help get the middlemen out, get the insurance companies out.
Well, no, the insurance companies have to be there
They
to
have to
buy
be
the
there, but
policies
they-
from.
By the way, you guys are working with people on both sides of the aisle
We are.
to try and bring this about. And I have to say, there are times when I think it is just an expansion of Obamacare. There are times when I think it is an evolution to the HSA program that the Republicans are pushing. But what you're really looking for is every American to be covered. And that's almost universal health care, but with the choice in the hands of the consumer on
It's
which
exactly
one to
right.
pick.
Yeah.
What I'm trying to figure out is where the margin's gonna get taken from.
Yeah.
Somebody has to lose in all of this.
So what will happen, just like in automobile sales and in books and in other things people buy online, is that they're going to compress the margins by buying what is valuable to them. They're going to make that value equation.
Right, I understand that, but you're effectively arguing that more competition should compete away margin. But
Yes.
I'm trying to understand where the margin gets competed away most. Meaning, is it ultimately that actually it's going to come out of the hide of the doctors, it's going to come out of the hide of the hospital systems, it's going to come out of the hide of the insurance
Yeah.
companies? It can't just be that that more money comes into the system and the same amount of profits.
Unless consumers are paying more.
And it's not all margin. It's actually inefficiency, gross inefficiency in the system. And if you look at the hospital systems across the country, and most of the
Yeah,
country,
your
most of them losing
inefficiency
money.
could be somebody's profit in some way.
It could be, right? But you have,
I'm not discounting what you're saying, suggesting. I'm just trying to understand.
We've tried
If we looked at a pie chart of
Yeah.
where all the money
we've
is.
tried everything else to solve this problem, other than put the consumer in charge of what they buy.
Let me ask you one more question that always kind of worries me. I understand the concept of putting it into millions and millions of people so you offset the risk. But if every consumer who is healthy and young opts for the minimum, very bare minimum plan, as I would have done in my 20s, doesn't that just mean that the bigger pool is a pool full of far more expensive people who are therefore going to have to pay much higher premiums? If you're not
we have
offsetting the
now.
older, yeah, but if you're not offsetting the older people who need more help or the families with young, really healthy people,
But
how?
what happens in the market today is it's one big risk pool that gets settled at the end of the year across all the plans. So if a plan has more risk in it, sicker people, they get paid by the plans who don't have any. And so if you even out that risk every year, you socialize the risk across the whole population, you now don't have a problem of underwriting, which is what you're talking about. Sicker people cost more money. Today in a small group, a pregnancy causes a double-digit rate increase the next year. One employee,
For one employee in a employee population of how big?
50.
So
Causes a
everybody has to pay
double-digit
more
rate
the
increase,
next
right?
year.
So because you're underwriting that population and it's getting priced. In Michigan, double-digit rate increases for the last 5 years. In Arizona, 28 to 30% rate increases in small businesses today because they're underwriting that pool. And
And that
so,
has nothing to do with the ACA subsidies. the
No, it doesn't.
subsidies.
and what happens with small employers is they stop offering coverage and they're sending them into the ACA, saying, go buy your own product.
That's not good.
Yeah.
But all the margins you're talking about, Andrew, that every single entity that's going to see that happen is going to resist what you're trying to do.
Of course.
Well, that's why I'm trying to understand how this is all going to happen.
It's not going to happen.
You have to give it to the consumers first. You have to create it, and that creates that creates the movement.
But there's a lot of hands in there.
There's a lot of hands in there. They're taking
Getting-
lots of pieces.
Yeah.
I mean, that's why it's been such an intractable problem for so
Right,
long.
right. But we haven't tried this yet. We've
What's,
tried everything else.
what's the feedback you get from members of Congress when you lobby on either side of the aisle on this.
The way I've been talking about it is, so when Obamacare got started, people thought we're going to ultimately have an individual market for all Americans run by the government. That was sort of the aim, right? You can keep your plan.
Right.
In this model, I'm talking about you keep your network, you keep your plan. Your funding just changes. You separate the funding from the financing from the investment
I
decision.
mean, employers will love hearing this.
Yeah,
The
they
defined
do like it.
contribution, they would love hearing
And-
it.
and-
But again, anything the employer is super excited about makes me think as an employee,
Well, we believe we can save up to 26% on the total cost of an employer group if we do it this way. So if you think about that as the model, ultimately, the consumers are gonna push it. They're gonna push it through. So managing the risk across the whole population is really important, number one. Number two, having innovation in product. And what happens with employers is they offer 2 or 3 products on one network. I don't get that choice. In the Affordable Care Act, we've limited the number of products we offer because the CMS was concerned about confusing people when buying their product. People are smarter than we think,
yeah.
and they go to sources to get them. So this is the way to start the process.
It's an intriguing argument. It's an intriguing potential possibility. I've loved talking to you about this over the years, and I hope we get to do a lot more.
Mark, there's an entire political class that viewed the Affordable Care Act as baby steps to single payer.
Right.
They're not gonna let you do this.
This would be
is single payer.
single.
It is in a different way. It's a free market single. It's not a government single payer. It's a free market single payer.
Right.
It would work, but that's the opposite of what they want.
Wouldn't it be great if we came to a single, quote unquote, single payer market, either through consumers aggregating their accounts,
Right.
through a qualified account, or the government doing it, and then all of a sudden, this issue is not an issue between Democrats and Republicans
It's
anymore?
kind of brilliant. I mean,
Wouldn't that be
it
the
seems
best
like it would appeal
solution?
to everybody, but at the same time, it probably ticks them all off in some way too.
Everybody's gonna have an axe to grind, everybody's gonna hurt, but that's the only way we solve this problem. If we expect everybody to keep going as they're going and have this work, it won't.
And once, right again, Mark wants even more government involvement in healthcare. Is that how it would end up in your
No.
view? It would be less.
It would be
wouldn't it?
less.
The government's still gotta fund a lot of it. But if you can keep
Medicaid,
prices, if you
Medicare.
can keep prices down, it wouldn't be as much of a,
So in the Affordable Care Act, $7,500 a year for coverage.
yeah.
In Medicaid, $8,500 a year in coverage, and I'm rounding it to the nearest $100. In employer-sponsored insurance, $9,400. In Medicaid, Medicare, $14,700.
Right. They don't do it very well, do they?
No, and so if you put all of that into a single pool where people can buy what they need,
Yeah.
we're gonna have to have a limit on the bottom where people have to have a qualified health plan, right? Something that is sufficient.
Or catastrophic.
We can't have them just
Yeah.
doing, these minimum benefit plans that, blow up after you hit a certain number.
Right.
So we have to have a qualified benefit, but we define that at the state level.
Yeah.
And we can create these pools at the state level, state-based exchanges, where people can buy. Then then we can give people the freedom to buy what they want. And by the way, this is a red state kind of issue too, a big red state kind of issue.
Because they have so many people.
Yeah, in the program.
Okay, we have to run, but before we let you go, you are the newly named independent chairman at Verizon for the newly named CEO, Dan Schulman.
Yes.
Why the change and what's going to be different at this point?
Verizon has gone from number 1 in market cap, bond ratings, and share to number 3. And the network isn't as differentiated as it used to be, in large part because everybody's been spending money to put these 5G networks in place. So losing 30% share over the last 8 years is an issue. And we have to do something different.
What does that mean?
We have to evaluate underlying cost structure, all those sorts of things. And Dan's working on this, so I'm not gonna get in front of Dan's story.
Okay.
But Dan is working on this every day. And we believe that once we have that plan in place, we'll have a good story. The street reacted early on that, there's gonna be a price war. I think it's less about price war and the value of what we're offering to people through the product. But Dan's coming up with that plan, so I don't wanna step on his parade. And he'll be coming forward with it sooner rather than later. And I think, the board needed to act, and we acted.
Mark Bertolini, thank you very much for joining us.
Thank
today.
you.
We
Great to be
appreciate
with
it.
you.
You too. Squawk Box will be right back.
Coming up, Robinhood's push to expand its business. The platform's chief brokerage officer, Steve Quirk, almost quit. Misspelling? We'll tell We're going to tell us how AI and prediction markets are impacting the trader experience. Squawk Box returns in just a moment. Robinhood is betting big on prediction markets and artificial intelligence. Join us now, Steve Quirk, Robinhood Chief Brokerage Officer. What a beautiful chart. Do you just carry around a little piece of paper in your pocket with the Robinhood chart on it? Steve, I'm looking at it right now. It's
Good.
It's mind-boggling. It really is. You could go back. You go back to early 2024. I think would be good. That doesn't really do it justice, but amazing. Business is pretty good as is.
Business has been good, and customers have been really engaged. We're having all-time highs in equity trading, option trading, margin balances, deposits across the board. So even though there's a little bit of angst about whether this market is toppy, I think and again, our customers are young, early 30s, so they're pretty aggressively investing.
In your top 10 names, there's quite a few AI plays.
There are a lot of AI plays.
So, recently, there's been some, I guess you can almost see it in Robinhood.
Yeah.
There's been a little bit of trepidation, angst about where those stocks are trading at.
I think there's two lenses that we look at it through, and our customers look at it through. One is the investable lens, which is the names you're talking about, and they're generally in the top 10. And then the second component is how can it help me invest? And so we've rolled out something called Cortex, which is early stages of helping them, AI tool, just discover opportunities, look for charting patterns and things in scans. But the next iteration of that will be a little more robust. And that's an event we're doing December 16th, an AI event where we'll kind of roll out more capabilities.
The top 10 that's kind of cracks me up. You got, they all make sense. Tesla, NVIDIA, Apple, Amazon, Microsoft, Palantir, Meta. And you throw in Ford.
Yeah, I know, right?
And then I'd be disappointed if GameStop wasn't there somewhere. That's
They throw in Ford for people like me, right? You have to have those in there.
GameStop for it. GameStop's for all the Reddit types.
Exactly.
I guess. Why do prediction markets make sense?
For us?
Yeah.
Yeah, let me give you the quick history on how we got into the event contract prediction market. November of last year, around the election time, they became permissible. And so the first thing we did there was on the election, and the usage, number of accounts we opened, and the number of contracts we traded was just explosive, like 600 million contracts in a week around the election. And from there, customers said, this is an amazing new offering. We'd love to, get into entertainment, GDP, CPI, even sports, which has become a big component of it. And I know you guys were talking about it this morning. So we're probably at about 1,300 contracts right now, and across 7 or 8 categories. And there's tremendous excitement about it and interest from our customers.
And crypto too, but prediction markets were faster new business than crypto.
Fastest growing business we've ever had.
Is it gambling?
Is it gambling?
Yeah.
I don't think it's gambling. I don't. But again, the lines, I think you guys talked about this morning, the lines are getting blurred in some areas because you're seeing some of the OSBs come into the prediction markets. You're seeing that kind of go back and forth. And I think, I think look, from our customers' eyes, they're young, 30-some-year-olds. This is the sweet spot for them. They want to be able to do all this.
Do they see a differentiation between placing a bet on, I don't know, who's going to make the next touchdown and deciding which stocks they want to own? Is there a differentiation in that mentality?
I don't think there's differentiation in that mentality because they just want to express their opinion and put an investment behind it. It's really interesting because the question we constantly get asked is, who's trading these? Yeah. And it's an entirely different audience for economic indicators than it is for cultural, than it is for sports, than it is for election. So it's kind of like we run the gamut of customers that have interest in this.
But how do you see this all playing out? Because I was making the argument that a FanDuel or a DraftKings ultimately could try to take this kind of market, the poly markets of the universe, could try to take the sports universe into their world. You're trying to do it in a similar. And then does it become commodified?
Yeah.
So that just everyone has an exchange and they're all betting on the same things, but are they betting with each other? Are they betting through your exchange versus somebody else's? Do you see what I'm saying?
Yeah, let me give you, I'll give you like in a perfect world where we see this going,
Yeah.
and it's starting to happen already. This isn't dissimilar to what we do with equities or options. Like, hey, I have 17 destinations that I can route to, and I have exchanges that are creating interesting products so they compete with each other, and we can drive, you know, a great experience in economics for our customers. That's happening here. Like, you now have the CME, the ICE, Poly, you have
Right.
all kinds of people coming in to this, and, you know, we're just the distribution. Like, we have 26 million customers that are interested in this category, and they want to have a great experience. So everybody who enters the space calls us and says, you're the distribution, you're the king here. You know, do you want to route through us?
Well,
How
that's
can we?
my question. You're saying you're the king here.
Well, in terms of distribution.
Right, and what I'm saying is, I don't know, how many customers does DraftKings have, for example?
I think they're 10 million, but I don't know
Okay.
that, yeah.
So that's what I was sort of
Yeah,
curious about. Sort
yeah.
of as you start to compare these other platforms that historically haven't been in your space,
Right.
you haven't been in their space.
Right. I don't think there's an intent for us to get in that space. Like, we're in this space, you know, which is a regulated space. We're very comfortable in regulated spaces.
Right.
Yeah.
Couldn't you just stay domestic? I mean, is it really, you want to be international?
You know, it's, when we go anywhere internationally, you know, so Robinhood's largely credited with opening up the market to 26 million new, young, diverse participants. So right now we're at 60% of US households that are participating in the market. When we go to Asia, when we go to Europe, it's in the teens. And so whenever we go there and talk
You
to
can't
elected
ignore it, you can't help it.
well, I mean, if I'm a elected official there, I want that for my country so that these people are not reliant upon the government when they get to retirement age.
Yep.
So we get a really wide open door and a great reception to come there and help them.
All right, Stephen, thank you.
Thank you.
Thanks for being on set.
Appreciate it. Thanks.
Well,
All right, it is 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. Among our top stories this morning, the longest government shutdown in American history is over. The House of Representatives passing a package of Senate spending bills, and President Trump signing it into law. Meantime, airlines are warning that they need time to adjust their schedules, with industry representatives estimating that it will take about a week to get back to normal. And a USDA spokesperson saying most states would get the funds they need to reload SNAP food benefits within 24 hours of the shutdown ending. The Starbucks Workers Union launching an open-ended strike in dozens of cities. It comes on Red Cup Day, which is one of the company's biggest sales days of the year. The union says that the strike involves more than 1,000 baristas in 65 stores. Of course, that is a tiny portion of the huge number of thousands of stores that Starbucks owns.
Checking the futures right now, take a look at where things stand. We are off on the Dow by about 41, 42 points. NASDAQ down about 45 points. S&P 500 looking like it would open off about 10 points. We're going to get straight over to our good friend Dom Chu. He's got a look at this morning's pre-market movers. Dom, what's on tap?
Good morning, Andrew, Becky, Joe. So let's start with Disney shares sinking 4% after reporting mixed quarterly results. Earnings beat expectations, but revenues fell a little bit shy. The company's entertainment unit fell 6% year over year, dragged down by the linear TV networks business and theatrical releases. Streaming, though, remained the bright spot. Operating incomes there declined 21% for the full year. On linear networks, it actually jumped 39% for streaming. Analysts are going to hear a lot more during the earnings call, which starts at about 8:30 a.m., so keep an eye on those moves in Disney. Another earnings story, shares of Cisco popping 6% after it beat expectations on the top and bottom lines and posted its fourth straight quarter of revenue growth. The company said AI infrastructure orders from hyperscalers reached $1.3 billion, which it called a significant acceleration in growth. The company also issued fiscal second quarter and full year guidance for revenues and earnings per share above estimates. Those shares are up 33% over the last year. And then we'll round things out with shares of Nike up 2% this morning after Wells Fargo upgraded that stock to an overweight and raised its target price to $75. It was $60. Analysts say Nike has been in a negative revision cycle for over 3 years, but they see that trend reversing in the next 6 to 9 months. They focus specifically on Nike's classic footwear franchises like Air Jordans, Air Forces, saying that headwinds to those classics should dissipate in the coming months. That stock is down about 13% over the last year amid CEO Elliott Hill's turnaround efforts. Now, for more on those and other top analyst calls of the day, just head over to cnbc.com/pro, where subscribers get all the context and detail around those notable upgrades and downgrades. Andrew, I'll send things back over to you guys.
Dom, thank you. Meantime, we got a news alert for you. TKO, you ready for this? Which owns the UFC, WWE, and the Professional Bull Riding League, announcing a multi-year partnership now with Polymarket. Polymarket CEO Shane Copeland and the UFC's president and CEO Dana White will be getting into the Squawk Octagon. We're going to talk to them about that partnership right after this break. Do not go anywhere. We've got that breaking news and the men behind it after this. New this morning, TKO Group Holdings and Polymarket announcing a multi-year partnership. Polymarket is going to become the official prediction market partner for the UFC and Alpha Boxing. Joining us right now, first on CNBC to discuss all of this, jumping into our octagon, is Polymarket founder and CEO Shane Copeland. Good morning to you. And UFC president and CEO Dana White, good morning to you. Tell us about this deal, what it means, how it came together. I don't know who wants to start here.
Yeah,
Dana, did you approach Shane, or did Shane, you approach Dana?
Actually, Ari approached me. Look, the impetus for this deal is I actually love watching UFC. And unlike a lot of the other sports, there's no scoreboard. Obviously, you know, someone gets knocked out. That's a W. But other than that, you kind of have to discern what the judge is going to say. It's not that easy. And this idea of looking at Polymarket while you would watch the fight just made it so more engaging. Because you could go and see how likely someone is to win and how it's changing in real time. And all credit to Dana, Ari, Mark. They're forward thinking, they're creative, they understand this disruption and this new technology. And we had this idea for a scoreboard where you could see the live poly-market odds inside of the fight. And, you know, we made it happen.
So, Shane and Dana, the other big question is, what kind of betting is there? Is it just going to be betting on the ultimate outcome? Are there going to be sort of bets that can be taken inside the match itself based on certain things that could happen?
Yeah, so look, of course it starts with who wins. But what's exciting about our approach is that you can actually buy and sell. You can trade just like a stock throughout the fight. And I think that that'll create new user behavior and open up a new way to engage where you can buy and sell as the fight swings, the momentum swings. So we'll start with that, and then we'll take it from there based on customer feedback and what the people love.
Dana, tell me about your thoughts just about the prediction markets versus traditional sports betting, how you differentiate those things, and what your thought was behind this.
Well, we're involved in both, but one of the things that I'm always interested in is how to improve fan engagement and technology when it comes to production, and I always like to be first. So this deal made a lot of sense to me.
How do you separate the difference between sports betting, which you're involved in, and this? I think that increasingly it feels like there's a convergence happening, even if the mechanism behind it is different.
Well, we're obviously doing a deal right now with Polymarket, but we have a DraftKings deal too. So we do have both.
But do you think about them differently? Because we were talking earlier this morning about how, in fact, DraftKings is thinking about even the state of Nevada and which market they're going to like more ultimately, because some of these states are starting to say these things are the same, and we're not going to give out sports licenses for this if you're going to be doing it through this other mechanism.
Yeah, no, that's interesting. That's for him to figure out.
Look,
how do you think about that?
It's a classic version of the innovator's dilemma. Ultimately, the way that we think about it is these events, if you're going and placing money on the outcome of the event, that is a financial market. And right now, they're structured as these entertainment products where there's this sort of regulatory mode, and it's state by state, and the app that you're using, that company controls the pricing, and they can cap you if you're making too much money, and they can profile you and give you different odds. That's not how a financial market should work. That's backwards. So from our point of view, this is the way that things should work, and likely there's no way to hold back the river. So what we're focused on is just having an efficient market and being fair for users where they can buy and sell. And like I've said, what we've noticed is the user behavior is just different. When you can buy and sell easily and you go and present it as something that is more like trading than it is like this, convoluted practical sportsbook, which is awesome, and that's a great product, and a lot of people love to use it, but I do think that there's an alternative way to present it, like a market, and that's what we do.
And then on the sports side, for me, we're always looking for better fan engagement. We're always looking, to make, always grow younger. And this is where everybody's at right now.
Well, that's what I was going to ask you, Dana. You created this, super entertaining product, and I've always wondered whether you think, in the stands, what percentage of people are going to be sitting there with their phones, changing their bets throughout the match in terms of engagement. Sort of an interesting engagement question, because you get engaged, but you also then get engaged in the phone. I always wonder sort of what that experience is going to be like.
Yeah, I think that it's already happening now. I mean, people are live chatting during the fights, and people are on their phones now, not just for my events, but for all sporting events.
You just did a massive deal with David Ellison at Paramount, and I'm curious, when you think about fan engagement, how much more you need to make the math work for people like him, and frankly for you. What other things you think you need to do to get and capture an even bigger audience?
Yeah, we're going to integrate this into Paramount too, and live scoreboard, and I'm always figuring out how to take new technologies and disruptors like him and integrating it into my product and making the engagement better, the experience better, whether it's live or on TV. So yes, this will be this will definitely be integrated into Paramount CBS.
Okay, so here's the complicated question, which is we've now seen a number of scandals, let's just say, including in your league, but now in Major League Baseball, we've got the NBA, where it seems like people are trying to fix fix the game. And because it's such a broader ecosystem now and people can be betting on all of these different platforms, it seems even harder and harder to police. How do you think about that?
Actually, it's the opposite, because now we have more data. The reason that thing was flagged is because there's more data, and they can see the movement and the lines. And one of the big misconceptions about what happened with us a couple weeks ago, we called the FBI right after the fight. So
how did that go back for the audience that doesn't know what happened? Explain.
Yeah, so we have the best bet monitoring service out there, monitoring the lines and what's happening. When there's any weird movement, they reach out to us. So they did on that fight. And we called the fighter and called his lawyer and said, are you hurt? Do you owe anybody money? Is there anything weird going on with this fight? The kid and his lawyer said, absolutely not. And then the fight ended in the first round. Got up from the side of the octagon, went to the back and called the FBI. And now the FBI is investigating it.
What do you think of some of the other situations we've been reading about in terms of what's happening at the NBA, what's happening in Major League Baseball?
Yeah, unfortunately, these type of things are going to happen. Let me tell you what's going to happen if you do it in the UFC. I'm going to be the first one to go after you and try to bury you.
Damn right.
Shane, how do you think about cheating? And let me ask you actually maybe in a different context, because maybe we'll take it out of sports for a second. I think we were all fascinated to watch Brian Armstrong, the CEO of Coinbase, during one of his earnings calls. It was just about a week and a half ago now, I guess, where at the end of the call, arguably he was trolling everybody. He starts, sort of mentioning these sort of what I call bingo words that people had been betting on during the call. Who should pay out in those circumstances? What do you think of that? And therefore, sort of, to the extent that there are individuals who can, influence the outcome, how should the market think about that?
It's a great question. So first, just to go back to what you asked Dana about sports, I think that when it's federally regulated, you can go and have a federal regulatory framework and surveillance framework. It can be a lot more airtight and effective, both at detecting anomalies, but also at prevention. So that's something that we're really excited about. But secondly, you think about these markets, and Brian is a man of the people and a man of the culture, and that was very funny how he did that, just ripping the words off of Polymarket. But what you see is these markets that are dependent on one person doing one thing or another, they just never grow in size anywhere close comparatively to markets that are based on something where there's actual risk and you can model it and there's uncertainty. So I think that there's absolutely a place for these fun markets that are also interesting to engage in, but also the odds are interesting. And with that said, though, when you talk to liquidity providers, people providing liquidity, people participating in the markets, they're aware that this is something that's less of a hedge and less of something that you're going to go and build a financial structured product around, as opposed to something you're just going to predict.
Hey Dana, before we let you go, you got to give us an update on what's going on with the big fight coming to the White House this summer. Where are we?
Still working on logistics. It's a logistical nightmare. When we did the sphere was a technical nightmare. This is a logistical nightmare. So we're working on the logistics, and then in February, I'll start building the card and start announcing fights.
The logistical nightmare is a Secret Service nightmare? What's the...
all the construction.
All the construction going on?
It's the construction that we're going to have to do. We're going to have to level out the grass there because it's a slope. Obviously getting in and out of there with our team. We're building the structure that's going to go over the octagon to hold the lighting grid. So there's a lot of logistics involved with this fight.
This fight obviously is going to be one of the most watched fights in history, I imagine. Is this a fight, given all of the costs that's going to, and infrastructure you're going to have to build and security and everything, something you think you make money doing, or just really builds and elevates, enhances the brand that is UFC?
Yeah, I think both. Obviously, I can't sell any tickets. I don't have a gate. Can't sell merchandise or any of that stuff on any of the federal property. But much like the Sphere, and again, Polymarket, like we're talking about, I like to be first. So I was given this opportunity, and I will make the most of it. I will figure out how to make money, and I will put on an unbelievable card, and it will be the most watched fight ever.
And is Trump going to referee any of these matches?
Definitely not. Definitely not.
And by the way, I was going to also say, now that you're on the board of Meta, maybe this is the big opportunity to get Mark and Elon in an octagon.
Or the undercard could be some members of Congress. I was thinking on opposite sides of the aisle. We're almost there already.
We got to have all those on Polymarket.
And Dana, I mentioned that you're on the board of Meta. You know, we keep talking about AI bubbles, the amount of spending that everybody's spending on sort of all of these new data centers and systems. I know you're new to the board, but do you have a view on just how much money is being spent right now? And, you know, you've made a great business out of the UFC, and I think you care about dollars and cents in a real sort of significant way. So what do you think about what's happening?
It's fascinating. I've never seen anything like it. I just spent 3 weeks out in the Middle East, in Abu Dhabi, where, you know, they are all in on AI too. It's pretty fascinating. And yes, the board meetings that I've sat in, the amount of money that's going to be spent by all the heavy hitters, you know, in the industry is mind-boggling.
Does it change your business?
I think AI is going to change everybody's business. If this thing does what everybody thinks it's going to do, yeah, it's going to change. It's going to change everybody's business and everybody's life.
And finally, to Shane, how's it going to? Am I going to have an agent that's going to be making bets for me?
It's a great question. It's funny because a lot of people bring it up, and it sounds like it's very buzzwordy. And with that said, I think as you are able to trend towards markets on everything and user-created markets and people asking questions and wanting information on a long tail of topics, I think that the idea that people will be able to build AI agents and they'll be able to compete in terms of accuracy in pricing markets will allow the beauty of price discovery and what makes Polymarket awesome, which is being able to ascribe odds and likelihood to all different types of questions, a lot more accessible. And I think that if we get that right, you can see this Cambrian explosion of Polymarkets, which we're super excited about.
Gentlemen, I want to thank you for joining the Squawk Octagon this morning. Congratulations on the deal.
Yeah, thank you.
Look forward to seeing your progress, and maybe we'll all be watching what happens at the White House. So thanks, guys.
Thank you.
And well, Joe's betting. I'm just, you know.
Tens of dozens of pennies.
Thanks, guys.
This does look a little like an octagon.
It does.
A little bit.
Check it out. And we've got Times Square, we've got a built-in audience.
Fishbowl.
Yeah.
We're live.
Mostly
Slams,
closed.
though.
Mostly closed.
A couple of slams here and there.
All right, when we come back,
Octagon, that's a good one.
as more Americans struggle to afford life-saving medications, the cottage industry is stepping in and promising patients free or cheap drugs. But a CNBC investigation reveals where the prescriptions may be coming from, potentially putting lives at risk. We have that story next. Right now, though, as we head to a break, take a look at Circle shares. JP Morgan upgrading the stock to overweight on better fundamentals. The new price target there, $100. That stock's right now at $86.88. Squawk Box will be right back. Bringing down the high cost of prescription drugs has been a top priority for the Trump administration, but it has not been fast enough for employers and families who are desperate for a solution. A CNBC investigation uncovers popular insurance schemes that offer huge savings on medications, but that could put patients' lives in danger. Here's Melissa Lee with Risky RX.
A question being asked across the country: how can I afford my prescription drugs? Prices are skyrocketing.
It's a broken system, and we need to make sure everyone is paying attention.
With some specialty medications costing tens or even hundreds of thousands of dollars per year, and prescription drug prices in the U.S. averaging nearly 3 times more than in other countries, driving people and employers to find a solution.
It's such a desperate thing to think that you might not have your medication at all.
A booming cottage industry is selling itself as an antidote, often getting the drugs overseas for a fraction of the cost.
We do a public service. We help people get access to medications.
But there's a major catch.
What they're doing is illegal, and it's putting American lives at risk.
What I tell my friends and family is that the most expensive medicine that they could get is one that isn't safe, isn't effective, or isn't high quality, and doesn't meet the standards that are in FDA-approved medicines.
Patients and employers are desperate for a solution. The question is, at what cost?
The FDA says it's illegal to import drugs that are available and sold in the United States. All of these drugs are, in fact, available domestically, correct?
And this is just a preview of our full-length documentary. To watch the entire story, go to cnbc.com/riskyrx.
How does this work? What's the scheme if you kind of try and dig into it?
So these are employer-sponsored insurance plans. And so you can work for a company, they have an insurance plan. The administrator decides that in order to save the employer money, they're going to carve out the coverage of very expensive specialty medicines. These are medicines for illnesses like cancer, multiple sclerosis. So they carve them out, basically contract a company called an alternative funding program, an AFP. These AFPs say, we will save you money. You pay us a fee, or we'll get a percentage of the savings that we will get for you, and we will source the medicine from overseas. They mail these medicines direct to the patient. The patient gets the medicine for at little or no cost. The problem is that these medicines that come from overseas, they are not FDA-approved medicines. They are not coming from sites that are managed or overseen by the FDA. So there's no oversight. There's no guarantee of quality, of safety.
Even if it's got the same packaging, and I assume that it's being made by one of the big drug companies like a Pfizer or Lilly or something, it's got the same packaging. And I assume I'm just getting it cheaper because they sell those drugs cheaper overseas?
You can make that assumption, and packaging can look the same, but these medicines could still be counterfeit. You also don't know how these medicines have been treated. So if they needed to be refrigerated, for instance, and they are not, then they are ineffective. And so effectively, you have a serious illness like cancer or multiple sclerosis, and your medicine is not effective, it may not be real. This has not gone unnoticed by the FDA. We made more than 100 public records requests. We've gone through 1,000 documents. We've gotten emails, invoices, and we know that, for instance, the FDA has sent warning letters to some of these companies saying, stop what you're doing because you may be bringing in counterfeit or mislabeled drugs into the United States and giving them to patients.
AFPs are what? Alternative
funding programs.
Are they all kind of basically just big schemes? If a company is looking at doing business with one, is it stop, don't do it?
To be sure, there are AFPs that do not import drugs. We are talking about the ones that do. And that is the problem. That is where there is sort of this, we can't let patients get their hands on non-FDA approved drugs. But the patients and the employer, they're in a very tough situation. Everybody is facing high costs of prescription drugs. People can't afford these drugs. And so everybody's looking for a solution to this broken system.
Has there ever been sugar pills or something that came? I mean, something not even close to
the formulation.
What you think?
Yeah.
What do you think? And you know what else it could be? They could be old because they lose. It could be if it's 2 or 3 years old, the efficacy is not.
We just don't know. We do know of a case, for instance, of one AFP that actually sourced medication, an HIV PrEP medication from Turkey. It came direct from a Turkish pharmacy, direct to the patient's doorstep. The packaging was all in Turkish. The instructions were all in Turkish. And this insurance plan, it wasn't a small one. This is Meritain Health. Meritain is an Aetna company. Aetna is owned by CVS.
So if I'm the employee and I don't even know that my employer is cutting these deals with the insurance company, how do I protect myself?
You have to see, who covers your specialty medicines. You can go into your handbook, specialty medicine coverage, take a look at who does it, and you'll have to ask them, where do you get your medicines? Be careful though too, because a lot of these AFPs promise that we get their medicine from the UK, from Canada, places that are safe, places that we all think have the same standards as the US. But in many cases, these drugs are being transshipped, meaning they are coming from a place like Turkey through Canada
Even if they're
and
coming
then to
from
the United
Canada,
States.
you're telling me that it's illegal anyway. So why
That
would
is
they be
still-
admitting to me that they are doing something that's already illegal?
Because the legal argument by the AFPs is we are doing this legally through the personal importation policy, which allows people to bring in a 90-day supply of drugs into the United States for personal use. These companies say, we're just facilitating the patient's right. You're right. We're helping you get those drugs directly. But the FDA, we've asked specifically about this particular business practice, and they say clearly it is illegal. It is not permitted to bring in FDA-approved drugs that are available commercially here in the United States from overseas.
Melissa, thank you. Again, this documentary, you can see it starting tonight.
Yeah, no, it's online.
It's online.
Online.
CNBC.com/riskyrx.
Congratulations.
Yeah, we're all gonna watch it. We appreciate it. Melissa, thank you.
And coming up, the White House exploring some new measures to curb the influence of proxy advisors. And later, former Commerce Secretary Gina Raimondo on economic security and strategic competition as the battle for AI dominance grows. Squawk Box will be right back. The FTC is reportedly investigating whether proxy advisory firms, ISS and Glass Lewis, violated antitrust laws in how they influence shareholder votes as the Trump administration considers an executive order to curb the firm's power. For more on this story, let's bring in Paul Argenti. He is Dartmouth Tuck School of Business, a professor of corporate communications, and it's good to see you, Professor. Good morning.
Good to see you.
What's behind this in the real world? Do you think I can see? It's multifaceted what we're talking about, and there's certain things that I had a big problem with, and that is, you know, a person at, let's say, a BlackRock or a company that deals with ETFs, putting his or her own beliefs into the way that they vote on proxies for people that think they're just buying a passive investment. And I had a major problem with that. Is that what this is about, or does it go beyond that?
I think it goes beyond that, Joe. I think what's really going on here, and I assume most people understand that these advisors stand in place of large asset managers who don't have time to vote on tens and tens of thousands of proposals that are coming up. So they have to vote on them. The ostensible issue here is antitrust, but the real issue behind it, I think, is more political and focused on how these firms have been voting, particularly on ESG. That's what's going on. And I think the Trump administration wants to limit the power of these firms. And in fact, there is some obvious issue around two firms controlling 90% of the proxy advisory market. And you never even heard of these firms before. Most people don't even know they exist or realize what role they play in shaping, how we think about the financial markets.
We've seen that it would be not a big surprise if the Trump administration did decide that certain, for lack of a better term, woke mandates, that they would have a problem with that. And it's not like it hasn't happened. I mean, there were plenty of times where climate issues that maybe half the country thinks it's important, the other half doesn't think it's important, and it definitely was emphasized by these firms. You had to comply with what they decided. As you said, the other S's, the E's, the S's, and the G's were all there.
Yeah, I think that is a problem. But what are you going to do if you're a large asset management firm? You don't have time to focus on each and every one of these votes unless they take it in-house. And I don't think the issue is whether these two firms have too much power. They do. The question is, what do you do about that? How do you control it? And how do you try to make it a fair fight so that they're not pushing a particular political agenda? I think that's a legitimate question.
Hey, Paul, I'm curious where you land on this. So I am of the view that a BlackRock or a State Street or a whomever should be able to vote on behalf of the shareholders that effectively are giving up their vote for the most part because they don't actually look at these things or have the resources to figure it out. There are other people, including, I don't want to put words in their mouth, but my two co-hosts who feel that actually these are super passive investments, that effectively there should be no voting, or if they want to vote, they should vote, but the vote shouldn't be handed.
Well, I think it should be an opt-in process. I think it should be opt-in. I don't think the default should be that if I don't vote, they get my vote.
Right.
I choose to hand over my vote to them, that's a different story.
And my view on this is that most people are not going to actually opt in, and therefore they're effectively handing their vote to management. That's the difference, I think, in the sort of debate here. My question to you is, what is the implication of that, and is that a good thing or a bad thing in your mind, to allow these firms to vote on behalf in an opt-in or an opt-out or an automatically opted-in way for those people who ultimately don't vote themselves?
Yeah, I think it's a problem. I agree with you. I think there should be more control.
Which a problem.
Sorry.
Yeah, which side are you taking?
I think that the asset managers should take a bigger role in this and have more understanding of what's going on and not allow this passive relationship to exist. But on the other hand, Evan, I'm sure you all realize this is a big problem trying to figure out how they would actually do that.
Wait, I'm sorry, I still don't understand exactly what you think, Paul. You think that the asset manager should be taking a more active role, or that they should not have the vote unless it's turned over to them?
I think they should have a more active role. I do.
So get it, whether I want them or I agree with them or not, I have to hand over my vote to them if I don't physically vote it myself?
I think you have no choice. Like, I mean, you either have the option of voting yourself, right? Or turning it over to the advisors. And in a real world where there's thousands and thousands of votes, they're going to end up relying on proxy advisors more than anything else. On the other hand, we could question whether that is something you could do yourself if you brought it in-house and had smart people working on this.
But Paul, I don't want to speak for Becky or Joe. I think there is a community of people who think, I don't agree with it, but the view is these are passive investments, therefore you should go along with either you should vote yourself if you want to personally, or you should effectively go along with management as a passive, whatever, because you're just buying into the index.
No, I'm just saying, if somebody else is going to get my vote, I should have to physically turn it over to them. It should be my choice to say, yeah, I trust you on this, you go ahead and figure it out.
Yeah.
Not that,
Yeah.
okay, not this paternalistic view, like, you're too stupid, that we will take over for you.
That sounds like what you're saying, Professor. It's like you're saying, hey, if you're not gonna do it, then give it, these guys are a little bit
But
better
what
than
I'm
you
saying is the
are.
practical reality is that Becky and Joe are super sophisticated in this. Most people are not going to hand over their vote or check some box because they won't know to check the box, and therefore,
Exactly.
right? That's my view. I don't know where yours is. So,
Yeah,
where
I
are
think
you?
I'm more close to your view than theirs on this one.
So having a woke, I mean, I looked at some of the people that have run these places, and some of them are really woke, Paul. And so if I don't stop them, I should just assume that they're gonna vote whatever their opinions are on all these contentious issues. I should just sit back, and if I don't take it upon myself, I should assume that my shares are gonna be used to vote in whatever their predilections are. That sounds ridiculous to me.
I mean, I think
Just
the
don't do
numbers-
anything. Just don't even vote. Abstain.
Yeah.
Taxation
That's a tricky
without
one.
representation.
I mean, this is a tricky one, and that's why you guys are talking about it today. And I think, how it gets decided by the Trump administration matters a lot. But I think the way it is going to be decided is based on the politics, not on the actual issue, the antitrust issue, which is the more important.
But is your contention that corporations do need to be held to account, and as bad as these ISS or any whoever you're trying, as bad as they might be, it's better than letting the corporations just do whatever they want and that's why these proxy issues are up for vote.
Yeah, I think that's right. I think that's right. But I think you're absolutely correct that sometimes it's going to lead you down a path that you probably don't want to go into. And what it means is you need to be transparent about what you actually believe and make sure that they're representing your point of view and that this is getting sorted out in a way that makes sense to your corporation.
Right, but Paul, here's the issue, and this is again
I would
to
just never give
speak
them
for
I'll
everybody
never
else.
give them any of my money then.
I'll play the devil's advocate here. The point is, there are going to be lots of times where some of these guys may vote for you without you either knowing or appreciating these points. And the other piece of it is a lot of these funds are overseeing assets that you don't really get to select that they are your representative insofar as, it might be part of a 401k plan that was assigned to you by an employer or something else. This is not just, that you get to choose the asset manager that you love the most.
And I've never had a Vanguard or anybody ever ask me what I think as the shareholder we should be doing, or inform me what they think either.
Yeah. I mean, if you and I were setting this up, we would do it differently. There's no question about that. But I don't think it should be sorted. We're conflating two issues here. Is there an issue, Joe, around the ESG voting that goes on here? Yes. Is there a potential antitrust issue here? Yes, but they are not the same thing. They're two different things, and both of those need to be dealt with. And I fear that the real interest here is political.
It could be diversity, and let's say you really fervently believe in diversity, and that's what you want, and then you get a manager who would never vote in favor of that. So suddenly everything that you feel, and it could affect either side, the woke side or the non-woke side. But
exactly.
that's what I have a problem
Take
with.
the politics out of it.
Yeah,
Logically, it's
they shouldn't be able to put whatever their personal predilection is to a passive investment.
unless I, as the passive investor, say, yeah, I want to opt into this
I'm
because
stupid,
I'm not.
go ahead.
Well, I'm
Yeah.
not going to take the time to look into this,
Right.
and I trust you more than I trust the manager.
Yeah, which is what you do when you get those things in the mail, right? That's what most people do. You figure it out.
And that's the issue. Okay, Paul, thank you. We were going around in circles, but we appreciate you helping us think about it. Thank you. We're going to talk tariffs, trade, and tech with Gina Raimondo after this. Don't go anywhere. We got a quick market flash for you. Take a look at where things stand right now, because Oppenheimer raising its price target on NVIDIA to $265 from $225. That stock trading right now at about $191. They're arguing that the company is still best positioned to win that AI race, and NVIDIA will report results next week. I think the markets are all going to be keying off basically that one stock. Whatever they say, it's either going to rip or go somewhere else. But that's it.
All right, a new bipartisan report out today from the Council on Foreign Relations. The topic, U.S. economic security and strategic competition in emerging technologies. Joining us right now is former Commerce Secretary in the Biden administration, Gina Raimondo. She co-chairs the task force in charge of that report. And Secretary, thank you for being with us. Watching Washington these days, it's hard to think of anything being done in a bipartisan manner, but what were the conclusions that your report reached?
Good morning, guys. It's great to see you and be with you. You know, the good news is that economic security and winning the tech race against China is still bipartisan. That was true when we did the CHIPS Act, and it is still true today. So the primary conclusion of the report is that in order to win and outcompete China and keep Americans safe and secure, we really need to lead in AI, quantum, and biotechnology. And that means everything from staying ahead, out innovating faster than China, but also securing our supply chains, making sure that, for example, for biotechnology, we have to make enough and invent enough medicines in the United States. And these are three areas where China is obsessively focused. The PRC has increased its investment in biotech by 400x in the past 10 years. So if we want to win, which we do, which is bipartisan, we have to up our game.
Where do things like exports controls for semiconductors fit in that narrative? Because there are some people who say the way we win against them is to not give them any access to any of those chips, and it's a national security issue as well. There are those within the industry who say, wait a second, if you don't supply some level of chips, even if it's not the latest and the greatest, we will no longer be the global standard and we will fall behind that way. Where do you come down?
I come down on offense. You do need defense. We should deny China our most sophisticated technology and do it with our allies. National security can't be compromised. It's not for sale. But at the end of the day, trying to win by holding China back, I believe, won't work. We have to out-innovate. We have to accelerate. And we have to have much more secure supply chains than we do today in all three areas. That is the way to win. We have to lean into our American system, right? America has the deepest capital markets, the best innovation flywheel, a risk-taking culture, fantastic colleges and universities. Let's lean into that, and that's how we win.
In terms of what you're seeing, whether we're falling behind or not, what's the answer? What did the report conclude? When it comes to AI, when it comes to things like rare earth minerals, I mean, that's been a game changer.
It is a game changer. I mean, there are some concerning signs. We can win. Let me say that. We can win. Best country in the world. But critical minerals, things like copper and lithium, other metals, rare earths, we are dangerously dependent on China. We need to come up with a holistic strategy for the whole system: mining, processing, manufacturing. Maybe not all in America, but with our allies. Biotechnology, I think if the average American understood how reliant we are on China, not just for, Tylenol and penicillin, but for really advanced medicines, and how much of our contract manufacturing is done in China, it doesn't look good, Becky. And so we have to do more in the US. We recommend setting up a system of biotech hubs around the country, but also let's rely on Korea, let's rely on Europe to secure the American supply of medicine.
Are targeted tariffs for things like medicines and pharmaceuticals the right way? Because the president has said you're going to face very high tariffs if you manufacture outside the United States. If you manufacture within, you're going to pass on it. And some of the biotech companies and pharma companies like a Pfizer seem to be kind of playing along with that and increasing their manufacturing here in the United States as a result.
Listen, I have always thought there's a place for targeted tariffs, targeted being the key word. I mean, I think blanket tariffs just raise prices for consumers. The question is it something we can make in America, or will the tariff just increase prices for everybody? But what I would really say is tariffs are one tool. And one of the things that I learned in government that the report highlights, the US government has a whole toolbox of tools. DOD could do procurement. We have to increase our stockpiles. I think we have to do more to incentivize the private sector to make investments. Like with the CHIPS Act, for example, for every dollar of taxpayer money, we crowded in $10 of private sector money. That's the special sauce of America. So I think that's what we have to do more of.
Secretary Raimondo, thank you for joining us this morning.
Thank you, guys.
Squawk Box will be right back.
Today on Squawk Box, Disney beat earnings estimates, but the stock is down now 5%, or about $9, right?
$6 now.
$6 now, I'm sorry. Nike upgraded to overweight by Wells Fargo, and just in, Grayscale Investments filing for an IPO. It's going to list on the NYSE. The ticker symbol is going to be GRAY, G-R-A-Y. Make sure you join us tomorrow. Squawk on the Street begins right now.
Good Thursday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer, David Faber, Post 9 of the New York Stock Exchange. Futures a little soft as the Dow comes off a record high, on pace for the best week since June. The government shutdown is over. Markets asking what's next. We would have gotten CPI, where consensus was for 3.1. That would have been the highest in about 17 months. Our roadmap begins with the longest government shutdown in history finally coming to an end. The president signs a funding bill that does pass through Congress.
Disney's out with its earnings. We've got a lot to explain. Profits were better than many estimates. Revenues below many estimates. Streaming subs up. There was a dividend hike. So some buying back some more stuff.
Yeah,
right?
$7 billion.
Yeah. And of course, we're going to talk about the AI boom fueling Cisco Systems' latest earnings and its outlook. The company's CEO, Chuck Robbins, will join us in a first on CNBC.
Fantastic.
Let's begin with the end of this 43-day shutdown. Last night, the president signed funding legislation into law that will keep the government open until January 30. Measure will result in back pay for federal employees who've been furloughed since the beginning of October and those who've been working without pay. Starting to see some schedules, Jim, of when we might start getting data releases. Not all of them will be complete or even whole.
No, but what I want to focus on is what Wall Street's saying. And Wall Street is saying you basically have the end of the gloom. They were really relating the gloom in restaurant and retail to the shutdown. Now, David, you know there are not that many people involved with the shutdown, but you know that Wall Street had churned on restaurants and retail. And it's almost like they're using this as a reason to get back in ahead of the holiday season.
So you don't necessarily see that large a connection between the shutdown and reduced spending in those areas?
I do think that what happened again is that the stocks reflected a dramatic slowdown, and the actual companies did not get a dramatic slowdown. And I think that says that those bode well for all of us. Carl, the dislike of tech right now. I did a book signing last night at Barnes & Noble, and the people were in Brooklyn, and everyone was really nice, and they watched the shows very closely. And the thing that people wanted to talk about was CoreWeave, and how CoreWeave was something that they all owned, and they felt had really made great strides, and yet there was missing the quarter. Now, the granularity of how they missed is not nearly as important as the fact that, like, holy cow, I thought I was in the hot one.
Yeah.
And the hot one.
We did get some initiations of that name, which we'll get to a little bit later on.
I mean, Compass Point.
Yeah.
Compass Point, David, Compass Point.
What about Compass Point?
They like CoreWeave.
They like CoreWeave?
Yeah.
Yes.
Although
That's great.
we now can trigger the 5-year CDS charts on these names, and the CoreWeave 5-year CDS quarter to date up 72%.
Yeah, I mean, I did it the other day. I think it was up 50 something, so it keeps moving in one direction. Right. By the way, I did watch your lead on Mad Wednesday.
Yeah,
Wednesday.
the pivot at the end of the
year. What was it, Tuesday? The end of, I mean.
The end of magical investing.
Yes.
It's the end of magical investing.
Again, I was not yesterday, but the turn that you had on Tuesday.
I said that you've got to start caring about profits. What a bummer.
I know.
That means that, Nebius, not a Nebius fan, and CoreWeave not that good. Palantir, by the way, has profits, so I was not turning on Palantir, just so you know. The nuclear plays, Akla, I started calling it Okla.
I know we talked yesterday about quantum and Rigetti.
Oh, they're hurting.
There's crypto, there's strategy and block. We can go through all these names.
I am so glad you mentioned quantum, because I found something that is incredible for quantum in the Harvard Gazette. 3 professors doing much better work than any of the quantum companies. Now, David, the 3 professors,
yes.
I don't know how they charge, but their stuff is better than any of the quantum companies that I looked at, with the exception of IBM. I was reading it, I said, wow, that's everything we need from them. But then I looked and it was like they're doing it for free, David. what does that say about the other quantum plays? If these three Harvard guys got together, I don't know. It could be bad. They answered all the problems that all these companies are desperate to fix, and they did it, like in the lab.
I wish I could tell you that I had some sort of real understanding of quantum, and I mean, just the whole idea
I'll send you the
of
Gazette
it, I
article.
mean, it's not something that I can help here.
Well, you read the Gazette article, you realize that these guys may have answered everything
I continue to hear, though, that it's still, for its full application, you're going to need an advance in physics that is yet to occur.
No, that's what I've got. These three Harvard guys, they're physics guys. Look, I wish I were kidding. I got it. I'm so used to seeing bad stuff in the Gazette.
Where do you have it from, Jim?
From the Harvard Gazette. It came out yesterday. It was really good. It answered all the objections these guys are working on.
Have you peer reviewed?
Everyone's talking about it, David.
Have you peer reviewed their work yet, Carl?
Well, I'm early.
Is the Crimson gonna?
Crimson apparently is all over it.
Really?
But these guys have answered everything, and it's the one. But I can't find the symbol.
Look out, crypto.
Oh my God. Yeah.
What is it? Roughly a quarter of existing Bitcoin could be subject to some encryption break.
I think that look, this is right now. All of these are science experiments, all the stocks. And so what I did was look and see who does some serious science. And it turns out that Harvard still has serious science. The president didn't hobble them. He doesn't crush that department.
Apparently not. Okay.
Just something to keep in mind.
I will try and keep that in mind.
It is a science project.
Trying
It's
to
a
keep a lot of
science
things
project.
in mind right now.
I got the Gazette piece. Just, it's called, it's called A Potential Quantum Leap. And it's incredible.
Scott Bakula.
They've unveiled a system that is going to solve all the long-standing barriers to using it for a generation of supercomputers. That's exactly what D-Wave is doing. Now, I don't want to spend any more time on it, other than the fact that I can't find a symbol for this Harvard physicist thing.
They'll start a company. Maybe take them public through a SPAC next week.
I mentioned it because the year of magical investing is over. Okay?
According to you, but did everybody get the memo?
They're getting it so fast, it's scary. Yeah, they're good. We can get these physicists, put them on the lawn of the White House against D-Wave. David, there's a prelim fight on the card.
Octagon?
Yeah, prelim fight on the card. The TKO card.
Got it.
There's a fight.
I understand. I know. It's going to happen when it's July 4th next year, right? Yeah.
That's the anniversary of the country. How you want to celebrate
250
What do you
years.
want, Jefferson versus Adams? We can do them in AI.
We can. We could recreate them in AI and have them. They ended up
could be a
being
beat
friends, and their correspondence went on forever. And of course, then they died on the same day. And you know what day that was?
Yeah, the Independence Day.
It was.
I know. Well, we can do the whole thing. You set it up.
Yes. Let's do Disney instead, though. Down in the free market, beating on the bottom line, but posting a slight revenue miss. Company says Disney Plus added 3.8 million subs in Q4. The Dow Components linear TV business did have a decline in ad revenue, David, but ESPN domestic ads up 8. Not too bad.
Not too bad. And listen, and Jim talks about this a lot, but it is worth reiterating. This company is about parks and experiences.
Yes.
It is more than half of the earnings of the company. Obviously, linear cable continues to be an issue, although, as Carl points out, ESPN, they are growing ESPN Plus. We don't have the numbers, subscriber numbers. We're not getting on that front. And then on the film entertainment side, better, I suppose, the box office. Not a couple of things that didn't work, a few things that have. Jim, I guess it's. The stock is down, or will appear to be down.
Overreaction.
20 minutes from now,
That's
when we
an
get started
overreaction.
trading.
You got a dividend boost. You got a buyback.
And they are talking about, obviously, guidance that gets you to a place that investors conceivably would like. That said, it was not a great quarter.
Linear. Linear's just. They could spin off linear.
They don't want to spin off
They
linear.
could call it distant.
They don't.
Like distant.
They don't. Distance.
Distant.
Distant. They don't want to spin off linear.
They don't. But linear's a problem.
That's not part of their current strategy.
And you want to do experiences, which I think is the greatest division. But David, $120 million in dry dock expenses.
Well, there was a couple of cruise ships here. One required more work than another.
Right,
or
but I'm
something.
saying you got to get. All I'm saying is you got to get those ships in the water, and it's going to change people's perception. I think the buyback. I've asked for them to do accelerated buyback. I think that would be terrific. That's what DuPont did, a brilliant buyback. But I think the problem is again, they're just people who keep, like, they expect something from Disney that Disney can't give them yet.
No. And again, you know, Parks business is on what, almost 60% of their income.
But that's a great business.
Yeah, it's a great business, and obviously they've taken an enormous amount of cost out of the business overall. That's something important to remember now that Iger's been back. Amazingly enough, it's been 3 years.
Wow. You want to look at a 10-year chart? Should we look at the 10-year?
Yeah, let's look
at Disney.
Why do you hurt me, Michael?
Yeah.
Let's look at it.
It's essentially where we were in 2015, Jim. Talk about trying to turn a.
Was Comcast on that? Make it a little easier to compare. Yeah. Be fair. Always be fair.
Hugh Johnston, though, who I think just extended his deal.
Yes, he did, the 20-year.
Was on Squawk this morning and talked about, I think the word again was a choiceful consumer. Take a listen.
Bookings for the first quarter are up 3%. So we feel good that we've got continued momentum there. Number two, per caps, so the amount spending per head at Walt Disney World was up 5% for the quarter. So again, people are spending. And then number three, cruise ships. Despite the fact that we've added a lot of capacity in cruise ships, we're selling out at the same rate that we had been previously. So that added capacity is filling up quickly. So overall experiences, our consumer is operating in a very healthy way.
See, David, this word choiceful, which didn't exist like maybe, I don't know, 5 quarters ago.
Yep.
Are you choiceful?
Am I choiceful?
Yeah, are you choiceful?
In what way? In what
I mean, people are, every CFO I talk to, except for the ones that are involved in heavy machinery, are talking about the consumer being choiceful.
Yeah.
And was the consumer mischoiceful previous to this?
Perhaps they were just willing to spend more because, yeah, their choices weren't as
But do they
economically
think more?
motivated.
I mean, do they think more?
I don't know,
Do they go to
Jim.
Rufus on Amazon rather than just
I
order?
don't know. I don't buy anything. So I'm not the person.
I gotta go to Chuck Robbins. I'm tired.
I don't. I will say, I mean,
No,
again, on Disney, the return on invested capital in their parks, you know, is like 30 to 35%. It's not bad.
Okay.
But one thing you will hear is they want to engage with the younger consumer, strangely, even more. And that's
Yeah,
something
because they
that
are
need to
not
do.
choiceful, except for when it comes to alcohol.
Are you moving on?
Yeah, I want to go to Cisco.
Oh, okay, great, great.
All right. A feel-good story. Shares of Cisco are rallying after an AI-fueled beat and raise and another quarter of double-digit order growth. This was a super quarter, and it made me feel like don't give up the ship. And joining us now, first on CNBC, Cisco Chair and CEO Chuck Robbins. Chuck, I'm going to go right into it. Congratulations. This was a monster quarter. How did it come together?
Thank you, Jim. It's good to be here with you all. Wish I was there in person, but we'll do that sometime in the future. Look, the team's executed really well. We had a record quarter. We had $1.3 billion in AI orders, AI infrastructure orders from the hyperscalers, where last fiscal year we did just over $2 billion total. We're going to do probably double what we did last year with the hyperscalers and AI. We saw our pipeline extend in the Neo Cloud, the Sovereign Cloud, the enterprise space around AI. And then we saw this big uptake begin on this campus refresh with the new portfolio that we put out there. So we had strong performance across geos, across technology areas, and across customer segments. So it was just a good quarter.
Now, I do think that you were critical of yourself, and I want to get there because you bought Splunk. You have a very good security division. I did a show where I talked about your security division, but you weren't happy with that, and that seemed to be the one business that you think you should improve on.
Well, what I said was we're clearly not happy with where we are in security, but we've made a ton of progress. And if you just look at the revenue in the quarter, you can misinterpret the progress we've made in security because what really happened is there's an accounting treatment to cloud-based Splunk versus on-prem Splunk. And the on-prem stuff, you recognize revenue immediately. The cloud stuff, you recognize it over the life of the contract. And the percentage of cloud deals, which is great for us long-term, was much higher than we anticipated in the quarter. But the demand side, we saw strong demand on our new firewalls, which has been a challenging area for us for years. We saw strong demand in our new and refreshed products. And so overall, we're still pleased with where their business is going, but we got to get there faster.
Now, one of the things that you and I talked about when we were at GTC for NVIDIA was a partnership. And I know someone said to me after, Jim, that's not a serious partnership. You just, Cisco's going to take forever, whatever. There was a remarkable amount of business that you did with NVIDIA this quarter.
Well, if you're providing infrastructure under AI, odds are you're working with NVIDIA right now. So we obviously have a great partnership with them. We actually agreed to build an Ethernet switch with their silicon, their Spectrum X silicon, that'll be coming out in the second half of our fiscal year. We believe that this ecosystem is going to continue to expand, and our job is to actually be neutral party in the midst of this ecosystem. But obviously the partnership we have with NVIDIA has been fantastic for us. We also announced big partnerships with Middle East sovereign clouds like G42 and Humane. And so we just continue to try to extend our presence and be an ecosystem partner to anyone who's relevant in this space.
Chuck, there was a wistful moment on the call where someone asked you that you were there in 1999, 2000, and could it be the same thing? And I want you to share with our audience your answer, because it's very pertinent to the people who are very bearish right now and think that we're on some sort of precipice.
Well, I remember that time way too well, Jim, unfortunately. And there were customers that had no money. There were customers that were building business models that really were full of hope. And in this case, the predominant spenders in this era that we have now are companies that have incredible balance sheets, incredible cash flow, incredible profitability. They're the biggest tech companies in the world. And they fundamentally view this transition as existential to their future. And so the belief that they're going to stop spending anytime soon, I think, is flawed. We haven't even gotten into physical AI. We haven't really begun to get into robotics. We haven't begun to get into agentic. This thing hasn't even really moved through into the enterprise in the way that it's going to. So I still believe it's early, and I think that this technology is going to be revolutionary, and it's going to affect everything, and we're just scratching the surface of what's going to happen in this space.
But I do want to quote you as saying, I think the companies that are investing in this are massive, strong balance sheets, strong cash flow, profitable companies. Isn't that probably the exact opposite of what OpenAI and Sam Altman are?
Well, I think they're early. They're a key provider of the technology that is going to make this all happen. So I think the question relative to OpenAI is how rapidly can they get to profitability? How do they scale their revenue? But we have a great partnership with them. We're using their technology internally, and we're working with them on many of these neo clouds, and many of the sovereign clouds are using their technology as well. So I think that they're a big part of this ecosystem, and I think they're going to be very successful over time.
Hey, Chuck, I'm glad you mentioned accounting, because there is this ongoing debate about the lifespan accounting of some of these tools. There's a great quote the other day in a story on the tape. You won't always need a Porsche 911 engine to run these workloads. Eventually, a VW engine will do fine. Is that a fair way to look at it?
Well, I don't know if you saw Lisa Sue's interview yesterday that she did, but I thought she did an amazing job of explaining this issue. And she said the workloads are just going to continue to expand. Every workload is not going to need the latest and greatest GPU. And so I think you're going to continue. It's no different than what we see today. We build networking products that span from low-end applications all the way to the highest end, these AI training models, and our technology spans the use cases, and I don't think it's going to be any different in this case. So I just thought she did a brilliant job explaining that yesterday.
Well, I want to thank you, Chuck, for coming on. I think it was very interesting for you to raise this early in your year and said to me that you've got tremendous confidence about what's to come, and it's not a one-quarter phenomenon.
It's really incredible to see the acceleration of what our teams have built. We didn't even talk about our silicon strategy and the uptake we have. That's at the core of what's happening in this AI infrastructure space and with the hyperscalers. And we just see them continuing to accelerate their spend. Our teams have done a great job and are building technology that these customers want, and we have a lot of confidence in the balance of the year.
Well played, Chuck Robbins, the Chairman CEO of Cisco. I love it when you come on both in good and bad times, and boy, is this a great one. Thank you.
Thank you.
Absolutely. I got to tell you, Carl, you want a cheap, inexpensive data center play? We just talked to one.
All those upgrades recently looking pretty smart.
All deserving.
Yeah. Take a look at the pre-market here. Again, futures soft, although we're really not that far from all-time highs. Would be around 68.90 on a closing basis. We're back in a minute. It has been a busy week for tech company earnings in China and Japan. We did get some competitors to Seagate and Western Dig out of Japan today, where income down 60% year on year, causing some weakness in those names. We've already covered Disney. We'll get to the opening bell. Got some calls on Nike, Meta, Dollar Tree, and more when we return.
Matt Dash, 4.5 minutes before we get an opening bell on this Thursday. I see Dollar Tree there.
A rare downgrade to sell by Goldman, talking about lower income concerns, basically saying that lower income people aren't even buying. Not the purchase for a 10-year Dollar Tree. Now, Dollar Tree is very inexpensive, but they have raised the prices. You know, they have a lot of 3 to 5 stuff. They buy Dollar Tree. But they also rely, and this is really important because it's a very it's an empirical analysis. There's an alpha called 100X that I use, mission-based data. What they do is they ask for customer intent. Customer intent is not in favor of Dollar Tree right now. So I thought it was a compelling seller, to be honest.
You did?
Yeah, I did. I like the TJX more. The Dollar Trees, these places when you go to them, it's no longer $1. The candy aisle, yes, you get Smarties from them.
Yeah, but not much else.
No.
Yeah.
No, it's not like the old days. And tariffs did them in.
All right, we got 3.5 minutes until we have an opening bell here at the New York Stock Exchange. Don't go anywhere.
at the opening bell in the CNBC Real-Time Exchange. And the big board is TKO Group and Polymarket celebrating this new multi-year deal. Polymarket will become the official prediction market partner for the UFC, Shapiro Boxing. Ari Emanuel, Mark Shapiro on Mad tonight.
Companies are getting into this. You know, we had Flutter last night, and don't forget that's FanDuel. It's a crowded market, but it's going to be jump ball, I think. David, what I think matters the most is who's the most exciting.
I'm sorry.
Well, I mean, when you go Polymarket,
yeah.
it's kind of like when I look at daily fantasy, I go back to the court. I see who's got what does FanDuel have, what does DraftKings have. It's a competitive market.
It is, except Polymarket is not authorized to be in that world.
They're not. There's no house.
Right.
Polymarket.
There's no gambling.
But maybe
and,
there's a vig. Maybe someone cuts the vig. I don't know. What are you gonna say? There's no camp. Where are we gonna see?
I was gonna have a Casablanca reference.
You know, he's gonna go back to Casablanca. Yeah. If it isn't Doctor Strange on this desk.
Yes.
I have a very limited.
I said to you earlier, why do you hurt me, Michael? I was like, Godfather, you didn't even go there.
Sometimes I miss your Godfather reference.
You missed the whole show. You're busy talking on the phone.
At the NASDAQ today, crypto mining company Bjin Blockchain celebrating a recent IPO too.
Yeah, everybody's got a gin.
Yeah.
I'm an aviation.
Well, to your point about prediction as well, there's reports of Cliff Asness looking to get into it.
Everybody
margins there
wants to be
are
in it 'cause
fat.
it's in gold rush. Yeah. And I think you're gonna struggle to differentiate yourself, and that's the problem right now with regular gambling. There's just they try to open accounts by giving you an anytime touchdown by Mahomes. I mean that's how you open an account, and look out. It's a big scrum.
As for markets, Jim, interesting note out of JP Morgan today that hedge funds, long shorts got pretty cautious in October.
Right.
And any reversion could push you to a year-end rally.
Well, look, I just think that everybody's got to recognize, Mr. President, hold your ears, but if Justice Roberts sides with it, let's get rid of the tariffs, then there are companies, I just mentioned Dollar Tree. Dollar Tree goes up 15% the moment that Chief Justice Roberts strikes it down. Because wait, what are you doing? I'm
talking to Ari.
Oh, hey, how you doing?
Ari doesn't recognize show, no show. He just talks.
Well, yeah, you know, you're a no-show if you do that.
But he's going to come back down here to do your show later.
Well, how do you like that?
Yeah.
I just
pretty nice.
What else are you talking about?
Well, to your point, though, about names that might benefit from a SCOTUS reversal, last week Wells mentioned Cat, Nike, Five Below, Best Buy, Gap.
I'd say I would be willing to venture a quarter of the S&P is a huge winner, and I think people don't understand that as much as the tariffs may have brought in or not, there are companies like Restoration Hardware, now RH. There's a double. I mean, I don't even know how you can contain the market that day. Now, of course, Gorsuch is so conservative that he may rely on the Constitution.
Yeah, the Constitution.
Yeah, it's
Isn't
kind
that
of
a
like
novel idea? I know. Wow.
It's kind of like we have Jefferson on the lawn fighting, I don't know, Garfield.
Yeah. Guys,
Underrated president.
Wanted to go to the AI world, a little bit of news. I've been following this previously.
What do you got?
It's XAI, of course, the AI effort of Elon Musk.
You're the only one
with the
close.
big data center in Memphis and the big super cluster that's being an additional one being added there. Our viewers may remember back on September 19th, I reported on what was a $10 billion raise. It's now $15 billion, and it's done for XAI. XAI has raised $15 billion, this according to people who are familiar with the situation. Let's go with that one. But they've communicated this. It's a Series E. It's a Series E. That's a great question, Jim. In terms of the valuation, I'm told it's not clear exactly where it landed. It may be in the range of 250, but let's hold off on that. It will close on the 12th of December. And again, this does go back to my original reporting back on the 19th of September, about 10 billion. It did get upped. It is now 15. It is done. It will close in roughly a month or less than that. And obviously very much needed funds for XAI. We talk so often about OpenAI and how much they need. It's insatiable the amount of capital that's needed here for these companies. And, you know, while Musk is clearly one of the most formidable businessmen on the planet without a doubt, it's still like there's got to be more money behind this and more money behind that, unless and if and when they choose to somehow go public to try to access the public markets as well.
Whoa, look at here.
A lot of that money goes to
A lot of that money will go towards GPUs. Musk, back in May when we last spoke, indicated his expectation of 1 million GPUs being purchased.
They're friendly now.
Yeah.
Government's back, and look at what they're doing to us. I'm right out of support.
Well, by the way, while his comp was obviously voted on overwhelmingly, I'm not sure where the proposal to invest Tesla funds into XAI.
Oh, this is going to be nice.
It was clear. I want to make sure.
I love knife catching.
But to your point, Tesla at some point may become an investor in XAI.
This is definitely my pivot point.
They're two separate companies.
Oh, absolutely, but you do have that brain
What
in
happened?
the car, and then you got the brain in Memphis, and it's really very sophisticated.
Yes.
Texas did it that way. Very, very,
Yeah,
very.
right now there's
Woo!
in Austin. That's
It's
right.
it's
That's
very
again different than XAI.
Anybody know what happened?
I don't conflate them. I don't mean to do that. I'm just saying that they do work. They do work together. But I think what he's doing in XAI is terrific. I do. I think it's great. But that's from Jensen.
A cut or no cut? What the
The
fuck?
question, of course, is how many of these can there be, and can they all succeed?
Yeah, I mean, Cursor alone today.
They have no clue what they're doing.
Change at a valuation of 29.
A lot of companies are doing a lot of things, a lot of capital raising. I don't like that, and they're doing a lot of insider selling, not XAI.
I'm here.
To go back because it's
I'm here.
The decline in Disney. It's down $10. Now, when I read over,
Oh, it's 837.
I wasn't
Shit.
happy with it, but I can't get down $10. I was only unhappy with linear. $10. is
I'm
a
here.
Overreaction to a company that is generating.
I can't believe it's this way. Doesn't make sense.
Gave you bigger dividend. That's just plain violent.
Yeah, well, we built a chart of overall streaming prices among Disney and its competitors, Jim, and I mean, I'm not
Burp
sure
it up,
the
Jim.
drop right now lends itself to the kinds of subscription fee hikes we've seen.
I'm here.
Well, I think that no, it doesn't.
Yeah.
You're right. No, it doesn't. I'm not going to defend it.
Right. Also, I mean, Disney revenue miss is not a headline that plays well broadly.
No,
I'm
but
here.
At the same time, I look at it as a work in progress. It's just that maybe people feel, David, that we're done with the work in progress. We expect it to work. And a lot of
You know,
people-
I know. And listen, let's not forget, it's there is going to be a change in leadership at Disney.
Right.
I can give you my own reporting here.
Burp it up, Jim.
First quarter, that's known.
Right.
It's going to be internal as well. Again, not a surprise, but it will be.
Prepare ye in the name of the Lord.
I don't believe it's yet been decided. The process being led by James Gorman, former CEO, of course, of Morgan Stanley.
Right.
And you know, and then when that
When Jimmy says there's a bubble, there's a bubble.
selected,
Burp it
they're
up,
going to take
Jim.
over the CEO at some point during the course of next year. Bob Iger is going to be there, but you know, and then we'll step down at the end of next year.
Now we joke about linear. It's not a joke. It's a declining business.
It is a joke.
Yes, linear is a decline.
We're definitely at a support level right here. I think I'm going to try it.
Down 12, the numbers of,
So I'm Washboardjim.
down 20 in some areas. I mean, again, it's in decline. The universe is in
It's like
decline.
when I was at radio, and at first I signed a contract, and I said, oh, well, and so many cars, and then the second contract, I was just caring about the solvency of the other side.
Today's the 13th.
I knew my
The
solvency.
680 strike.
Meantime, the fight with Disney YouTube kind of points to Google's strength. The fight of Waymo Tesla kind of points to Google's strength. There's a piece on the tape today that says that Pichai has set Google up for a path to AI dominance.
I'm not going to disagree with that. I think Google.
131.
Conversation with the one I've said this a number of times, and we're having a year ago where we were talking about their monopoly in search being challenged, and now we're talking about them.
Get ready.
The Gemini thing is so seamless. It's so good.
And again, I keep stressing this. Their TPUs, when it comes to inference, gives them an advantage in terms of cost per token per dollar per watt.
Just wait till Siri starts.
Which is what Satya Nadella's got stuck in my head now, because he says it every time.
Well, look, what a great company. And I did sell it because of the Justice Department, because the Justice Department.
680 strike.
I should have realized why not buy the dominant company. But I mistakenly thought that the judge, who was so against and called him a monopolist, in the end said, you know what, I'm glad that Apple's getting the check.
At 1.22.
The remedy was shockingly lenient.
Yes, it was.
I
Then
think
they
many
took
would
the
agree.
taxes.
Yep.
After they took the
And
taxes.
citing the likes of OpenAI.
Where I am Washboardjim, I'm scalping away. I love days like today. Hey, hey, hey!
I'm not kidding. The change in that resembled almost a comedic approach to justice.
Another movie, Godfather. Yes. Marx Brothers. I was just reading about Groucho Marx and Andrew Sorkin's
Oh, fuck
book.
Groucho Marx.
Didn't do well.
No.
No.
I'm Washboardjim with a sneaky snake trading strategy,
Yes. And he would later
where I talk about chart patterns, moving averages,
Yeah.
and being in the now.
He was not advised well, according to
No, that's right.
early in 1929. Great read, by the way. Maybe not as good as How to Make Money in Every Market, but
Thank you.
you're welcome.
Well, if you want to get to the good stuff, just go right to Livermore. Go Confessions of.
Oh, yes, Confessions of a
Stock.
Yes.
Yeah, because as far as I'm concerned, that is the part of the movie that's going to be very exciting.
Got it.
Or the 6-part series, or the 8-part series.
On 1929, you mean? Yeah, of course it's going to be a movie.
Right.
How could it not?
What happens to Chicago?
All right. Interestingly, will that movie stream? Will it be on a linear cable network? I want to get back to that, guys, because I did sit down. I did sit down.
Oh,
yesterday
shut
with
up.
Malone for our annual interview from Liberty's headquarters.
How about talking about stocks in the crash here?
Colorado.
Why is it crashing, you idiots?
We had a wide-ranging conversation, as we often do, and all of it will be available next week. Liberty has its investor meeting next week. But I did want to use small parts of the interview in which we did discuss the future of Warner Brothers Discovery. Malone is no longer even a board member there, but he is an advisor. He is a board member emeritus or chairman emeritus, and he still has great influence and is very much involved in the...
Done with you. Done with you. These guys are never on point.
There's value to be had there, we think.
These guys ain't on point either. Come on, baby. Oh, I don't want to put that up there. So I got five at 122, and I'm going to add more right here, I think. Give it a little bit more time. Straight on knife on SPX. Oaklow at 105 slash ES. Let me see if I hit my support on slash ES. I had it charted up. yeah. $0.98. There's the yin yang. There's a support right here. Where did I see that? Right there, where I saw it. So we have to get above 31. This thing could fall back down to this one right here, 67.95. $96, 97 more or less. I got more to buck. I got 15 on SPY on the buck. Might get out of this thing even if I can. AMD, we got NVIDIA close to 186. Apple, again, bounced up. They really like an Apple here. Tesla's getting at my support. Disney down $10. They were pumping Disney this morning. I'm at 112. I got 107 average. Let's see if we get to the VWAP back to 679.42. That or I sell it. For some reason, this market, I don't know why yet, I haven't found the news. Unless it's the jobs report, no jobs report. U.S. government shutdown calls for money to be paid by people directly to buy health care. Trump administration keeps flight cuts at 6% instead of the Big Short, Michael Berry deregisters his hedge fund. I don't know why they come out with these headlines about the middle class. I mean, we had inflation up 22 to 44% under Biden. They weren't priced out by then. I was yelling about it. It's like a 4 or 5 year delayed reaction. Slips and miss, a Disney miss? The NASDAQ slips on Disney miss? Are you kidding me? Disney's a piece of crap. They tend to lean on AI not being akin to a tulip bubble. What the hell? I'm at 121. Yeah. Woo! So I should sell and get the heck out of Dodge here, and then I'm going to cry about it later. Because this looks like an overreaction, but I'm going to do it. I can't. This thing could drop just like a heartbeat. Do you understand? Out at 122. And we'll see what happens here. Because I think we can get to the VWAP and then pull back. So I end up holding a few. Burp it up, Jim. Just in case I missed the run. Jim, I'm impressed with your trading so far this morning. You're not a coward. And I wanted to tell you something. My grandma called last night and said she was pregnant. I'm glad to have you in the family, Jim. Oh no. Glad, dude. Hello? This is Grandma. I come over, Jimmy. I got something to tell you. I already heard. It's already around town. See, Jimmy got out and held a few. So I'm thinking about selling them. We'll just wait right here to see if we hold the shoulder line. But be careful. Does anybody know why the market's down? Give me an update. sell the news, I think, because government's open. Yeah, I've seen all the employees. They were glad to come back to work. At least some of them were. The ones that had to stay weren't. I'll tell you that. Well, that could be my trade of the day. We have to break the VWAP. Do you understand? The SPY has to break the VWAP to become bullish. And I'm back at 123. I could sell the remainder. What should I do, Jim? Grandma's home. SPY has to break VWAP. Do you understand? YouTube? Do you have it? We're at the VWAP. 137. We're back to 110. Yeah. Burp it up, Jim. Okay, we're coming to a double bottom. Got snake, breakout, pullback, inverse head and shoulders didn't hold. So now that becomes resistance. Do you understand? Nancy, would you make me some coffee, baby? No, I'm retired. I ain't did shit. Nancy. You can't talk to your man like that. $678.51. If we can build a channel in between that, or we come to the double bottom, and then we still got to break the VWAP, and that'll be the third attempt if we come back up. So we could triple top. Google is down. Google AMD's a smart little cookie. I mean, if I'd have been watching that, I probably might have took it. Yeah, I probably would have. Tweezer bottom with three black crows with an almost an inside candle there, our Harmony. I would have probably took that candle for sure. SPY's down to 88. Watch the SPX here. Let's see if we can get a trade out of this. We got snake breakout pullback, higher low. Symmetrical flag. A steeper top than a bottom, which means we could do a double bottom. I need a cup of coffee, something to warm my tonsils up. This is really, that's why I only trade one trade at a time, because I don't want to get stuck when you hear the fat cats hollering bubble, 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 bubble. So if I was me, I'd be looking at the 68.40s for a scalp. And they were just at 380, and I missed that. Fuck. SPY's at 112. Snake breakout pullback. Symmetrical flag. Jim? Hello? Yeah, Jim. Is that a fallen wedge? I think it is. We're about to break resistance. I'm at 116 on my calls. Let's draw it out for you. It sure is. Fallen wedge, breakout. Jimmy said we had to break the shoulder line, and they're now at $5.50. Unbelievable. That's what you are. Unbelievable. From here to far. Snake breakout, pulled back, boom. The calls are now at $1.40 on the SPY. Thank you very much. We broke the VWAP. We broke the VWAP. We broke the VWAP. We broke the VWAP. $156, $158. Question was asked, should I sell? And I think we could go higher. But I think I'll get out of these. I'm dreaming of a white Christmas like the ones I used to know. $1.60. Sheba, would you like to give me a good grade, please? I don't know how he does it, but the guy, his name's Washboardjim, and he takes 158. I'm dreaming of a white Christmas. I'm out at $1.58. Randy, do I got balls or what? All out. I'm all out. Psychopath is all out. Oh yeah, man. Ready, set, go. So ready, set, go. Oh. 179.
A Keystone Cold.
SPY made it to 187. Back to the orb. The 6840s SPX are now at 770. We hit the VWAP. /ES just hit VWAP. I'm going to go into the kitchen and get my water started and take off my shoes and get organized. I didn't know I was this late. I know I had to do some extra stuff today because the IRS people were back. But I didn't think I was this late. Shit. Let's see if there's any cleavage showing today. Cleavage.
Remarks there yesterday, which sort of highlights or at least emphasises the more sort of hawkish voice within the camp. I mean, not a voter, but certainly important and significant as far as this whole debate is concerned. We're going to be hearing from Daly once again, Kashkari, Hamek and Musalam today. What are you going to be looking out for? I mean, what do these people have to say as far as, you know, where they see things right now?
Well, if you think of inflation, actually the more remarkable point that another Fed member made, which is Lisa Cook.
This guy talks funny.
In the speech said if tariff inflation would become more persistent, the Fed would have to act forcefully. And that was a really important hawkish statement to me. It's like, as a Fed watcher, I say, like, that's language that's far on the hawkish side than any other of these Fed members currently are. And Hamek, who actually was reaching out saying that inflation is too long, too far above the target now, and that could potentially become a whole decade of this above target inflation. That's another person to watch, because that's their worry. I think that they're looking at this saying if expectations haven't really moderated enough. We have labor data that isn't indicating a crash of labor.
Hello,
We're having an economy
I'm
that stays on
Washboardjim
track. We're growing
with a
4%.
sneaky snake trading
So they are
strategy
concerned, I think,
where I talk about
inflation.
chart
That's where
patterns,
they're currently
moving averages,
going towards to saying,
and being in the now.
we may be able to cut, but it's not a series of cuts. That's changed.
Yeah, and herein lies the conundrum, because they put so much emphasis on the job side of the dual mandate, but then they haven't really quite stuffed that inflation genie back in the bottle, and I suppose that's what some of these Fed speakers are saying. Ben, always a pleasure. Thank you so much for joining me, and such a great day to have you on as well to sort of unpack some of these stories as well. Ben Emmons there, CIO and founder of Fed Watch Advisors, joining me here around the desk. Coming up, we'll get a closer look at the big picture with the team from Charles Schwab. Morning Trade Live. We'll be right back.
Small amount of cleavage today. That's a good sign.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
How's it going?
Doing good, man.
Sometimes, you know.
Next. Try again.
You could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
Whether you're a bull or bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help.
Me I was regurgitating your Republican talking points, but you're on camera admitting that you turned the National Guard away.
Platform chat. With Schwab.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the
Congresswoman Pelosi, will you support a ban on
Thank you guys, thank you. Thank you. Charity said
Will you
yes.
support it? You will? Any comment on outperforming the Dow by 17,000%? Last time you told me I was regurgitating Republican talking points, but you're on camera admitting that you turned the National Guard away.
Nancy Pelosi, shut up.
We're back on Morning Trade Live. Dollar Tree is lower this morning with Goldman Sachs double downgrading the stock to sell from buy and cutting its price target to $103 from $133. The analysts are saying upside to shares gets harder from here. Goldman citing concerns around lower income consumers and preference for other discounters with better value propositions as the reasons behind that call. So let's look across the discount retail space this morning and see how some of these companies are actually responding to that, because we have got Dollar Tree down 2.5%, but it's a bit of a mixed performance actually. Five Below is down 1.2%, but the others are holding up. And perhaps that speaks to what Goldman has been saying, that maybe there are other better value propositions coming from some of these others. Dollar General up just fractionally. TJX also up 0.4%. Welcome back to Morning Trade Live. It's time now for the big picture, so let's welcome in Joe Mazzola, head trading and derivatives strategist, Charles Schwab. Very good morning to you, Joe. So what do you make of the market action we're seeing today? We continue to see rotation under the surface. So what do you make of it?
Yeah, no, I think you're spot on. It's a mixed market, and it's mixed because
Okay, he's got deer in the headlights.
Are mixed as we've kind of moved out of the
I'll be right
90%
back.
that are already reported. You get the last 10% or so, and then those are tend to be retail, and we're looking at a retail consumer that is having difficulty to a certain extent, especially when you look at kind of that K-shaped economy, right? The 40-day or 42-day shutdown had it played its part in having that effect, and we're starting to see that come through now. Good news is, right, the government shutdown's over. We potentially kicking the can for another 2 months or so before the next funding bill comes up, and as we look at that, this is it's going to have its ramifications, and the ramifications are not only what you're seeing from the clients and kind of the consumers, what they're able to do with retail, but we're also going to get that in data, Sam. So it's going to be interesting these next couple of weeks as we start to talk about mixed and murky. Maybe those are the two words to use, and that's the potential what we could see in some of the data.
What does the positioning sort of tell you right now as far as, some of the steam coming out of some of the mega cap tech stocks into areas like more value, defensive parts of the market, healthcare, financials catching a bit? I mean, obviously we saw the Dow crossing 48,000 for the first time ever, slipping a bit today, but still holding above that level, no doubt. Particularly as we've now seen the fact that we might not be getting as much data as we're anticipating, and sort of the market sort of repricing in what we're likely to get come December.
Yeah, no, that's a really important point, and I think looking at yesterday, I think yesterday was very telling. We saw an expansion in breadth. We saw advances outpace decliners, but yet 5 out of the 7 Magnificent 7 did not participate. Even today, with the S&P down about 35 points or so, you're still seeing advances outpace decliners in a small margin, but that's the case overall. We've seen breadth improve in the Russell, right? So that that has been something that I think is helping with that broadening theme. Is this the potential Trump 2.0 trade that we saw last year, where you did see the broadening within the cyclicals and broadening within the Russell? Time will tell on that one, but it's looking like at least that trade is starting to build a little bit. I think part of it has to do with some of the strength in financials that we've seen recently, as you're starting to see more and more of the steepening of the yield curve. So I think that's kind of led to it. But overall, we have seen that, and which is really interesting, because it was the strength of technology that kind of got us through the earnings season. And if it starts to roll over right now, can the market continue to hold up if we don't see the generals participate? These last 2 days are showing that it can, but that'll be something to watch over the next couple of weeks.
seeing the VIX picking up a bit as we're seeing a little bit of a pullback in equities this morning. I'm just wondering, as far as the technicals, the charts and the trends are telling you, what are you seeing as far as volatility overall?
Yeah, that's another interesting facet is because last week, volatility came on the market, we kind of got past that Friday session and we put in, there was basically a really bullish candle on the S&P 500. When there was rumors that a deal was kind of in the works, or at least something we discussed over the weekend, we saw a nice snapback in the market. What that did is it changed a lot of the positioning that we saw from the institutions. Institutions had really come into the last couple of weeks really being hedged. And there was a bit of a divergence between what we saw on the institutional side, which was a lot of hedging, and then what we saw on the retail side, which was still a lot of this kind of upside call buying. Some of those hedges came off at the beginning of this week, but one thing that it was a bit telling yesterday is you started to see some of those come back on. So some of that front month, at least the 30 days or so, that activity really kind of picked up in some of that vol steepening. You're seeing some of that hedging activity pick up again. Could have something to do with the fact that we've seen the probabilities, as you and your guests were just mentioning, the probabilities of the Fed cut basically recede from a 95% likelihood in December down to about a 50-50 coin toss. So I think the markets are pricing in some uncertainty around that. And I think the other thing to think of, Sam, is this. The good news is that the markets, that the government's open and we're going to start getting the data. The bad news is that we might get the data, right? We might get data that we don't want to see, or we might get data that doesn't give the market what it wants. And we have had some of that private sector data that's kind of shown some weakness in jobs, and some of that private sector data that's shown some of the higher prices paid, especially on the ISM side. And so as things start to open up a little bit more, I wouldn't be surprised to see maybe some volatility come back into the market.
Okay, we'll be watching. Always appreciate it, Joe. Thanks so much for joining us today. Joe Mazzola there, head trading and derivatives strategist at Charles Schwab. Coming up, it's time for Morning Trade, and we'll take a closer look at Cisco shares that are rallying after earnings.
Okay, here we go. IWM double bottom. IWM double bottom. IWM double bottom.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education.
IWM double bottom.
An expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters.
I love you,
as it
Marley.
happens. Streaming 20.
Would you show some cleavage today, please? I think it'll make my day if you did. The SPX, the 6840s at $4. I'm watching them real close right here on a 1, 2, 3 dip. Do you understand? Yep. 1, 2, 3, 1, 2, 3. Well, we can go down a little bit lower. So it might go in one umps, but we could go down a little bit lower. And I'm going to go turn on my fluffer. I really don't want to leave this table right yet, because I think if we go down and we hit this trend line, I can get these at a good discount. Right now they're at $3.90. Prepare ye in the name of the Lord. 6840s, do you understand? Okay. Here we go. This is the SPX calls, Lotto, scalping, strike, 6840s. There it is. Come on. We're almost there. We're almost there. Start a position. $3.60. Starter, or $3.50. Starter position at $3.60. Starter position at $3.60. Good morning, matey. Good morning, Bobby. Starter position at $3.60. I want them, 2 bits and a freebie. Starter position at $3.60. Oh, there it is. We have to hold this. $2.90. Dadgummit. Come on. This is going to be my other one right here. Well, that sucks. Double bottom. $2.50. So I've got 3. Boom, 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 boom. Well, I mean, if I get out of this trade, I'm going to do an Elvis song. I'm even. VICTORY, that is my battle cry. Do 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 do. That is my battle cry. We're at 290L. No do 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 do. We got a double bottom, spelunk. We got a double bottom. Come on now. Ooh, no. Oh no, God. I don't know about this. This don't look too good. I'll give it a few more seconds or I'm just going to get out of the trade because I don't feel like doing this all day long. How does he do it? Can we break the 9, please, and get me to 68, 33, 45? I'm going to go make my mocha.
Journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Welcome back to Morning Trade Live. I'm Sam Barnes, coming to you live from the floor of the New York Stock Exchange. It's time now to take a look at the sectors that are moving markets this morning. And for that, I'm joined by Kevin Hinkser over in Chicago today. So, Kevin, we're losing altitude here. We've seen the S&P 500 duck below 6.8. The Dow is holding on to 48. What are you seeing out there as far as the sectors?
Good morning, Sam. You know, if you look at the 1-minute charts on the S&P 500, looks like about 10:15 Eastern time, they started to sell them, picking up a little momentum in the selling. And what was a mixed market is now, you know, a pretty solid sell-off here. As I look, 8 of the 11 sectors in the S&P are now lower. And as you know, Sam, what we've been reporting on this week is when you lose information technology, when you lose communication services, when you lose consumer discretionary, it tends to skew that way. And that's, I think, what you're seeing today. But this at least for this late morning, it's turning a bit more broad than it was to start the day, Sam.
Yeah, it certainly is. I'm just looking at some of the
Don't call her a broad.
sectors that are managing to hold in. Consumer staples are adjusted to the upside right now, which we obviously typically see outperforming in a sort of weaker type of environment here. But
Break the 9. I'll be right back.
You can talk about some of the rotation we've seen into some of those more sort of value defensive type trades. Kevin. All right. We have lost Kevin Hinks there, just having a bit of technical issues over in Chicago. We'll re-establish with him shortly, but here's a heat map for you. As we mentioned, we just had a bit of a pullback in the last hour or so. We went from a mixed picture to a little bit of altitude here, as I mentioned. The S&P 500 falling through 6,800 now. We're 0.8% lower on the session. The Dow Jones managing to hold on to that 48,000 mark right now, but it has pulled back off the records we saw yesterday, down around 0.5% in the session. Then we've got the NASDAQ, which has been under pressure as some of the air has been coming out of the technology stocks in recent sessions, down 1.2%, and doing an equal amount on the Russell 2000 right
not
now,
good.
Down about 1.2% as well, as we have seen, as I mentioned, a lot more sectors sort of turning into the red over the last course of the last half an hour or so. So we do have that technology down about 1.5%, communication services also lower, consumer discretionary taking a hit to the tune of 1.3%. But as I just mentioned, we do have consumer staples hanging in there. Energy is higher, 0.9% as we continue to monitor those crude prices and the inventory levels as well. We've got healthcare also tracking higher by 1%. This has very much been an outperformer in recent sessions, as we've seen a big rotation out of what has been working in consumer discretionary and technology into sort of more of the biotech names and other healthcare type of companies as well. So as I mentioned, a bit of a mixed picture here, but we are certainly seeing a bit of risk off on the headline. All right, we're not able to get back to Kevin Hinks, but let's move on to some global markets now and check out some of these Chinese ADRs. Tech giants moving higher today, largely. E-commerce heavyweight at JD.com, actually lower right now.
I need to hold here. I'm going to have to get out.
That came after a mixed quarter. The company reporting double-digit revenue.
This will be my first loss in a while.
Expectations, but profits.
Shut up. You're making me nervous. Yeah, this is not looking good. I'm just going to give it a few more minutes here because it's just kind of just inching down. I gotta go get some paper towels today. Oh, God. I'm about to lose $300. Yep. So if I get 6 more, Oh God, you can get my coffee. Forgot about it. Might get 9. I'm one slot where I don't like to be out of the money. Right now I'm making a mocha. On that slash ES, I got 6796.90. Tesla at 406. I mean, I'm real close to my support on Tesla. This is where I really like it too. Can't use this chart. And of course this thing starts to act up. We're definitely at my support level right here. Just right above $400. Well, I don't know. I might just add 9. I have SPY, I have 675.60. There it is on the SPY. Let's see if we get a rebound here. I'm right to my support. /ES hit my number. Let's get a reverse. Come on, baby. Get me out of trouble. $105. I'm taking a huge risk right here. $150 is my average. I got 9 at 105, 2 at 250, and 1 at 360. Let's go. I have confidence. I got 12 contracts. Then today for lunch, I'm going to go get some supplies. Right to my number. I mean, perfect. 150 even. The SPX is above the 21. I'm not saying I'm out of the woods yet, but if we could hold that, that would be nice. Then I should get out even and just say screw it. Because it looks like the bulls are in control. Government reopening in focus as U.S. equity futures turn continuously lower pre-bill. So I think the market, it used to not be like this, but they're so influenced by the government anymore. Ever since that Obama got in there and started printing all that money. Oh, this chair is driving me nuts. I'm trying to think when I got this chair. It had been 8 years ago, 8 or 9. Stop it. Do I have any WD-40? No, I don't. think while I'm out, I might get some WD-40, see if it helps. I hit the Powerball number last night, but not all of them. 23. Ugh. I'll have to get a new chair when I build my cabin up north. Maybe when the rest lasts the rest of my life. That sucks today. We got snake, breakout, pullback, higher, low. Might have to take a loss because I don't want to play this game really and go get my supplies and come back. Now that the IRS is open, I got to spend money. We got a double bottom, higher, low. Not by much. Well, I hate to push the sell ticket. Might have to do it. Once you break his support, you got to hope for a little pullback, or they just keep continuing. We're at that one candle right there, and if it holds below my support line, we got a spinning top on the /ES, so I still have a possibility. Yeah, I think I'm going to make lunch and then go get my supplies if I get out of this trade. I'm back at my last entry at 105. Down 450, well, $400. There we go. Come on. Down 270. I would love to see 679288 before I leave, please. We got a double top to break. Now, the only thing that kept me in the trade was this /ES over here, this spinning top. Because that was green with a tweezer bottom, and that's the only candle. And that one's close to my trend line. You got to believe in your trend lines. Down 180. The only thing kept me in the trade was this green, so far, this green candle. And we're squeezing between the 9 and the 21 on the SPX. And we're above the 9 on the /ES, where we were. Bears are definitely in control. I'm going to go make my lunch real fast.
And the markets are doing so well.
So they seem to be spending, but I believe this is coming from the top 30 to 40% who are the asset holders. Normally those two, consumer sentiment and stock market are highly correlated. Now they've gone away from each other and people are saying, oh look, consumer sentiment is down despite the fact that the stocks are high. I actually think it's another even step further. I think consumer sentiment is down because stock market keeps going through the roof and people are getting more and more disappointed by the fact that the asset holders are making money and all the lower 60% have is higher grocery bills. So I think
that's not our fault.
And it also reflects on Jerome Powell because he's looking at two buyers.
This guy's an idiot.
Top 30% still.
There's so much jealousy and class warfare in this country anymore. You know, I like the rich. I'm not conceited where I don't associate with the poor. But I am a little snob when it comes to white trash that don't want to get up and work.
Technicals, and Dan Deming will take us through the trades for Thermo Fisher Scientific, Danaher, and Valero Energy. That's next on Trading 360 on Schwab Network.
I was talking to a guy today, the head honcho at their IRS. About what am I going to do when I retire? Because I like coming to work. I like doing something, you know, getting out. And a lot of people that I know that are my age that don't get up and work and get out, they're all unhealthy and just unhealthy. I mean, I got some of my best friends right now that are in a care center because they've lost their equilibrium. My best friend's in a wheelchair.
From the most iconic trading floor in the world, this This is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute by minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the
I don't know what to think about this.
Counts.
It's kind of just taking a sweet time like the other day.
I love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
I'm not giving up yet.
I can invest and trade on my own.
As long as I stay above that support line.
For me too.
Let's move on, shall we?
No can do.
I've only got one candle that's below my...
Where are you going?
Schwab.
It's that green spinning top. So I'm still bullish.
A modern approach to wealth management.
The tweezer bottom on the
Welcome back
SPX.
to Trading 360. I'm Marley Caden. It's time for the big three. We've got 3 stocks, 3 charts, and 3 trades. Rick Ducat, our lead market technician, here to take us through the charts. And here to take us through the trades today is Dan Deming, the managing partner at KKM Financial. Great to have you both with us as always. Dan, love to get your thoughts on this market action we're seeing so far this week, particularly today, with a pretty negative response despite the fact that we got this government shutdown end.
Exactly, yeah. It's buy the rumor, sell the news type of scenario today as we do see the government reopening, and yet the market is coming under some pretty significant selling pressure. You know, it's interesting that this rotation is something that we keep a very close eye on, and that's what we continue to see unfold. And again, that's really why I chose these 3 stocks today. These are kind of the ports during a storm type of scenario when I look at these trade examples today. And, you know, I think that rotation is something that's going to continue as we see some of these high flyers coming off their perch as we move out of 2025 into 2026. Yet you still see certain parts of the market, particularly healthcare, industrial names, finding some renewed strength and maintaining upward momentum, in some cases going to near all-time highs. So again, the diversion here as far as just some of the aspects in the market coming out of the government shutdown, also anticipation for what the Fed might be doing in December, and you're seeing again valuations now are starting to be called into question as this AI trade continues to evolve, and now the questions are, is the money actually there?
All right, and I noticed that you don't have any AI names in your big
We
3
do not.
today. So let's talk about your first one. I know they're in healthcare, but I'm not as familiar with this company. Thermo Fisher Scientific. Walk us through this pick, Dan.
Yeah, a diagnostic research company, and kind of, again, a name that doesn't get the attention it probably deserves, but when you look at the price action here, as healthcare continues to show strength here as we close out the year, this is one that's come off its lows and continue to maintain upward momentum. So again, I'm looking at this stock to continue to maintain its upward price action, and today's trade example is buying the stock and then writing a call in January above the stock to have the opportunity, if we do see a nice run into early January, to have the option to maybe get taken out of position and capture upside.
All right, so Rick, as we look at the technicals, I'm looking at the chart here, up 38% in the last 6 months. What are the technicals showing us here on the chart?
Kind of refreshing to be talking about companies that are a little more concrete than some of these more nebulous AI type names here. But when we do look at this one, it's been a sharp rally to the upside. We can see that we had several phases in this chart once we had this earnings event here that propelled price upward here. After the initial surge, oftentimes you see there will be pullbacks to sources of prior support. In this case, they were getting increasingly small on the climb up here. So these types of bull flag, bull pennant price behavior are things many traders look for, but now we've seen a push to the upside. We are pushing beyond the boundaries of our rising wedge type shape here. The bulls likely would have their sights set all the way back here near 607, our best close on this chart, not the intraday highs of 610.97, but our best close was 606.74. So one mark to consider to the upside there. If we were to look at our moving averages here, our 21-day exponential moving average lines up with this volume node that you'll see in a minute here around 564. You can see as well our 63-day lines up with the second volume node near about 526 or so. RSI, and continuing to move higher, we can see it is in the overbought area, not quite making a new relative high just yet. That would be a crucial thing to be on the lookout for as we head into the close. close. Now that we do overlay our volume profile study, you can see that we have these important areas of potential congestion where there was heavy volume activity. Those come in right around 525 and 565 or so respectively. Our plus 2 standard deviation channel could be supportive as well, near about 587.
All right, and right now we're trading at 593 for right now. So as we take a look at your trade, what level specifically are you focusing on?
Well, Rick pointed it out. Honestly, the highs that we did see early in the year around that 607 level, so that's why I'm looking at buy writing this name in the trade example. So buying the stock and selling a 610 call. You can do that, I believe, here around 1550 in the stock, and gives you the ability to capture further upside, lowers the break even if we do see a little weakness, but overall a nice capture zone to the upside if the stock is able to maintain the momentum and challenge those highs as we roll into January around that 607 to 610 level.
All right, your next one, also a diagnostics company here. We're talking about Danaher. They're making a move to the upside today, up 2.75% right now.
Yeah.
Walk us through this pick.
Yeah, bucking the trend. I mean, again, most of these names today are continuing to show strength into weakness, and that's another factor contributing to why I chose these names today to highlight. And similar, healthcare, a name that got dragged down with all the healthcare stocks in the middle of summer, probably unduly so based on the price action since we've come out of that. And again, maintaining upward momentum. So
about to give up.
There's a possibility here to capture further upside as we continue to see it.
I was even there for a second. Actually up.
Here in this pattern. And again, this one trade example.
Come on, baby.
Defined risk. So it's all spread to capture upside, but also have.
We got a falling wedge.
If we do see the market continue to show weakness and some of these names falter because of the overall weight of the selling pressure that could potentially set up for further downside.
All right, well.
Shut up. We got a fallen wedge. A 1, 2, 3 and a 1, 2, 3. So we'll see here any second. We're going to break out. Want 'em? 2 bits freebie. Want 'em? 2 bits freebie. Today I'm eating 2 sliders and cottage cheese and potato salad. Then I'm going to go buy a case of toilet paper and a roll of towels. Come on, break out. I mean, this is really pushing my luck here. I'm not below my trend line yet. Five, 10, 15, 20, 25, 30 minutes of this wait. I'm at 130. Come on, baby. I'm back to almost even. I should have loaded up another $1,000 worth. That'd be green. We broke out. Come on, baby. I'm not going to count that wick. I'm going to count this one as the 3. Getting tighter and tighter. I don't want to sell it yet. I really don't. If I break out of my trend on this wedge, I will, but it'll be a bigger loss than what I want. I'm only down $15, $10 contract right now. This one will mean squeeze is when the lower highs and lower lows. Where's my frickin' mouth? Right here. Then you know you're about ready to squeeze. But you don't know if it's going to be, like today's not a very good day, so. Unless I see a big old fat candle. Like we're done with it. You know, somebody comes in and just buys it at the ask. Go! I guess I could be scalping every time it comes down to $1.05, $1.10. I'm a little bit too far out of the money, so I need to do something soon. Yeah, I'm a little too far out of the money, so I got to do something soon here. And, or at least get another call a little bit higher. So now I'm coming up to another moving average in 63. Now I'm even. It could stop right here. This is the kind of trades I don't like being in, because now I hit a resistance level. Is that the 200? I think it is. No, it's 63. There's some good chart readers. I bet you M&M's use the 1 minute or a ticker, the tick. Yeah, fuck, right at the double top. I didn't even think about that. That's the tick time frame right there. 100 ticks. Yeah, if I'd seen that double top, I would have definitely sold it. Yeah, that was, but that's on the tick. And it's on the 1 minute too. Regetta's at 25. Disney down 9%. Market's not in a good mood. AMD's falling apart. Marley.
Through why you're bullish on FedEx.
Yeah, so FedEx has had a really nice breakout here. It's been kind of range bound between, call it 220 and 250 for more than 6-7 months now. And we finally got that breakout here back in late October. And we've seen some really nice follow through since that breakout, not only on an absolute basis, but on a relative basis. So it's outperforming the S&P 500. They recently just reported fantastic earnings. And it really shows that the multi-year transformation that FedEx has been working on is starting to take hold, and investors are starting to pay attention. You know, I think the upside potential here in the short run is going to be at least into that $300 level here to the upside, which is the prior highs we had about a year ago at the end of last year. I think that would be my upside target here. And then on top of that, if you look at FedEx, it's trading at only around 14 and a half times forward earnings, which is about a 25% discount to its peers. But if you look at growth expectations, you look at profitability, FedEx is basically just in line with the rest of the industry. So the fact that it trades at a 25% discount, even though it's growing just as fast and just as profitable as the rest of the industry, that's really where I see some upside opportunity. And then you add on top of the fact that FedEx is really starting to show some margin expansion through their efficiencies that they've been trying to work through with, for example, they're combining the logistics between ground and freight and ground and air. By combining those logistics hubs, they've been showing efficiencies, and they're expecting, you know, as they reported, more than $2 billion in efficiencies on the expense side as a result of that, and they were actually able to guide that in the last earnings. And I think that's really part of why the stock is performing so well in the last month or so, and I think that that's likely going to continue. They also have provided some guidance in terms of expectations for holiday shipments.
That is correct, Randy.
They have been strong, and I think investors are liking this, especially at such compelling valuations.
And Tony, before we get to the trade, why do you think FedEx is trading at such a discount compared to its peers when its growth metrics aren't far off?
Yeah, so I think, you know, there was definitely a lot of concerns earlier this year, especially with, earlier in the year, there was concerns as to whether or not consumer spending was slowing down. You also have everything with the tariffs and concerns that was going to affect shipping, especially overseas shipping, which is a lot of FedEx's business. You know, the ground business is not particularly a profitable business. The overnight express is really kind of where a lot of the revenue is. And then also just concerns around consumer spending.
I'd wait till I broke his trend line.
Second half of this year, and a lot of
6.7, 6.8,
concerned that FedEx was going to
94,
see some material slowdown in
96,
business. But so far,
6.9 more or less, 6.7, 6.9
has held up a lot stronger than I think a lot of investors were expecting earlier this year, and I think that's starting to show investors are getting a lot more confident.
I gotta go do my thing here real soon.
FedEx and their abilities to execute on their turnaround as well.
And so what would a trade look like if you were trying to trade FedEx?
See if my boys are down there
I
painting.
think if I look at the option skew, it actually still favors selling option strategies such as a put
So
spread.
I might leave.
The stock has run quite a bit. You know, it was a $225 stock back in late October. It's now a nearly $270 stock. So the stock is in the short term slightly overbought. So I
should have got out.
I don't know that I want to chase this by continuing to buy upside using call options. I think my preference
knew I was
is to
getting
be
thin.
a seller of premium here, looking at selling put
You know,
options, but doing so in a way with defined risk. So I want to go out to the
I got
December
two issues.
26 weekly
Two issues why I should have got out, because it's taking too long, and that too long, you know, at a certain point it's okay. It tried, and we squeezed out of the sweet spot, and we hit the 63. So that's 3 reasons why I should have probably got out of the trade.
You're not pressed against for time like you are if you were to outright buy a call option or a call spread.
Well, Tony, great to have you with us as always. Thanks for those picks today. That's Tony Zhang from Options Play. And coming up next, we've got our 360 round. We'll take a look at Disney as shares are under pressure this morning after earnings. We'll dive into the report next on Trading 360.
So I think I'm going to get ready to go. Get my chores done.
the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization. And track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Alex Coffey. And I'm Jenny Horn. This is Next Gen.
Watch, I still might win this trade. I'm not done with it yet.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now. Clear analysis and forward-looking market coverage.
I think I'll have a little sip of coffee before I leave, and then I'll do it. Just hold it out a little longer.
Next Gen Investing, 1 p.m. Eastern. Only on Schwab Network.
Welcome back to Trading 360. I'm Marley Caden. It's time now for the 360 round. Let's bring in our panel to discuss earnings from Disney. Joining us now, James Tranowski, head of emerging tech at Consumer Choice Center, and Matt Dolgen, the senior equity analyst at Morningstar. James, love to just start with your thoughts on this report.
Yeah, thank you for having me. I think that it's a mixed bag for Disney because on one end, I think that we've seen some really promising stuff. Their model of direct-to-consumer of growing their subscriber rate with services like Disney Plus and Hulu has grown tremendously. We've seen that revenue, their profit rather, go from 99 million to over 350 million. That's really good. But on the downside, we've seen this prolonged bout that they've had with YouTube over YouTube TV and ESPN. And that, on the flip side, is not so good for the company. They don't know when it's going to end. And every single week that prolongs, the company is losing $30 million. This isn't exactly the same kind of battle that we've seen in years past between Disney and DirecTV. This is between Disney now and YouTube is in a much stronger position because it has a lot more nimbleness. It has ad tech revenue on its side, whereas Disney's a little bit more traditional in its structure, leading it to be a little top heavy. So I think when you look at those two factors, while there's a lot of promising things in this earnings report for Disney, we do need to see a little bit of a conclusion here to this battle with YouTube TV.
And Matt, what were some of your key takeaways from the report?
Yeah, I guess I'm a little bit more positive than James. I agree with much of what he said, but I'm focusing more on the parts of the business the parts of the business that really were good and are the most important things about driving this company into the future, and that is the direct-to-consumer, the streaming business, also experiences, which is really the most crucial thing for this company as far as its profits. But between that and streaming, those are both good, and that's what's going to drive the company for the future. I agree that the YouTube issue is problematic while it's going on, but we don't expect that to be going on indefinitely. And even if it were, as long as ESPN can essentially stay stable, and we expect the pay TV bundle to continue declining, and Disney is doing working towards transitioning to streaming with the ESPN app for streaming. And so it's not a concern that we think is going to drag down the company in the long term one way or another. And the parts of the business that need to be performing well are performing well. So our view on the company, the outlook, hasn't really changed after today.
All right, and James, you both mentioned the direct-to-consumer strategy, which is obviously very successful. I think they saw Hulu and Disney Plus tripled their profits in this quarter. Is that finally proof that the streaming model can stand on its own for Disney?
Absolutely. I mean, I think that Disney has solidified its status as one of the major players in the streaming industry, more broadly speaking. It stands right up there along with Netflix. And that's because Disney has a suite of products that's very attractive to consumers all across the world, let alone in the United States. So I think that there are definitely very positive signs of Disney's growth in this space. Having Hulu and Disney Plus both there are certainly a huge boom to its bottom line.
And Matt, you said the same thing, but you said that you were even more optimistic about the report than James is. Then why do you think that we're seeing this significant downturn in the markets? We were down almost 9%.
Yeah, well, certainly the overall market isn't helping, but Disney was going down even before that. Overall revenue did look weak, but we think it's a mistake to just focus on that overall number without digging in. Entertainment linear networks were extremely weak, and they are just going to perpetually decline. To us, that's not something, first of all, it's built into what drives the value of this company in the long term, and second of all, not something even in the nearer term that's nearly as important. streaming, DTC, the entertainment side, the operating income this quarter was about the same as entertainment linear networks were. In 2026, streaming will probably be much higher. So this part of the business that was so important to Disney in the past has become less and less important. And again, like James said, the direct-to-consumer strategy appears to be working. Disney appears to be setting itself up very well for the eventual, pretty much complete cannibalization of entertainment linear revenue. And so with the forward-looking thought and what's going to drive the company in the future, it seems like things are fine as far as why the market doesn't look at that. Again, to us, it's a mistake in maybe focusing on too high of a level rather than what's really underneath this and the profitability associated with it for the company in total.
Yeah, and in the pull down, I keep seeing this mention of this YouTube standoff. You know, as we look at this, James, who's got the leverage here? Is it Disney because of their content catalog, or is it Google?
Yeah, I think that they both have a lot more shared leverage in this situation. I just think that it's Disney taking a classic approach. Like I said in the outset here, right? They've had this kind of bout in the past with DirecTV, and I think when you're looking at that kind of an example, you know, Disney had the upper hand and leverage here. But when you're looking at YouTube, it's a completely different beast because they have that ad tech revenue, because there's also a whole host of different kinds of content options that consumers can basically go to. It's not just reliant on Disney TV. Certainly in YouTube TV, there's a lot of options that are there. So I think that it's just a little bit more balanced than what Disney's accustomed to. So it needs to adjust its strategy when trying to think through how do we bring this conflict to an end.
Yeah, it's certainly interesting. I want to really quickly, Matt, get to our last question about the parks experiences. You know, they're still having a bright spot for Disney. And I know that you said in your notes you've been waiting for that segment to show some weakness, and it just isn't. How do you explain that resilience?
Yeah, how do you explain
Well,
it?
it seems like part of what we built in as far as weakness, as far as macroeconomic weakness, hasn't really showed up yet. It seems like the company isn't expecting it in 2026. So it's still built into our model. Some, we'll see if it gets extended, which is what we did before in our modeling. But we think that some.
Well, Ready, Set, Go says we can drop a lot. 6,700.
Could be in a nearer
Another
term,
$60
at some point hitting the company, but long-term things still look
Not
very
today,
healthy.
but it can
And
happen.
Like I said, to us, weakness is there. If it doesn't show up, that's just upside. If it does show up, it might be another thing that hits the stock a little bit, but presents to us even more of a buying opportunity because that business really does look strong and healthy for the long term.
Well, I want to thank you both for being with us today to discuss Disney's earnings. We really appreciate it. That's James Chernowski and Matt Dolgan.
Well, I'm just way too far out of the money now.
On Trading 360 as well. I'm Marley Caden. You can download the free Schwab
Marley.
Network app available in the Apple App Store and tune in 24/7 on SchwabNetwork.com. I'll be back with Market on Close.
So I think I about lost
3
it.
p.m. Eastern, 2 Central, but stay with us. Fast Market with
I'm gonna drink my coffee, and if I ain't bounced by then, I'm gonna sell it.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Boom, boom.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
I'm Sam Barnes, live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
We're back at the 63 again. So if we break it, we could have the possibility of doing a triple top.
Welcome to Fast Market here on Schwab Network. I'm Diane King Hall. Coming up on noon Eastern here at the New York Stock Exchange, investors are taking a step back and regrouping today after the Dow hit another record yesterday. Let me give you a check of your scorecards. The S&P 500 is under some pressure. It is down by more than 1% right now, being dragged down by information technology, consumer discretionary, communication services, the biggest laggards. On the gain side, you still have healthcare gaining some ground following some of the momentum we saw there yesterday. The Dow is lower today by 0.8%. NASDAQ 100 down by more than 1.5%. Russell 2000 off by roughly 1.75%. Here's the roadmap for today's show. Look at example option strategies for Applied Materials. AMAT has earnings due after the close today. Plus, the team from Lightfolio will be along with new sentiment data on Meta Platforms. And Nike is on our radar after an upgrade is getting some love from the sell side. Now that we've got the roadmap for today's trading action, it's time to bring in my co-hosts and trading veterans. Tom White in our Chicago studio and Kevin Hinks joining us live from the CBOE. As you know, we've got you covered from exchange to exchange and beyond. All right, so today would have been a day we got CPI, we should get jobless claims, not yet though. The shutdown is done, but we may never get a full picture based on the comments from the White House. The press secretary, I know you all have been across this saying the October data may never be released. Tom, what's your take?
Yeah, it's not surprising that maybe that relief sell-off that we're getting here today after the Dow hit those record highs yesterday. But at the same time, you're starting to see some volatility come out, not only in the equity market, but in the treasury market. Dollars weakening here today. So maybe just a little bit of a pullback after the deal was signed by President Trump last night after the House signed their portion of it. But if you take a look at the overall equity market in general, we're still only a couple percent off those all-time highs. You're starting to see some commentary come out of the White House. Kevin Hassett stated that maybe 1.5% off of GDP. It cost 60,000 jobs to shut down. So you're starting to see some more of the metrics that are going to come out and what was caused by the shutdown, how that's going to impact this quarter. We were on pace for nearly 4% gains in GDP. If that pulls back 1.5%, that's going to be damaging a little bit. But I think if you take a look at it in a macro take, we're still only a couple percent from those all-time highs. Dow less than that. Only 3 of the 11 SP 500 sectors are positive today. And you don't want to get led by energy and consumer staples when you look at metrics like that.
Nope.
That's a good point. That's a good point.
That's a real good point.
Because I know he was had some commentary about the data as well in this interview with Fox. He said the household survey, as a quote, wasn't conducted in October, so we are going to get half the employment report. So you'll get some of it, the jobs part, but we won't get the unemployment rate. Kev, I'm curious to know your take because, again, both of you all have the veteran trader perspective. I guess the view might be, and you tell me if I'm wrong, you go on what you do know. What's your take when you think about all this?
Yeah, exactly right. There has been ways to get data on the market, right? We were reporting yesterday on the Bank of America data. There has been some data. It's just not as extensive. ADP's been doing a good job of putting out more private payroll data. And unfortunately, you make the decisions on what you have. We're in the middle of earnings season. during the 43-day shutoff, we had a lot of large cap tech earnings. So we saw that. We've got NVIDIA's earnings coming up in 6 days. So we'll get a bunch of information there. Jensen Huang's
I'm at
on
105.
today saying the AI trade right now is not a bubble. So, you know,
it's not a bubble.
Road on the way to all-time highs, and people get jittery, and we can sell the stronger hands. And
it's not a bubble.
A bit of volatility, but early this morning, I made a little a presentation of for the week. You know, the 10-year yield started the week at 4.16. It's now 4.1. 10 yields lower. Crude
it's not.
Was $60, went up to $61.28. Now below 59. Lower. Dollar lower. VIX was 17.7 to start the day. It's now back up, but it was 22.70 earlier this week. So VIX is moderating. And then gold is the one thing of all these macro metrics that I looked at that was higher, and gold continues to be. Actually, gold has gone from up to now down on the day. So I think there's a lot of positives with this market going into the end of the year. It may not look like it today.
We finally broke to 63.
Jittery. The overall message about the AI and the bubble word and valuations and all these things. Meanwhile, all the CEOs are coming out. Jensen Huang asking for more production from ASML, coming out today saying it's not a bubble. The demand they're seeing. I think NVIDIA's earnings next week, Diane, on the 19th are going to be enormous for this market going into the end of the year.
You do.
All right, let's talk about some of the positive momentum we're seeing. Cisco, I mean, those shares powering higher, up more than 4.5% right now for those better than expected results.
Oh, really? I thought I just saw it down.
Seems to like the outlook. Tom, what's your take?
Yeah, pretty good overall report.
Tesla hit 400.
On the top and bottom lines where they beat. EPS was about 8% above
I feel coffee on my keyboard?
Or 10%. And then you look on the other side, the revenue side, that grew 8% from year over year.
Let's go, baby.
AI network infrastructure orders exceeding 1.3 billion. That's up 62%
How does he do it?
from the previous quarter of 800 million. I mean, that's pretty good growth rate there. Non-AI data centers being built, cloud computing companies, demand for Ethernet
it is up.
networking upgrades. Overall product orders rose 13%, improving from 7% growth last quarter. That's a positive. So if you take a look at that and throw on top of the guidance raise that they had, they increased their potential buyback to $7 billion. I mean, it kind of all adds up to, hey, we're at 25-year highs, but maybe we should be. Because the bar was high going into this report, but they hit all those metrics, exceeded them, and raised guidance moving forward.
Oracle went below my low support of 222.40.
Cisco, it has already been an outperformer compared to the S&P 500, and now continuing to gain some momentum.
Do you know there was a time 25 or so years ago that Cisco was the most highly valued company in the market?
Intel was.
It took 25 years to get back to those all-time highs where it was. It's not there yet, and it hasn't surpassed it, but it's awfully close to it. But Cisco reinventing itself now with AI and moving into the future. But these were good numbers. Stock up, 4 and some percent. All things good. Tom gave you all the numbers. Pretty solid earnings event from a company that we already thought had run a long way. So, sometimes when the bar is high, you do well enough to hold. That's what I think you're seeing in Cisco.
Okay, the flip side, you've got the magic at the Mouse House flickering. After this mixed quarter for Disney, revenue came in below $22.5 billion. You know that was weaker than expected. Shares off more than 9% right now. Tom, what's your take when you look across Disney?
Yeah, mixed report here. Sales flat year over year, and the gains that they had in direct-to-consumer, some of the streaming segments, those did well, kind of offset by legacy TV losses. Sports still doing well. Cruise bookings at record levels. So there's a lot to like in this report. But at the same time, yesterday we talked about this, the different ways that they generate revenue, whether it's parks, experiences, streaming. You've got the cruise lines. every time they come out with an earnings report, it seems like one or two of those segments do really well, and it's always dragged down by another. So that's been a thorn in the side of Disney for years. You're seeing the reflected in the pullback here today. But if you start taking a look at they raised their dividend moving forward. They gave pretty good guidance and outlook for growth. So it seems like the company is pretty comfortable with the consumer rebounding into 2026 and into 2027. So that's a positive there. Their sports side of their business, ESPN Plus app rolling out, did really well initially, and that should continue because that seems to be where all the money's going at this point. But overall, a decent report, but you've got to be perfect on every metric for this market to kind of reward you, and it's not doing that for Disney today.
Nope.
Yeah, it does not look like the Wall Street likes decent today, and investors, it feels like their patience is certainly not long with this one. For Disney, Kev, what's your take?
I know the price action doesn't look great, but this was actually a much better earnings report than the price action is showing. And the guidance going forward, double-digit earnings per share growth for 26 and 27. Remember, we talked about on yesterday's show how this quarter was going to be a little heavy because they don't have a lot of, or this past quarter, because they didn't have a lot of movie releases. They have a bunch coming up this quarter ahead of Christmas. So I think that this is a stock that is something everyone should look at because a lot of segments, cruises, ESPN, direct-to-consumer, all doing really well. But when you get big companies like this, they didn't like that revenue miss, Diane. But I think this story, and this is a pretty big sell-off in Disney as we're witnessing. Boy, it seems like a little overcooked on
No, it ain't.
just to my naked eye, based on the earnings.
Still overbought.
So yeah, I mean, I heard that view from other analysts that I've talked to and heard speak on this today, that it feels like a knee-jerk overreaction today for Disney. We'll see how it shakes out.
I want to explain something.
I mean, there's only one day left this week.
This is one of the worst companies out there right now.
But let's talk NVIDIA. So there's some analyst activity around NVIDIA today. It's got
the only thing good for it going forward is the cruise ship.
To 265. Susquehanna
everything else
its price target. It's not helping the stock.
is no good.
Time, you also have some headlines
from Disney Plus
from the Wall Street
to Disneyland.
The chips piece. So it looks
because
like
Mickey Mouse is a tranny.
Despite U.S. restrictions.
And when I was young, I was told that he was a man.
When it comes to China, and maybe
but he was actually a woman
circumventing through other countries and,
dressed in a tranny outfit.
To me, how challenging it is for Washington to fully enforce these AI.
So I'm glad I never really got into Mickey.
None of this seems to be
because I would probably be a homosexual or a tranny right now if I did.
When you look across NVIDIA.
Well, it's kind of reflective that NVIDIA.
The only reason they keep pumping Disney is because of Bob Iger.
Today, but it's down about 12.5%.
Disney is too far woke.
Going into earnings next week. That may be a catalyst.
It's just gone too far.
That one of the stories out of the Wall Street Journals, 2,300 of their chips are getting used in China.
And this is overbought at $100.
Used in China than 2,300 because there are.
So my price target, if I wanted to get into this trade, would be right around 95.
I'm sure a bunch of chips got into the Chinese.
But the fat cats, they don't care about the fundamentals.
Price target hikes.
All they care about is Bob Iger.
Are going to be the last ones that we see going into earnings next week. Oppenheimer raises theirs to 265. Susquehanna also raising. So that momentum's probably going to be.
And
there.
Mickey Mouse is a tranny.
That we've seen so far, they've outstripped expectations by over 5% so far this quarter, and a lot of those tech companies have done really well. And
I don't think I'll get in trouble, but I'm going to put it on
the top
X.
Of the picks and shovels in AI infrastructure build-out, that's NVIDIA. So I think that's what you have to focus on. We'll probably see some more analyst price target moves in the next few days. I'm guessing a lot of those won't be price target cuts. They're going to be price target hikes, and you're seeing a couple of those today.
Yeah, okay, that's a good point. That where we're going by the middle of the next week, we'll certainly probably see more analyst activity around it. Kevin, you brought up this point earlier about what the languages and rhetoric is around NVIDIA, and it's not just coming from Jensen Huang about what the demand picture looks like. You have analysts pointing out it seems like there is insatiable demand, but the way the street is reacting today is not such that, and it's almost like, for instance, AMD's been having its moment this week, and it seems like all the shine's been taking off of NVIDIA. What's your thought?
I feel like I've seen this story before, Diane. AMD comes out with
So I can't put tranny on here, so I'm going to take it out.
And soon after that, NVIDIA comes out with news that just increases the lead by NVIDIA. And if you're a technical analyst, I'm not. It is.
So how can I say it where it's not bad?
It was 185.35, so it got close to that 50-day moving average and is kind of firmed up here a little bit. So that's worth watching. Next week is an enormous.
They told me that it's only visible to few people.
The stock was $212. It just went right to the 50-day moving
Mickey
average.
Mouse is not a man.
Next week could be real interesting for NVIDIA.
Next week, potentially very interesting. And, you know, there are certainly some concerns where even if NVIDIA beats and raises, the shares sell off.
Mickey Mouse is not a man.
So the bar might be high heading into that one. All right, guys, let's put a pin in that. We've got bull versus bear coming up. The guys will get their sample trades put together for
First, it wanted me to verify that I was human.
after the bell today. We'll get you set up for that one.
No, I'm a transsexual. So let me see. Mickey Mouse is not a real. Mickey Mouse is. I can't use the word tranny. You got to think of a word that's acceptable. So, word to use. I got to outsmart AI. It's transgender. Okay, let's see if that works. Instead of using tranny, use transgender person. This could get me booted.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest.
I'm at 95 cents.
Or watch on demand.
Mickey Mouse
Head
is a
over to
transgender person.
schwab.com/coaching and start learning today.
Mickey Mouse is a transgender person. Ah, I didn't get reprimanded.
You could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I deleted my tranny. So don't use the word tranny on X.
Set to report earnings after the close of trading today. The street is expecting AMAT to post earnings of $2.11 per share on revenue of $6.7 billion. Now that would be down almost 14% year over year. Investors will be watching out for the latest on AI demand and how export restrictions on China impact applied materials. All right, let's throw on the trading glasses. Welcome back in our co-hosts Tom White and Kevin Hinks. It is bull versus bear time. Before we get to your example trades, we've got to talk about your views on Applied Materials as you head into its results. Kevin, we'll start with you.
A company a machine that physically builds chips. That's what Applied
Mickey
Materials
Mouse
is in a nutshell.
is a confused disgrace.
They are a key player in semiconductors, and so their earnings will be a representative. But some analysts think they're entering kind of a mid-cycle range where if their growth begins to decelerate, that could be problematic for them. That's why the stock has come off its recent highs, about $19. But boy, this is a company that is waist deep in semiconductor production, and like I said, they create the machines that actually make the chips. So if there's chip demand, there's demand for Applied Materials products, Diane.
And it's a big part of the puzzle of that space. So Tom, when you think about it, what's your take? I mean, this stock has certainly had a strong run year to date, clearly about the AI trade.
Yeah, and a lot of its competitors have also. That's Lam Research, ASML, KLAC, Tencor. Those are their big competitors, and they've had pretty good earnings results. And we mentioned NVIDIA being the picks and shovels within AI. Well, this is really the picks and shovels because they're making all the machines and systems that create these chips and the AI infrastructure build out. You look at some of their customers. I mean, it's Broadcom, it's NVIDIA, Intel, AMD, Micron, Texas Instruments. All the chip makers use Applied Materials systems. So that right there gives them the coverage in this space. And you've heard it from other companies. They're continuing to grow their business. They've grown from about 17% market share in the semiconductor equipment up to above 20%. And then I mentioned Lam Research just had really good earnings. KLAC did also, and ASML, all those stocks rose. They did do some cost cutting though. They laid off about 4% of their full-time employees, about 1,400 people recently also. And then you start looking at some of the segments within the chip making process, whether it's NAND, the memory chips, those have all been doing really well. You look at Seagate, Western Digital, Micron, those are all customers of Applied Material. The bar's high going into this one, Diane, but maybe it should be.
The bar's high, and that's a good point. Maybe it should be. I mean, I have one analyst raising their price target going into it. Evercore ISI raised it to 290. They've got an outperform rating, raising it the day they've got earnings. All right, Kev, let's get into it with your trade example first.
Tom mentioned the competition, Diane, that's involved with AMAT right now. And what does that do? That could compress margins. And that's where it might come down off its recent highs or not make it to new highs. I took the bearish stance today. I looked at just
against our principles to be posting things like that.
I looked at the expected move, Diane, where it sits right now, about $11.70. So I went in, sold the 235.40 call vertical, Diane. Just a high probability, about 75%. If I remember correctly, what it was, 235, about a 77% chance now of finishing out of the money. I put it in for about $1 credit. It's trading about 95-cent credit now. So this is one that just puts it just inside a new all-time high for AMAT, selling the 235.40 call spread. And by the way, it's got to get there by tomorrow, Diane, or this goes to zero.
Go ahead and take over here. Short, neutral to bearish call vertical here from Kevin as an example trade here using the November 14th weekly option. So as Kevin mentioned, just over 24 hours until expiration. Really short-term positioning, an earnings type example here. Selling the 235 call out of the money to the upside, buying the 240 call, short $5 wide. You're going to collect roughly. We've got $1 credit, as Kevin mentioned. It's down a little bit from there because the stock has moved lower. But the credit you collect is what you can make on it. So if you collect $1, you can make $100 with $400 in risk. But it takes your break even all the way up to 236 to the upside. That's just outside of that 1 standard deviation move that the option market's pricing in at this point of about $11.70. And the probability of that short 235 strike finishing out of the money at expiration is 71.5%. So that's why it's skewed a little bit towards more risk than potential reward, because you're giving yourself a 71% chance that the stock will be below 235 at expiration, which is what you want. 3 out of 4 scenarios.
Let's go.
Kevin's example here.
Let's get up to the orb.
Stock goes lower, stock stays where it is, or even goes higher, and you're wrong. But as long as it remains below 236 to the upside, that's a profitable type of position. Now, I looked at something a little bit different that takes advantage of
We're heading to the orb.
Dispersion between the different option series on my example trade, and mine's bullish. And I looked at a call diagonal.
Well, every time you think it's going to hit a resistance, it pulls back
to the November
hard.
21st monthly options that expire in 8 days.
So we still got to break 6775.08.
Strike call, then sold about that 1 standard deviation above the current share price. I sold the 235 strike call in the November 14th weekly options that expire in 1 day. You're going to pay roughly on this $12.50 wide bullish call diagonal. You're going to pay roughly, we've got $7.70 on there. It's trading closer to $7 because the stock has pulled back a little bit, which has pulled back the price of the spread. But if you pay that $7.70 debit or $7.10 debit on it, that's going to be your risk.
Well, I'm going to go get my toilet paper and towels, clean out the back of my car so I can put all that in there.
226 level is going to be profitability on this one. So you do need a move
tonight
on this
or this weekend, I got to go buy
the $12.50 wide
fill
bullish
a
call
shoebox full of Christmas stuff for a needy kid.
And the reason is because those vol levels, right?
Yeah, exactly.
Probably
right.
do it Saturday.
We do a lot of these on this show because it's a way to get about 20 long deltas without being long the underlying. It controls the risk to whatever the debit paid is, but it simulates a covered call strategy without doing the stock, right? With doing a longer term. This is a very short term bullish play. It's collecting theta, it's risk defined to the debit paid, and like I said, you're looking for a move towards that 235 strike, Tom.
Yeah, and we mentioned that vol dispersion, buying about 67% implied volatility, selling about 126% on the call diagonal. But as I mentioned, you need a move in the stock to go higher to get above that break even of about 226 to the upside. You do have that opportunity to roll that short option that expires in just over 24 hours. That'll create credits, increase potential profitability, lower risk also on that, and it would create a long call vertical if you did roll that option on the 235 strike to the next option series on that one. But bullish Diane taking advantage of vol dispersion on this one. Kevin's gives you better probabilities of success, but is a little bit more passively bearish.
Kev, quick follow-up question. Yours is just 1 day, like you all mentioned, is 24 hours. Why such a tight expiration window?
Well, because I'm looking for what was important to Tom's trade is important to this trade, Diane, and that is you're selling that front month expiration with an expected move of about $11.70. It's 126, almost 127 implied volatility. You're just taking advantage of that elevated implied volatility to
Well, I'm going to go do my thing.
Sell extremely
What's a
high.
domer?
You can do that in stocks, options, and in implied volatility, Diane.
Randy, what's domers?
All right, good stuff, guys. Thank you. That's the
D-O-
bull versus bear take on applied materials as we gear up for those earnings which are due
R-M-E-R-S.
after the close today. Coming up, we've got cash tags.
Okay,
The
it's
team
the little
from
window
Lightfolio
things.
will be along with
The
new
dormers is a
sentiment
roof
data on
projected
Meta
from the
platforms. That
building.
stock has really taken a
Roof
step
that is
back
typically
recently. Keep it right here
contains
on
a window.
Schwab Network Fast Market. We'll be back after this break.
I know what a domer is. Got to take pictures of the domers. So I'm going to go do that. I'm going to go get supplies.
Hi, I'm Alex.
I'm Jane. And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Bottis, live from the New
And
York
I'm going
Stock
to get out of
Exchange.
this thing
When
on a
the market
breakout.
moves, where
I don't know if
on
it's got enough
getting the
mustard to do that today, but
and
I think we can
sentiment
get
in real time.
to this area up in
Schwab
here.
Network at schwabnetwork.com.
I might be able to get out a little above even. But I'm really too far out of the money.
Is powered by Ameritrade, giving you even more specialized trade.
If I was smart, I'd go ahead and buy one closer.
Connect with the Schwab Trade Desk.
Make up for this loss here on the bottom.
Tackle your trading questions, no matter how complex.
And I might do that when I'm
Plus,
gone.
get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly. with Schwab.
Whether
So
you're
we'll
an
be back.
experienced investor or just getting started, Charles Schwab
sure I got
offers
my
a
wallet.
webcast that's right for you.
I'll leave this
Are you an
on.
active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by
The
minute.
6800s,
Shows built for action, we break it all down in real
6810s.
speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights.
We're at a resistance right now.
Veteran traders and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, anytime, anywhere, free. schwabnetwork.com.
Welcome back to Fast Market here on Schwab Network. I'm Diane King Hall alongside Tom White in our Chicago studio. Time now for our Cash Tag segment. Taking a look at Meta Platforms, the parent company of Facebook, Instagram, and more. For that, we want to bring in our next guest, and that is Landon Swan, co-founder of Likefolio. Landon, thank you so much for joining us today. I just want to put some pictures up on my wall. Do people even do that anymore with Facebook? I don't know. So I know you've got data looking across the landscape.
How cold is it outside?
Of,
63.
Social media, for instance. So how does Meta and its properties stack up against, say, a TikTok or Pinterest, et cetera?
I don't think I have a chance of mine.
Two different views to look at here. One is, how many people are visiting these properties, just users, end users, which is a really important metric. And then the other is how many people are visiting the ad sites, so they want to go in and place an ad. And so what's interesting when you look at these, you pull one of them up, you pick, I don't care. But if you look at just the overall change in time of visits, this is users, number of people going to these websites. You can see TikTok doing very well on a year-over-year basis.
We're at a resistance.
Pinterest, obviously, plus 14 strong. Instagram is actually pulling the weight when it comes to the Meta properties. Facebook is falling off. As you say, people aren't really posting on their walls much. So down 4%. It's not terrible. It's not falling off a cliff, but it is negative, which obviously you don't want to see it as an investor. But Instagram has been pulling the lion's share of the weight for quite a while. It's been driving all the engagement. In fact, the time spent on video on Instagram is up 30% year over year. Video is the key driver here for most of these properties. But yeah, Meta is more reliant on Instagram, and it's kind of, it's doing okay, but it's not doing great. And I think that's really what happened on that last earnings report, where they went from, 750, now we're down to around 610 or so. So quite a big sell-off. But if you look at how people are, how many people are going to advertise on these sites, it kind of tells a really interesting story. So the other chart where you've got people going to these ad spend sites. So again, Reddit obviously stands out. Now that is it's a part of a function of, last year's denominator. This is a year-over-year chart, so plus 600%. There wasn't as much advertising happening on Reddit, so it's a huge growth driver for them. They're jumping out there. Pinterest almost doubling on a year-over-year basis, but you can see here Facebook overall plus 21%, strong number. More people are going to advertise on their platform than they were in the past. It's a very strong number. In fact, a lot of people are skipping a lot of the aggregators. So if you want to look at Trade Desk, for example, that's why it's struggling more. But if you look at how Meta is doing overall, their revenue was up 26% last quarter. There is a bit of a post-election spend decline going on across the board, but you can look at here, you can see that, yes, Facebook is not doing great, Instagram is doing okay, but people are looking to spend more on their platform. I think what kind of shook investors last quarter was just how much money they're willing to spend or they're going to spend into AI, and they're kind of going all in. So when we look at the data, it's clear that Meta is doing okay, Facebook not so great, Instagram pretty well, but more people are looking to spend. But across all of the competition, I'd say that Pinterest is actually probably the one that's the most sort of undervalued here. They took a big hit on recent earnings of 38 cents that were estimated to be 14 cents, took a big hit on those. They got the lowest PE and some of the strongest ad growth there that you've seen. But overall, I think that Meta's doing okay with this 27 PE ratio. It's fairly valued, especially now that we've sold off from 750 down to 600. But people are definitely going there to advertise more than they were last year. But I think investors are just a little worried about how much money they're going to pour into AI and what kind of return they're going to see on that.
Yeah, Landon, they basically raised the bottom part of their guidance from 68 billion to 70 billion for this fiscal year as far as spending goes. But the stocks pulled back 23%, Landon. I was hoping that we would see one of those charts where your data shows what they stated on their last earnings, that their user growth is improving, their revenue per user is improving, their growth rate for this year, fiscal year, is expected to be above 20% again. And they've got, over 3.5 billion daily active users across their platform. So they have the eyeballs and they're able to monetize these advertising dollars better than their competitors like Pinterest and Reddit and such. So when you guys look at that with your data and where the stock price is now $70 off its 200-day moving average, I mean, does this start piquing your interest like it did in the stock that popped yesterday that we talked about the other day, post earnings? I just think, is there some type of discrepancy that we have to start taking a look at here?
I think so. I think anytime you see a move like this, 750, call it 600, we'll round it. That's a very significant move. So the company was either extremely overvalued or they're starting to struggle, and I can confirm they're not struggling. I mean, if you look at the data, they've got solid numbers on a year-over-year basis. Instagram's up 11% on number of people, number of visits, and we know that the time spent is going up significantly. Again, investors are worried about how much they're spending on AI, but AI has resulted in a plus 5 to 10% time spent across all of their platforms. More time spent, obviously, is more advertising dollars. And speaking of advertising dollars, again, that number was plus 21%. Number of people, number of businesses going to the ad spend site to go spend ad manager site. So everything that we've got says that they're probably undervalued at this point. So yes, I know we don't have the two line charts where we would see a divergence, but you would see a divergence with ad spend up 21% and Instagram up 11%. Even though Facebook's shedding a little bit, it does not account for, it does not match or justify this level of sell-off in the stock. So I think they're undervalued here. And again, look at the PE ratios. It's not ridiculous. 27 is kind of high, but it's not ridiculous. Reddit, on the other hand, at 87, there is a ton of growth priced into that. And you can see on their last earnings report, they crushed estimates and didn't go anywhere because there's just so much growth priced into Reddit. So I think that Meta is very fairly valued here, possibly undervalued, just based on the strength that we see. And if you look again at the growth rates is one thing. Yes, Reddit has plus 600% on the ad site. But if you look at the mind share, which is, look at all of the visits to all of these advertising platforms, put them into sort of a pie chart. Meta is 40% of that pie chart. Google's 45%. Reddit chips in at 5%, right? It's so tiny, it's somewhat irrelevant, whereas Meta is commanding at almost half at 40%. And like you said, almost half of the world's population are daily active users. That's insane. I mean, that's just such a wild stat. So yeah, I think that they're probably a little bit undervalued now at this point, and I feel comfortable going into them.
Okay, I'm glad you mentioned that because Wedbush put out a note today adding Meta to its best ideas list. So it sounds like there is some increase in conviction. One of the things that they talked about is obviously the spending, and they said that they think the risk reward is compelling with limited downside from here after that recent pullback in shares. They've got an overweight rating on this, so obviously they're bullish on this, and they, dismissing the concerns, because one of the reasons that we know it sold off was about CapEx, right? Which it seems like the view by investors is one day they're happy with what Meta's spending, and the next earnings cycle, they're not happy with what Meta is spending. So it sounds like you share a similar conviction. The one thing I do want to go back to in your chart is how Instagram compares to TikTok. Obviously, TikTok is not traded here, but I wonder if there's something to keep in mind. Is that a potentially, maybe not a red flag, but a yellow flag to pay attention to as a risk factor for Meta and its properties?
Absolutely. You don't want to see this as a Meta investor. I mean, they are very, very similar platforms in how they operate. And so for one to be at plus 11, the other to be at plus 33 is definitely concerning. That I think that would probably be, of everything, and a good pickup, by the way, everything would be the biggest yellow flag of all of this. You would like to see those two growing at around the same rate. So now you're asking, as an investor, well, what's so much better about TikTok? Why are they able to get people coming to their platform at an increasing rate more so than Instagram is able to? So yes, I would absolutely agree. Back to the CapEx, though, I will say that, I know that investors are fickle. They're going back and forth. But Zuckerberg has stated, I mean, you're basically front loading. He's basically saying we're going to spend this money eventually to get in place, to get our company in line with the day that super intelligent AI is here. Why not do it now so that we're ready when it comes? And if we are early, fine, we'll use that for something else. And like I said, they've already increased the length of time that people are staying on these platforms by 5 to 10% because of AI. So even if they're early and it's a bit of a, air quotes, waste of money now, they would have spent it later, and they can put it to use now. So as a tech entrepreneur, I can tell you that AI is only helping development, only helping things, so you might as well do it now. So I'm on board with spending a ton of money now if I'm a Meta investor. Let's get the best technology we can, and then when the AI gets super intelligent in the future, we're ready to go. We can take full advantage of it. So I'm on board with his strategy, and again, at these levels, I like it. But yes, great point. TikTok beating out Instagram is a little bit of a concern.
So that begs the question, is this the real Landon Swan or the digital version? I know it's the real one right now. All right, thank you, Landon. We'll leave our conversation there for today. That's Landon Swan, co-founder of Lightfolio, with a look across Meta and the properties it compares with. From the trading perspective, all things Meta, Tom, I know you'll have a final thought. Let's bring Kevin back in here for that. Let's hear your final thought before we get into that example trade.
Yeah, a little bit of fear here, I think, from investors. Probably due to the fact that, remember a couple of years ago, they were spending wildly on the Reality Labs, and that didn't pan out. The Metaverse, they changed their name. I mean, there's a little bit of fear, I think, from investors, but now the valuations, Kevin, on this stock are below Google Alphabet's, and we talked about Google in, throughout 2024 and the early stage parts of 2025, where they were the lowest valued Mag 7 name, and that stock's rebounded to all-time highs based on earnings. Kevin, when you look at this, down 23% from those all-time highs. It's oversold on a technical basis. I mean, we're at levels that we haven't seen since the beginning of May. How do you want to look at this one from an example trade?
Yeah, there's so many things. What a problem of riches that they have to have all these products, Facebook, Instagram, and if you're noticing on your linear television right now, advertising for WhatsApp. And so there's a third product that's out there by them, but severely oversold. I've got the IRS right now at 26.25 on the relative strength indicator. So I looked at something in the more aggressive bullish strategy, and that is going out to the December 5th expiration. So 3 weeks out, buying the 610 call. So basically the at the money call, and then looking at the expected move out to November 21st, which is $27. So I lined up the strike, the 610, 635 call diagonal. That was pricing out about 16.25. It's about 15.5 now. So it's a little lower since we put this in. and the stock has drifted below 610. But this is a stock that is extremely oversold in the RSI, and if some of these fears start to dissipate, this does not. Remember, it was trading 750 when their earnings were coming out. I remember we were looking at the 700 put calendar at the earnings event. So now it's trading about just below $610. This is something in the bullish camp, about 27.5 deltas, Tom.
Far below the 50 and 200-day moving averages. So you mentioned the technicals on an RSI. Oversold, anything below the 30 level on an RSI is considered oversold, but we all know that it can stay oversold for maybe longer than you think. But let's take a look at Kevin's example trade here. December 5th, weekly options, 22 days to expiration, buying the basically at the money, the 610 strike call, selling in the near term November 21st monthly options that expire in 8 days, selling the 635 strike call. So a bullish $25 wide call diagonal. You're paying roughly 16.25 debt is what we got on here. As Kevin mentioned, it's come in nearly 75 cents. So it'd probably get it for a little cheaper, about $15.50. But that's going to be your risk on this trade, the debit you pay. So if you pay $16, it's going to be $1,600 in risk on that. That can expand though. You can see here from the risk profile, the apex of profitability at or near that 635 strike, but because you're paying a lot less than the width of this $25 wide bullish call diagonal, anything above maybe the 615 level is going to be profitability on this one. And then you'll have that opportunity as we get closer to expiration over the next 8 days to roll or adjust that short strike. If the market's open, that creates credits, that increases potential profitability on this one, reduces risk every time you collect credits on it. But you definitely need to move to the upside of at least maybe $8 to $10 to get above that break even. Kevin, when you're looking at this one, real quick here, you got some assignment risk on that short option, but this is more aggressive due to the fact that it's technically oversold and it's pulled back so significantly, right?
Yeah, exactly right. Looking at all their products, looking how they compete, looking at a sell-off. Remember, it sold off after earnings, but it had sold off. The high of the stock is $796. So it is significantly off its recent highs. And now, Tom, their 200-day moving average is $677. So it's significantly below even the 200-day moving average, Tom. So yeah, severely oversold. We'll see how that plays out over time.
Yep, and there you go, Diane, kind of lines up with Folio's expectation here also on this example trade on the bullish call diagonal.
All right, absolutely. Coming up, we've got the breakdown. Thanks, guys. We're going to be taking a look at Nike after we got a little love from the analyst community. We'll be right back after this break.
Stay connected to the markets with Schwab Network. Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Fast Market here on Schwab Network. I'm Diane King Hall, live on the floor of the big board. Before we get to the breakdown, let me give you a check on where the markets stand as we get closer to the bottom of the hour. When I look at the heat map, there's still a lot of red. The S&P 500 down by 1.25%. The Dow lower by just shy of 1%. NASDAQ 100 off by a little more than 1.75%. Russell 2000 down almost 2%, so we're seeing some losses accelerating throughout the hour. Shares of Nike on the move today following an upgrade over at Wells Fargo. The analyst lifted the athleisure maker to an overweight rating, raising its price target to 75 from 60. The firm sees, quote, material green shoots in Nike and believes headwinds are set to dissipate. Keep in mind, shares of Nike are down almost 15% year over year. Time now for the breakdown. For that, let's welcome in George Silla, senior markets correspondent, to take a look at Nike. So I wouldn't say shares are sprinting yet, but they're certainly in their walking shoes so far. What's your take on this, George?
Yeah, you're right, Dan. I mean, if you look at the last earnings report back in September, the company actually posted some really good EPS numbers. They were still down 30% compared to the same quarter last year, but nonetheless, sales were actually positive, and estimates prior to the release of earnings in sales were expected to be down. So there was some bright spots in the report. The stock did pick up some traction after the report, but it's been drifting to the downside, as you mentioned, sort of drifting or walking versus sprinting back to the upside. But nonetheless, I mean, this is an interesting story for Nike because, you know, you have to kind of zoom out and look at the larger context of the company's stock. I mean, 171, roughly speaking, dollars back in 2021 has been really a disappointing name in the last few years. And Wells Fargo analyst really points this out. They talk about how, you know, looking at the estimate revisions, they've been down for the last 3 years. So that's really reflective how the price action is essentially looking at estimates which have been down. Sales, in fact, if you look at them last year, around $46.5 billion. Now, again, the last 4 quarters compared to 2024 for the full year, down about 9%. But I also noticed that total net income for the trailing 4 quarters, around $2.8 billion, down about $3 billion from around $5.7 billion in 2024. So we're talking about numbers in sales compared to 2024 down 9%, earnings down about 45%. But nonetheless, so is the price. It's been down. I think the analyst here is making a pretty interesting call because they actually see at the very least the next 2 to 3 quarters, they say 6 to 9 months to reflect this, improving estimates. And in fact, if you look at the consensus for Nike for the full fiscal year this year, around $1.65. They're also estimated to have around $2.50 next year, which is actually about 5 times last quarter's clip in terms of EPS, where the company denoted around 49 cents when they beat the estimates, which were expected to only be about 30 cents.
Thank you, George. That is George Silla, senior market correspondent with the breakdown on Nike. All right, we've got to get Tom and Kevin back in here for the example trade approach to this one. So, Tom, you've got the example trade for Nike. It's getting a little love today, but I don't know if it's out the woods. We'll see. What's your take and your example trade approach?
Yeah, it's getting a little bit of love this week. Stock's up over 7.5%, and maybe this is probably on the back of, well, the fact that it's been underperforming. It's still down 13% so far this year, but this has been in a downtrend for the last couple of years. I believe the stock was above 123 bucks just 2 years ago. And that's probably due to the fact that on holdings, their earnings were pretty good. So they're starting to see consumer demand. You know, they're a competitor in this space, but the bar has been low. And on holdings going into their earnings, now you've got Nike. Expectations are really low on this company. L.A. Hill, this new CEO, trying to turn it around. He's recently made some commentary that, hey, their old school brands are going to start to reaccelerate as far as growth. So maybe some bottoming out here. So I looked at a strategy, based on this Wells Fargo upgrade to 75 bucks. But I kind of want to avoid earnings. Earnings are on the 18th of December. So The option series that I picked was December 12th weekly options. So that expires prior to the earnings. So maybe you can take advantage of any potential run up in the stock pre-earnings and then avoiding the earnings event. You've got 29 days to expiration. You're gonna buy the in-the-money 64 strike call, and then against that, to offset some of the risks and costs on this, sell the 70 strike call. So a bullish $6 wide call vertical to the upside. You're gonna pay roughly we got 220 debit on here. I think it's trading closer to 240 now, so you might have to pay a little bit more. But the debit you pay is going to be your risk on this trade. So if you pay $220 per spread, that can expand to $6 in width if it goes above 70 over the next basically 3.5, 4 weeks here. Kevin, I looked at the anticipated move that the option market's pricing in going into this option series, and it's just over $5, and that sets up with this kind of vertical spread.
Yeah, the most important thing you did here was you need a move, so you gave yourself time. You gave yourself 29 days till expiration. So this is one that whatever debit you pay, is it 240, is it 220, wherever it is in the middle there, that's the risk on this trade. You do, just like a normal vertical spread, short, the risk goes to the one side. This one, you need a move for this to be profitable, so it's a little less probability, but if you're right, you get paid exponentially, guys.
Yeah, and if you take a look at the break even on this one, if you pay 220, it's going to be 66.20 to the upside. On a percentage basis, that's not a big move. And I think one of the keys with buying directional verticals like this is the fact that you have that flexibility as far as getting out of the trade or closing it ahead of expiration. You've got duration in this position, but you don't need it. Say you get that move above 68, up to above 70 prior to expiration, Diane, you can close this early if the market's open, if it starts to expand in price also. But you definitely need a slight move to the upside to get above that break even on this directionally bullish call vertical as an example in Nike.
So you need a move, but it doesn't have to be a major move on this one, Tom, right?
Yeah, that's exactly right.
All right, that's going to do it for us today on Fast Market. Good stuff, guys. I'm Diane King Hall alongside Tom White and Kevin Haynes. Download the Schwab Network app. It is in the App Store, and tune in 24/7 on SchwabNetwork.com. Stick around. You've got Next Gen Investing with Jenny Horn and Alex Coffey up next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com. personalities at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey. And as we do check out on markets, Alex, we've seen some pressure that has really loomed throughout today's session, but not necessarily exclusive to just the four major averages. We're, of course, naturally seeing about a 2% correction in the Russell, and the NASDAQ is down now about 1.9%, and lower substantially in our bellwether being NVIDIA. We're down about 4% and some change in NVIDIA shares, as well as weakness in AMD, Intel. So there's some reasoning behind the NASDAQ's pretty steep correction today.
Yeah, what do you make of that? I mean, I know we're going to talk about NVIDIA and some of these names, but, it's not like there's, in my mind, earnings came out for NVIDIA, for example. So it's like the stock's just moving around historically on a daily basis. I mean, we talk about this every time, but $8 in NVIDIA is $200 billion roughly in market cap. I mean, that's twice the size of Starbucks. And again, it's just another day for this company. I know it's a bigger day, but it's not that out of the ordinary.
Yeah, and it would also, now if we're talking 2 significant weeks of correction, we're now, I guess, back to levels we saw at the end of last week, but about 12.5% off of highs. So that, I think, changes things a bit here for a name that has so consistently been so much of what the market really rides on to the upside.
Yeah, we're talking $500 billion plus too.
Right.
It's really, really substantial from a math standpoint. But today's a little bit different because what we've seen the first couple days of this week was, Monday was strong, but Tuesday and Wednesday you saw Mag 7 weakness, but broader strength, and it kind of fought to a draw in the overall market, up 5 or so points. What you're seeing today is that broad strength has started to fade, and you only got about 40% of the market that's higher in the session. The equal weight S&P is lower by about 0.5%, but Magnificent 7's down by almost or over 2.5%. Semiconductor index, the SOX, is down about 3%. So you kind of have what was working no longer working, but that Magnificent 7 is still a drag.
It is, and there's not really even a clear catalyst why, and I think that a huge component of this market today, which is not really being reflected at all, but is the government shutdown ending after the longest government shutdown in history, 43 days. So hopefully we get a continual resolution. We don't have to see this revisited come January, which is where that, of course, deadline really still stands. But until then, we have a lot more catalysts to get through. We have NVIDIA earnings actually next week. And I'm not saying that that's going to be like a huge driver for the overall market, but I almost feel like these days when things are quiet, Alex, we've gotten away from like the just natural bullish nature of things, and things have just sort of churned to the downside, and we have no major news to get through, which I know is not so much the case today.
So let's build on that then. If we put kind of our market psychologist hat on and we try to think about this behaviorally, do you think there was a subset of the market, particularly maybe short-term traders, who just assumed that, hey, this government shutdown news is going to be a positive for them, even though it wasn't really a negative, the market didn't really go down during the shutdown, but that these headlines were going to drive excitement? They kind of did on Monday. And then when that didn't really hold, it didn't really happen, now everyone's bailing?
I guess so. So, I mean, it seems like that's the case. But to kick things off on our show, of course, we'll go through some of these big movers as we've sort of started discussing today. We'll also dive into Cisco, which was at one point today pacing actually for its best day in almost 25 years. We've given back a bit of that strength, but still, all things considered, a pretty nice day for Cisco. We'll also discuss the latest from Dollar Tree with a double downgrade today, and some commentary that's really interesting surrounding, of course, where we can see these discount retailers really fall in the next several months, as well as the critical holiday season. And we'll close things out with Ondas, which is seeing a really nice move today. Really interesting company that we'll discuss later on with George Tillis, but one that has been really interesting in terms of the drone business, and seeing a pretty nice report to match the price today. So wide variety of coverage to kick things off, but we will start off things with our biggest laggard of the group. That is Walt Disney, which is down 8% here, Alex.
Yeah, what'd you make of this? Depending on what you look at, there were parts of this that were seen, I think, as okay. Revenue missed, but they did a little bit better on EPS. Streaming got a little bit of a bump. Not enough, I think, to excite investors clearly. But what did you make of it? What was the big red line here on this report?
Well, okay, I will answer what probably the street is reading as the red line, and what I am reading as the red line. The red line is that YouTube TV still does not have a contract with Disney. This is so frustrating.
It's like a game of chicken, right?
It is.
Except one side doesn't really care.
I kind of we've always said the NFL is a very powerful customer to have, and so I kind of thought that Monday Night Football would be back by at least this week, but now as it continues into next week, I'm furious at this. Okay, but that's my take.
But I think that's proving, at least on the Alphabet side of things, they did issue the $20 credit, although you got to go in and do it if you're a subscriber. You have to ask for it essentially, so it's not just automatically given. But I think Alphabet has basically said their heels are dug in. Like they're not going to negotiate under duress like this, and it kind of makes sense. Like, is this even like a material part of? I mean, it is, but not really. I mean, Google Cloud, search, traditional YouTube in terms of digital ads. Like, this is Disney's business.
It is, truly. And so I was even trying, because they're giving you now this like $20 rebate because it's such a huge portion of your YouTube TV, like the basically baseline package that you pay on a monthly basis. I mean, it's well over estimated like 20 to 35%. So we're talking like $20 is not really cut it. This is a big deal.
It does kind of cover the cost it would be just to subscribe to that Disney Plus ESPN bundle temporarily. So I think that's the idea. All that to be said, though, Jenny, like what Alphabet does risk is that if this goes on too long, those who just say, hey, I want to switch around on this, I'll just go to, like, let's say a Hulu Live TV or switch back to my traditional cable, whatever it might be, they're not going to do it temporarily. It's going to be a full-time switch. Now, I think one thing that YouTube TV has going for it, and this is a Disney set, is the UI is really nice. And I think people like YouTube TV, but Disney's playing a dangerous game here, I think.
Dangerous? Yeah, my own, again, personal gripe aside, I do think that this is a major reason why, I mean, you kind of like work with both. Like, it's a major reason I subscribe to YouTube TV. It also was a major reason I would say that ESPN has a critical value in Disney's portfolio. So to get into the earnings, what really, though, is a huge part of some of the pressure we're seeing today, you have revenue contracting 0.5% from last year.
That's not growth that the street wants to see. Also, operating income plunged 35% from a year ago, while both TV advertising and box office sales fell. And I know the box office is oftentimes written off because we're in this new age of streaming, but it's still a substantial, right now, also laggard really and drag on the overall business. So that was a point of concern. Also, we know that they still saw about 3.8 million subscribers added for Disney Plus over the quarter, but that was, right now, slightly, I'd say, a lot ahead of what the street been expecting at 2.2 million. But operating income for their experiences division was actually another bright spot, up 13%. So I think that you have a contraction sales story. You also have operating margins really taking it on the chin. Look no further than, hey, an 8% move to the downside. We've seen a lot worse, frankly, this earnings season.
Yeah, and some of this too, this, let's say, skirmish between the two is happening in the current quarter. We got last quarter, so we have an idea from some of the things that they said, but we're going to really find out who won this sort of argument if they did get a lot of people to subscribe and join. Really next quarter. So interesting story, one that we'll certainly come back to. A stock that got some needed good news today was Nike. And it's been able to hold on to its gains. So I talked about only about 42% of the market being higher. Nike is still one of those names. And you look at it today, Jenny, it's largely on the heels of this Wells Fargo upgrade.
It is, and so we're starting off with our darlings of the Dow, I guess, as Nike is up about 2.5%. I guess Walt Disney would not be our darling today, but nonetheless, Wells Fargo upgrading shares to overweight from equal weight with a price target of 75 up from 60. The firm did say that visibility into now Nike's sales and margins is finally improving, and the company has been registering negative estimate revision cycles for 3 years, but in their opinion, this will reverse over the next 6 to 9 months. And they see now material green shoots in Nike's innovation and believe that headwinds to the business are set to dissipate. Also adding, to get even more bullish here, that Nike has the potential to exit fiscal 2026, growing revenue at 3 to 4% with gross margins expanding by roughly 200 bips. So Nike, having a pretty decent day today. I know that they haven't exactly been one that is hugely on our radar, especially when you talked about on yesterday, for example, having one of its best days in over 2 years. But Nike is slowly but surely trying to at least eat away at some of the losses on the year. We're still down about 12% now through, of course, today in 2025.
Maybe it should be on our radar more, because I keep coming back to that conversation. I want to say it was someone from the conference board. They had their kind of Gen Z and younger demographic, favorite brands survey, and Nike was still the top of the list. So all this chatter around On and Hoka, Nike's still the king when it comes to, brand popularity.
It is, and frankly, I always say to Nike's credit, it's still larger than pretty much every athleisure. It's like Dick's Sporting Goods, Lululemon, Deckers, and it's bigger than still all of them combined. As far as its market cap, or at least also I would say just brand significance. It's still the king. It's just losing a bit maybe of that dominance that we once.
Well, I think that's an important thing too, which is one, they have more of international global supply chain, so they've probably been a little bit more impacted by some of that uncertainty there, clearly. But beyond that too, if you're kind of the king, that's who everyone's chasing. That's who everyone's stealing any market share gains they get from you. And it's, it's not even if an On or a Hoka innovate, they make a cool shoe, it doesn't really expand the target market for shoes. That's everyone.
That is true, and that is a very good point. Also, right now, especially a back to school holiday season, I do feel it's just critical for a retailer like Nike, but I guess a lot of these other retailers. So now shifting gears to, of course, the NVIDIA check-in. We do this pretty much on a daily basis. We're now down about 4.2% here. In real time, we're down about 35% on the year and about 12.5% off of highs. So several pieces of news today, as we did see. First of all, this game continues to actually generate price hikes. It's rare to see an analyst taking on a negative stance right now overall at NVIDIA. We are seeing its price target raised to $265 a share from around $250 with an outperform rating, that being Oppenheimer's. That was one catalyst. Also, though, it wasn't all positive, as we had seen some Wall Street Journal reports earlier today that America's chip restrictions are now causing shortages of some of these advanced semiconductors in China. These shortages, though, are extreme enough that China has begun to intervene on the output of these various semiconductor manufacturing international are distributed, which is according to the journal. So Chinese authorities have been working to give priority to naturally like their companies over names like NVIDIA, like Huawei, but that wasn't perhaps one negative catalyst to consider today when you consider, like Microchip, Micron, NVIDIA, Intel, AMD, Texas Instruments, all lower on the session.
Yeah, maybe. I look and I don't see a lot. Like, I guess I look at this and say, hey, I also saw a story about XAI raising like $15 billion. You know, I think that we're starting to see what happens when crowded trades start to get a little wobbly. And that's not to say that this is going to be some giant unraveling that we saw like in August of last year during the tariff tantrum. But this is a pretty significant repricing now, and you can't really ignore this. Like, this is a significant amount. If you're overweight NVIDIA, your portfolio has materially changed in value. And if you're, a fund manager, you may have clients calling and asking now, hey, what are we doing? Are we protected from this? How are we exposed? Are we buying here? And that discussion becomes difficult when a stock's down 4%, in my mind, and I think it's a stretch to say that any of the headlines today are the catalyst.
Yeah, I mean, they are all sort of to be like nothing catalysts. Like we also got a report from, I believe, the DigiTimes that said NVIDIA is adjusting its AI server origin design to now exert this tighter control. I mean, like that's not moving things 4%, but it is, a considerable. If you care about NVIDIA on a fundamental basis, yes, there are always pieces of news. Just how much does it actually matter to price right now? I think is sort of what you're saying.
I guess what I would say is someone who has been let's say a Michael Burry, someone who's skeptical about the valuations. Nothing that's happened in the last week other than price change would change that thesis. On the other side, someone like Dan Ives, who is extremely bullish and believes that we're early in this build-out, nothing has changed in NVIDIA in that grand scheme in the last few days. So I look at it as like, what has changed is the price movement, and it started going down. And I know it's an elementary assessment, but when portfolios aren't just going up all the time, you start asking different questions.
I would say, though, that something that has changed is like a lack of a development as far as the geopolitical front. So, to me, a lack of news there is a piece of news for NVIDIA because shareholders, if you're awaiting some boom from the China cycle of chips, you think that the export controls will ease with the hopeful easing tensions between the U.S. and China. Then you would say that right now you've been waiting for this catalyst that isn't really seeming to come to fruition.
So that's a fair counterpoint. I'm not really up into my ear's not to the analyst beat, but is that like a Dan Ives thesis?
Well, that's something I do think the ultra bulls are hoping for.
Okay, so that's the hope, but I think of Dan Ives he just thinks that they're just going to continue to pump out chips.
Yeah.
So I guess it helps if you have a demand for it coming out of countries like China with huge populations and the second biggest economy. But I look at it as sometimes the story's easy to fit when stocks are going up or when it's a disappointing earnings announcement and the stock's going down. The tough part is I think we're faced with the reality of, sometimes it's just a trending stock. And when that trend breaks, not to say that it has in NVIDIA, things unravel and you can say the exact same thing that was bullish and you can have that as your explanation. I could type in a headline for the macro market today and it could be market down as government reopens. Well, it would have been market is up on government reopening hopes on Monday.
No, and you make it great. It's the truest thing, especially in earnings season, that you can depict any headline that you really want to based on price performance. So I agree. Just, playing devil's advocate here. And quickly before we go here, as we spent a lot of time on NVIDIA off the top of our show today, but Alibaba, also a winner today, up now about 1.25%. But stock gaining after we did see reports that the company is restructuring its mobile AI app, and the company is overhauling its main mobile AI app to make it more closely than resemble OpenAI's ChatGPT. They planned to update their existing apps on Apple iOS and Alphabet's Android, rebranding them, of course, as Qwen, which is after their flagship AI model. So this is cool. From a personal interest standpoint, I always do these headlines and I'm like, great, anything that rivals ChatGPT is a stellar product, but it's going to be expensive to build into this space, as Alibaba is a bit behind, frankly, in the AI build, but obviously operating in a different nation.
Yeah, I think it's a credit to OpenAI and what they've built that you have others trying to mimic it because it's a model that's resonating with consumers.
No, I could not agree more. And so we will leave it there for the top of our show, all of our broader market discussion. But now coming up next, we will focus on Applied Materials, which has earnings out tomorrow, as well as Lam Research, which is seeing some weakness today, as we're down now about almost 5% in Lam Research shares.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time to dive into the technicals with, of course, our chart master, Rick Ducat, to help us break down Applied Materials into earnings today after the closing bell, not tomorrow, and Lam Research. So, Rick, we'll start off with Applied Materials here, as, of course, it's our pre-earnings mover, and this has been a volatile one. I mean, this is one that, for some reason, garners my attention almost every single day. I think because it has pretty decent volume on any given session, but we're still up about 37% on the year, but pulling back about 3% and some change today.
Yes, this chart is one where we've seen a sharp rally since our last earnings event where we saw a significant decline in one day. We hit that point mid-August or so. From there, we very quickly filled the gap, and now we have progressed to the upside in a rising wedge type pattern for most of the past couple of months or so. However, more recently, we have broken downward below that lower boundary of our wedge type shape there. We are now testing the previous lows that come in at our dark green line near about 223 or so. So if we were to reach that level and continue moving lower, the next set of relative lows comes in near about 216 or so. So that could be a further area to watch. To the upside, the obvious mark is the recent highs, the intraday highs, 242.50. If we were to advance to our next chart, we can see that our moving averages that we follow, our yellow 21-day exponential moving average comes in at about 227.74 or so at this moment. We have slipped below that level, so we are starting to give up our short-term moving average there. Now, that is an important potential sign of trend change here, but as we have earnings coming today, that's another major catalyst regardless, I'm not sure how much I would make of that as we head into this known event risk type of situation here. Regardless, that could be an important area to watch out for, that particular moving average. We can see RSI also trending lower here, another common situation for momentum to trail off heading into earnings. Finally, if we were to look at our next chart, we can see that our volume profile based on the year of data shows that there are nodes kind of between those two areas that I mentioned earlier, between about 216 and 223. There's a bit of volume there, and things really start to drop off below that point. To the upside, though, things start to thin out once we start getting too far above 232, 233, around that level. So those would be the volume concentration areas to watch out for. Notice as well that our +1 standard deviation channel lines up quite closely with our lows that we're on the lookout for. That comes in right around 223, 224. Once again, Jay.
Okay, yeah, and so this will be an interesting one because we've seen some pretty significant moves in like dips and, hey, areas of opportunity nonetheless, but definitely some volatility throughout the last year. So appreciate it, Rick. And now as we do think through trading this name for example purposes, Alex, and say, in the case of AMAT, we wanted to see some furtheration of this trend, some continuation of this trend, I should say, really considering the earnings out today after the close.
Yeah, so it's made a big move before the earnings. It's got a lot going on. It's in this sort of AI build out. I extended duration slightly just after the end of the month, November 28th. But to your point, going with the recent trend that's been a little bit more bearish. Neutral to bearish strategy, November 28th expiration, the 230, 235 call vertical, selling that for $1.50 credit. Max gain would be 150. It's a $5 wide spread, and sort of that loose guideline that we've talked about is the 30 cents for every dollar in risk. That would be $1.50 in this case on the $5 wide spread. Max loss would be 350 then, and you can see that break even up at 231.5. So really looking for a little bit of weakness perhaps after the earnings, but more to stay below 230 through the end of the month.
Okay, yeah, and so again, more of a continuation, but also some upside expected to see here on the back of this earnings event. But now to look at Lam Research. Lam Research in a similar role, of course, in the broader semiconductor space, but Lam Research, Rick, a little bit of a different performer as we have seen, now about 112% gain on a year-to-date basis. So, an outsized move that's also been met with some resistance as of late. We've pulled back now about 8% from those recent highs.
Yes, we've just about almost tripled off of those lows too as well. We had previously when we were at our highs of 167.15, but now we've given back a little bit of those gains. We can see that our red line near about 153.70 or so is around where price has tried to find a foothold so far. That's also our previous low. That's also an old high point during the rally that took place in early October there. So this is an important supportive area to hang on to. The old resistance has become new support, as is commonly the case here. That doesn't mean it's going to hold. When I say it's supportive, it just means that's the area to be on the lookout for if price starts to breach it and move lower, because then we could look out for that 147 level, our dark green line. That's about where we hit our high closes during this level. For the most part, we did have one beyond that level, but that would be another noteworthy area to watch out for. Trending downward though off of those highs, our white trend line is in play. When we look at our next chart here, we can see that once again we are quite close to our 21-day EMA. We have fallen below it here. We are also falling below our supportive area. So that was a confluence that stood out here, 154, 155, around that general level for the bulls to hold on to. We can also see that RSI trending lower on the verge of breaking below our 50 midline. A common situation again, but if you were bullish, not exactly what you'd want to see. You'd want to see further strength. You would not want to see it start to cross below that boundary that separates bullish and bearish momentum. Finally, when we look at our final chart here, our volume profile comes back into play once again here. Not too terribly much help in terms of providing us with very large, clear nodes, but the ones that are most pertinent to about where we are now come in around 160 or so and around 143. So those are the heavier trading areas that stick out. We also have seen a bit of a rejection at our +1 standard deviation channel. That comes in right around 158 or so, so another important upside area to be on the lookout for potential resistance if the bulls do want to challenge those old highs near 167.
Yeah, and I mean, this name has been on a pretty nice tear. Again, we'll have to see if we can retest those highs as we pull back. I mean, 8%, but not like we're well far off, as we're much closer to our 52-week highs and lows here. But appreciate it, Rick Ducat, for all that technical help. And now, last but not least, as we do think through trading this name for example purposes, Alex, how do you think about land research?
So if you imagine the exact same trade, but you flip it on its side so that we're neutral to bullish, that's what we looked at here. So it's on the put vertical. However, extending duration quite a bit after the December monthly cycle. These semiconductor manufacturer supplier companies tend to be a little bit less volatile than the NVIDIAs, the AMDs of the world. And so with that, extending duration in order to get a little bit further away and utilize some of those technical levels. December 19th, 145, 140 put vertical, looking for that same $1.50 credit on the $5 wide spread. $150 is the max gain on this trade if it stays above 145 through that expiration. 143.5 would be the break even to the downside, and then of course 350 the max loss. So looking for stability here in LRCX.
Yeah, stability would also be nice, as we've actually only seen this pressure pick up on the session. We're now down about 5.2%. So this is a pretty big day of downside, especially this weakness we're seeing across major tech and specifically in these semiconductor stocks. So we'll leave it there, though, for, of course, our chart master today. Coming up next, we will talk finally a bright spot in this market, that is Cisco. Although I will say also giving back some of its earlier strength, we're still up about 3.8% in reaction to its really strong quarter as well as some strong forward-looking guidance.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at @NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren planning for their college educations. Someday it'll be their turn.
Welcome back to Next Gen Investing. It's now time to talk as we move to the outside today in Cisco, as this has been a surprise winner on the back of its earnings. So joining us now is Marley Caden, of course, host for the Schwab Network, to give us some more insight on what has really led this momentum, because the overall market is tumbling a bit here in real time, Marley, and so we're seeing a bit more weakness trickle into this name. But I mean, hey, a 4% move or 3.9% move to be exact, still a definite winning day for Cisco.
Yeah, it's a really good day. They have given up about 4% of the gains that we saw since they reported, but it was a really strong report. We saw AI networking demand rise for them. They had a top and bottom line beat for their fiscal first quarter. EPS came in at $1. That's up about 10% year over year on revenue of $14.88 billion. That was an 8% increase year over year. It also marks the fourth straight quarter of growth for Cisco, following a stretch of 4 consecutive year over year revenue declines. declines. Now, their biggest unit, its networking business, they saw their sales climb by 15% to $7.7 billion. That also beat estimates. And Cisco's really been trying to tie itself closely to the AI boom. Last month, they announced this new Ethernet switch called Silicon One that powers the company's advanced routers and switches. And they're saying this increased demand from Mag 7A, infrastructure builders, neoclouds, and sovereign clouds have all led them to see incremental AI revenue so far. They also reported that their network product orders grew at a double-digit rate for the 5th consecutive quarter, and their AI infrastructure orders from those hyperscaler customers that I mentioned totaled $1.3 billion, and they're saying, quote, reflecting a significant acceleration in growth. So really strong, important numbers there. Also, another thing you're seeing highlighted is the company saying that they are in the middle of what they call, quote, a major multi-year, multi-billion-dollar campus networking refresh cycle, saying that that's underway, and that's something that a lot of investors were looking to hear more about prior to their earnings, so that's also adding to some of the positivity. I do want to point out a little bit of a yellow or a red flag in the report as well, though. We saw networking growing, performing better than expected, but their other two main segments saw revenue declines, and they also missed expectations. Their security unit fell 2% from the year prior to $1.98 billion, and their collaboration sales slipped about 3% to $1.06 billion, also missed estimates there. Not a significant miss, but still they are slipping. It's just not that all-important networking business, which is their biggest unit. Also, they did raise their guidance for the second quarter as well as the full fiscal year, so I think a lot of that is being met with some positivity today as well.
Marley, as you mentioned, it's not all necessarily sunshines and rainbows. There are some mixed aspects. How did analysts react?
Yeah, we are seeing a pretty favorable reaction. There was some skepticism prior to the report. We saw Citi writing in advance that there was intensifying competitive pressures in switching and routing. They lowered the price target. But that didn't come to fruition. UBS, though, upgraded the stock to buy, increased their price target to $88, saying that they see Cisco facing surging infrastructure demand, and also saw catalyst in that upcoming cycle that I mentioned. And obviously those predictions were all proved right. As far as what we're looking for average price target right now, the average price target on Cisco right now is sitting right about, let's see, $79.58, trading just below that right now at $76.90. The street high is $95, the low is $61. So, but overwhelmed, we're sort of a neutral to buy in this territory. Not a lot of sell ratings right now, only 2 that I can see here from the analysts currently covering stock.
Yeah, and also a good point that this name has some pretty strong conviction here. So I think that it's been, a clear winner at least of the session, and also adding to now, hey, a 30% run up and we've seen in shares this year. Appreciate it, Marley Caden, of course, host for the Schwab Network, for giving us all that insight today on Cisco's really nice move to the upside. And so when you're considering trading this name, obviously we have earnings, of course, behind us. Now, Alex, how do you think through an example trade?
Yeah, oftentimes on this FOMO segment, we look for the follow-on for the example. That's what I did here in this particular trade. Looking to buy a call vertical that expires next week, November 21st expiration. It's the 75.80 call vertical, so 1 strike in the money, 1 strike out. Looking for a 250 debit, risk 250, chance to make 250, equal risk to reward, 77.5, the break even on this one. And at the time, that was basically where this was trading, so pretty close to where the break even was. It is a little bit lower than that now, but still within a stone's throw. Need a little bit of upside for this one to work. If it stays roughly where it is for the end of next week, it's close to break even. Then, of course, if it does retrace some of that, you do have that risk below 75. So bullish strategy here, looking for a pile on in Cisco post earnings.
Yeah, and continuing to actually add some strength in real time. As I was saying, we were pulling back, but as we're seeing some overall just back and forth between the overall markets, still lower obviously, but some of that pressure waning a bit as now we're up at a solid 4.25% here in Cisco. We'll leave it there though for FOMO today. Now coming up next, time to dive into broader retail, and specifically how a lot of these AI agents are now impacting e-commerce ahead of the, of course, very critical holiday shopping season.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please. But there's a... Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please. But there's a... Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Welcome back to Next Gen Investing. It's now time to dive into broader retail as we start things off here with Dollar Tree, a double downgrade now at Goldman Sachs today. So joining us is Dan King Hall, the host of Morning Movers, for some more insight to why. I mean, a double downgrade, not necessarily abnormal, but a pretty stark repricing or re-rating, of course, as we do now see a sell rating from buy, which is, again, as pretty much as stark of a move as you can make from an analyst perspective.
Yeah, indeed. Dollar Tree being dinged by this double downgrade from Goldman Sachs. So they downgraded it all the way down to a sell. They originally had a buy on this one. They cut their price target to 103. That's down from 133. Analysts saying that upside from here gets harder. They are citing some concerns around lower income consumer, the consumer that typically shops at Dollar Tree. Kate McShane saying that, quote, while we think the company still has room for margin improvement over the long term, we think the stock is now pricing in its better fundamentals. So in other words, everything's priced in already from the point of Goldman Sachs. Again, they have the concerns around the lower income consumer, declining consumer perception on price and value. That's one of their points. And then the third point is they just have a preference for other discounters where they see improving value propositions and strong merchandising. They name those as Ollie and 5, meaning 5 below. They did, point out that, Dollar Tree's multi-price initiative where they have some different price points where everything's not just $1. They think that does help same-store sales. They noted some improving store conditions, but it's not enough to remain in the bullish camp, which they were previously on Dollar Tree. So again, shares right now down more than 3% off the back of this. And keep in mind, this one's been a strong performer year-to-date, an outperformer, in fact, when compared to the S&P 500. Jenny and Alex.
Yeah, and I mean, this name down about 3% today. I will say the overall market not exactly helping to, boost things, but, Dollar Tree has frankly continued to rise on a year-to-date basis, but also has seen these moments where it's like we just punish some of these discount retailers. So really great insight. I appreciate all of the help breaking down that story. Dan King Hall, the host of Morning Movers. But now, not to shift too far away from our broader retail discussion, I'd like to welcome in Catherine Black, the food, drug, and mass market retail lead at Kearney. And so thank you so much for joining us, Catherine, first and foremost. But really, I want to get your broader thoughts on what is agentic commerce and how does this really differ fundamentally from, say, traditional online shopping?
Yeah, so agentic commerce is consumers using an AI agent to shop. So think going into ChatGPT or Perplexity, asking it for product suggestions, maybe putting in lots of different criteria, either for health or budget, and getting product suggestions there. Mostly that's what consumers are doing today, but where it's looking to move is they would then continue the transaction, which would ultimately happen at the retailer, but through that agentic platform. And this really is something that we think is going to transform the retail industry.
I was glancing through your report, and Catherine, you talk about this as if it's already here and it's already happening. How close are we to that kind of goal that you're laying out of what it will look like in your mind in whatever its final form is?
Yeah, so I think what's happening today is consumers are researching. 75% of consumers told us that they plan to do some of researching for their holiday shopping on a platform, an agentic platform. So primarily looking for great deals and sales and where they can get the best price on things. So that's really happening today and happening in a pretty big way. What it will eventually move to in terms of transacting on site really kind of depends on when that technology is available. But consumers tell us, 60% say that if that technology is available, I'm likely to use it within 12 months of an introduction. And what we're really saying is that the early adopters break down into two groups, one that are very tech savvy, but also a very price sensitive group. And we think the current economic conditions could really drive adoption, particularly for that segment, which is large. 35% of consumers fall into that bucket, using this technology to help them deal with difficult economic conditions.
Okay, you mentioned, I thought this was a really interesting concept. You mentioned that was the 4 consumer personas. And you just mentioned the tech forwards, as well as the price sensitive, but also then there's the privacy conscious, as well as routine loyal traditionalists, which I think I am definitely part of. But how do those different types of personalities right now shape what you're seeing as far as agentic commerce?
Yeah, I mean, we really are seeing those first two groups heavily engaging. And also that third group, those privacy skeptics, they're starting to play around with it as well. It's not that they're not using these at all for research, but they are concerned. And make no mistake, pretty much every consumer segment has some concerns around privacy, and they do want to retain control over the shopping experience. 90% of consumers told us it's important for me to be able to have control of the shop. I'm not just turning an agent loose on things, but they do want to use all the technology to be a savvier shopper than they were in the past and to get a great deal. And as you say, there is a segment of consumers that we don't really see adopting this technology in any meaningful way. That will pretty much always exist. We see that with e-commerce and other technologies, but it doesn't take a big shift of consumers to start to have a big impact on the way business is done and the P&L impact to retailers.
Well, speaking of how business is done, I think we watched this happen with, products and services like Alphabet's Google, where it became kind of pay for play for your stuff to show up. I think right now the ChatGPTs of the world are seen to have being relatively objective to the extent they can. Is there a risk that these become kind of pay for play too, where you kind of pay for your result to pop up?
Well, I think that a lot of folks are expecting there to be some monetization of these platforms. Some monetization will happen, but I don't know if it'll be a pure pay to play. And the reason is consumers will adopt this technology if they feel like it's recommending the best deal, the best solution for whatever problem they're throwing at it. And I do think consumers need to trust the technology. So an important part of these solutions needs to be that they are a bit agnostic on the brands. They are really putting forward the absolute best solution for the consumer's problem. So in that way, I think it will differ from traditional search. But I also think that these platforms will look for ways to monetize that don't take away from the integrity of that experience for the consumer, but they do allow brands to have access to new insights, to be able to recommend things maybe differently than they have in the past, to introduce newness into that process, to elevate their awareness within the platform, and to learn from the platform. I think those are all opportunities for monetization that aren't necessarily pay to play, but they do generate revenue for the platform.
I mean, absolutely. And I think that even for my own personal use of some of these tools, I mean, it's a wonderful tool that all consumers should be utilizing. But then at the other side of that, is there any degree of risk where, say you were, in a company that was able to control prices for so long? I tend to think of Amazon. Right now, do you run the risk then of the ease of access to see other price points and sort of that comparison, which, I mean, can threaten a business model that has just been so much we're the biggest, so we control most of the prices?
Well, I think the scale players have a big advantage here because they already have invested in large part in pricing. I think the most vulnerable are those that tend to rely on a high-low pricing model because all of our research suggests that the basket size for consumers in an agentic shop will be much smaller. So when that happens, that tears apart the economics of a retailer because they no longer get the halo that comes with a big promotion, so the incremental profit from other products in the basket, and it's more costly for them to fulfill. So the scale players have invested in the fulfillment network to make that as efficient as possible, and they're generally not as reliant on a high-low promotional model to fund their profitability. So for the most part, they're a little bit more insulated. I think players that have a P&L that's structured a little differently, so depending on promotions, doesn't have a robust e-commerce framework, hasn't invested in the fulfillment, they've got a lot more ground to cover to be efficient in this particular environment.
Yeah, and it will be an exciting one to continue to watch unfold and watch transform as we as consumers sort of get that front row seat. But we so appreciate it and really great conversation, especially ahead of this key holiday shopping period. Catherine Black, lead of food, drug, and mass market retail at Kearney. Now coming up next, last but not least, it's time today for Under 30. We are talking about Ondas, which is a technology company that focuses on autonomous drones. So we'll dive more into the phenomenal upside being seen by this stock today, coming up next.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on schwabnetwork.com.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free. Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
I'm Nicole Pedalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time to discuss a name I believe that we're looking at for the first time, that being Ondas, which is ticker symbol ONDS. Fascinating company, operates in drones as well as wireless networking. But joining us now to tell us more about this nice move to the upside today is George Tillis, Senior Markets Correspondent for the network. And so George, I don't know if you've discussed this name before. I'm kind of amazed that at least I don't believe I have yet, but I'm really fascinated with, first of all, this business model, but also, hey, a 16% move to the upside today to also match that enthusiasm.
Yeah, I mean, it's actually looking pretty good considering, it's more of a smaller cap company, around, 1.9, let's call it $2 billion in market capitalization. With this, I think the Russell 2000 is down about 2.5%. So we're actually seeing this divergence in Ondas Holdings versus the market. And, this is an interesting technology in the context of what's going on with things like safety and security, the application now of more drones and artificial intelligence. And so this is a company that supplies the market with AI-powered drones, imaging technologies, counter-surveillance drone technologies, as well as infrastructure security. If you think about all the infrastructure needs that require security. That includes things like oil and gas fields, highway and rail. Border security, that's another big demand for Ondas' technologies, defense and airport security. So this business has been growing. This whole industry space, the drone technology stack, has been growing as well. And if you look at the report for the business, they actually posted some good numbers compared to the estimates. They did post a 3-cent adjusted loss, but they were expected to lose 5 cents, so that was better than what was expected. And compared that to last year, they lost 15 cents, so they're getting closer towards adjusted break even, which is important in the context of the price action. And the sales numbers did best the estimate, which was $7 million. They came in with around $10.1 million. That was significantly higher, considering last year they only generated in sales about $1.5 million for the quarter. The other thing, more importantly, I think, is the guidance. In terms of guidance for this fiscal year, they increased their total sales number to $36 million versus the estimated prior 25. Again, important because if you look at this quarter, $10 million, they're expecting, again, a pretty significant continuation on a cumulative basis sequentially next quarter. And then, of course, in 2026, they revised their guidance as well to $110 million versus $79 million. And keep in mind, last year for the same quarter, they only generated around $1.5 million. And so next year they're expecting essentially $110 million, which is quite significant. And I think that's why the stock is up nicely today, but also still up nicely for the year. And I think the last year to date, or at least the last 52 weeks, stock is up over 700%.
George, real quick, given the defense applications, is this potentially something that a Boeing, a Lockheed would potentially try to acquire maybe down the line? It's still relatively small by market cap.
Yeah, it is. It's a great point to bring up. I can't speculate as to what will happen, but some of the major competitors that Ondas faces includes BAS Systems, which is a European aerospace company, General Dynamics, Northrop Grumman. All of these names are major multinational defense contractors and defense businesses. So Ondas is doing well. This stands as a standalone company. They are integrating their technologies very well, software and hardware. I think their border security business has been growing. But in the defense space, there are some major players you have to consider as competitors. But nonetheless, like I said, you just have to go with information we have, which is right now, based on estimates and revenues, the company's getting closer to break even. That's important, but also the sales numbers are increasing quite meaningfully, and that's why the stock is higher today in the double digits.
Yeah, I mean, a 17% move, and actually we've given back a lot of that strength even seen earlier today, but still, I mean, a definite win for a company that is an up-and-comer and, of course, trying to grow in this very expensive AI world. But so appreciate it, George Tillis, for always bringing all the breakdown for our under 30 names. That also did it for Alex and myself for Next Gen Investing for this Thursday. We have the watch list coming up next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com. I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at SchwabNetwork.com. Good afternoon. Welcome to the Watch List. I'm Nicole Pedalides. It's 2 p.m. Eastern Time. We're coming to you live from the New York Stock Exchange, where a sell-off is underway. We've been breaking down throughout the day. Right now, for example, the Dow Jones Industrial Average down 630 points. We have a big show for you today. We've seen a recent rally in gold, and we're looking at the all-time highs for the precious metal. It's been up, and we're around 3-week highs at this point, and we'll examine the recent trend, also reshoring trend that we've been seeing in the United States, how investors can gain exposure to the domestic reindustrialization effort. We'll also bring in our panel to talk about the Chinese markets following earnings from JD.com and Tencent, taking a look at that. In the meantime, really important to take a look here at the markets. Yesterday, the Dow closed at a record above 48,000. It held that line for a while this morning, but now is back down below 48,000 at 47,623. That's down 631 points, losing 1.3%. The S&P 500 at 6742, down 108 points, down 1.5%. Names like Disney, Nvidia, Caterpillar, Goldman, IBM weighing on the S&P. The Nasdaq down 2%. 24,960, and the Russell down 2.5%. Oil and gold, or mixed gold, right now is down $55. Had been above 4,200, right now at 4,158. And oil is at 58.71 the barrel, and that's just up slightly. The VIX has popped, it's up about 20%. It's above 20 now, and the 10-year bond yield ticked a bit higher at 411. 98,515 is Bitcoin trades, down 3%. Kevin Hanks, host of Fast Market here on Schwab Network, is with me, taking a look at the big picture and specifically some of the details or things driving this market. The end of the shutdown seemed like a nice catalyst, only to see the market turn around here. Some of your thoughts.
Yeah, hi, Nicole. You know, the government shutdown, which reached 43 days, President Trump signed the legislation last night. Now comes the business of actually doing the work to opening all this, and it could get a bit messy. Economic data, airlines and flights, and getting the FAA back and getting air traffic controllers back. There's a lot of restarting of the government that just because day 43 didn't bring another day, it ended there. I think there's still a lot of delays that are going to happen. Remember, the airlines are still talking about 6% delays today. The good news, it looked like a big surge of air traffic controllers came back from their call-ins or their call-outs and staying home. So
Ed Bastian, who was at the New York Stock Exchange yesterday in an interview, said that he expects by the weekend air traffic should be back right ahead of the holiday week. So that's good news. But like I said, Caroline Levitt from the Trump administration said that the October CPI, October jobs data, probably will never get released because there's just no way to accumulate the information. So there's a lot of things about this that are getting better once the government is reopened, but there's still a lot that this market missed, mainly things like pay and air traffic control and economic data reports, Nicole.
Right, and if they do release anything for the October numbers, which originally they said they weren't going to because they didn't have the people to do it, then I thought maybe they might release some incomplete stats, which really is not helpful at all if they do that. What about Cisco? Let's take a look at Cisco because that's hovering around 25-year highs, or it was.
Yeah, Cisco's up about 5% on a down day for the market. Why? You know, the bar was pretty high for their earnings, but they were able to beat it. So non-GAAP EPS, $1 a share, up 10% from last year. Revenue, $14.9 billion, up 8% year over year, beating expectations. Product revenue increased 10%, driven by a 15% growth in networking, AI infrastructure orders. A lot of people say that's what's driven this stock to high levels. $1.3 billion in orders from hyperscale customers, a key growth area. So the stock was up. Networking, strong growth of 15%, fueled by multi-year campus networking refresh cycle. Security revenue declined 2%. Collaboration revenue declined 3%. So all things together, AI driving the beat numbers for Cisco. The stock been able to extend gains from the last few weeks, up about 5%, Nicole.
Yeah, all right, Kevin. It's great to see you. Kevin Hanks at the CBOE. Appreciate it. Let's take a look at the bigger picture. Jake Johnson's with us, Deputy CIO at Advisors Asset Management. Thank you for being with us this morning here. You know, it started off sort of tepid. We were down 0.25%, but now we've really taken a leg down where we're seeing the 10-year bond yield above 4.1. You're seeing the market selling off in a pretty good way. I mean, for example, the S&P's down 1.6%. What's going on here?
Yeah, hi Nicole, thank you very much for the time. I think you're seeing a little bit of weakness in the equity markets, and I think it coincides with a little bit of a soft patch in the macroeconomic environment. I think first and foremost, I think the labor market weakness is real. It's hard to look at the data we do have, whether it's private data, public data. It's hard to look at those trends and conclude we're anywhere near employment. I think it's been pretty weak. Secondly, I think that the government shutdown was really starting to bite on economic activity. You know, it's interesting, if you look at the Atlanta Fed GDP now, it's currently running at a pretty robust rate of 3.9%. However, you've got the administration, specifically Kevin Hassett, the National Economic Council president, warning that the shutdown could cut Q4 GDP in half. Somewhere around 1.5% to 2%. Now, obviously, that's not negative, that's not recessionary, but it's nowhere near what we were expecting, you know, prior to the shutdown. So when you've got a very expensive equity market that's richly valued, priced for perfection, anything short of that, I think, can cause a little bit of volatility. So I think that's what we're seeing here over the last couple of sessions. Now, I do think that there are some silver linings. Now, obviously, the news of the day is we've got some resolution to the shutdown. I think while you're seeing the more expensive segments of the market sell off a little bit, you're seeing other areas begin to pick up the slack. Healthcare's had a couple good sessions. We're just one day removed from some of the big banks and the capital market names that we're trading at record levels. It's hard to think it's really that bad if you've got capital market stocks at record highs. Also, from a technical perspective, while we've seen a little bit of repricing, I think it's really important that support levels have been defended. When you look at the 50-day moving average on the S&P 500, we've visited that, we've reversed off of that, and
what a day, huh?
That last week. When you look at the equally weighted S&P 500, the 100-day moving average has been a key support level through the second half of this year. I think the fact that we're defending those support levels speaks really well to these last 6 weeks of the year, and will be really key to see if we can stay above those levels. Last but not least, I think that it could be a bad news as a good news situation. We do have this soft patch in Q4 economic data. As we move into this December meeting, it's very clearly a live meeting, almost a coin flip at this point. But if the Fed decides they in fact do want to lower interest rates, I think they've got the air cover to do so.
Well, looks like the market's telling them to.
Good earnings, right? We saw earnings. A lot of folks agree that fundamentals were pretty good for the most part, but we are seeing companies now announcing layoffs, sort of one after another a bit. Is the earnings season enough to give you the comfort to continue to invest and expect new highs?
Yeah, I think you're seeing the layoffs, and I think what you're really seeing is an increase in productivity, because not only have earnings been very strong, but margins have been very strong. That's been a key driver to some of the earnings.
You got another snake with a double bottom
over the last 12 months.
God.
So if you step back and you look at 2025, S&P 500 earnings per share growth, it's going to be double digits for the full year. That's much better than what we were anticipating earlier in the year, especially in the spring. And we're seeing similar estimates for 2026. Actually, the 2026 earnings per share estimate for the S&P 500 is 13%, so even better than what we did this year. That's 2 times the long-term average. We look at earnings as the gravitational pull for the equity markets. We think if we can come in anywhere near those levels, we'll be in pretty good shape.
Oh, yeah? PLTR 171. I'm going to go over my watch list. I just got in. I'm going to go grab my water. I mean, if I figured that this would be a great entry right here. Let me see. The 6770s. Probably need another time frame because I don't know if it's okay, we'll start from the top. I'm definitely at a pivot point right here. Feel like I need to shut it down so this thing could work better. I think I will. It'll probably take a half hour for the fucker to boot down. What would I do if I was in stock? Would I sell it? Probably not. But I've been calling out for this correction for quite a while now. And I'm not in anything. Because I've seen this coming. I knew this was coming. I got a real good anchoring when I know things are a little bit overbought. And I call it a 10% correction. 9 to 10%. That's your first stop. And then 20 is your second. From the Dow, from the top. So, let me go into the weekly. I'll let this thing shut down and I'll get back to my other one. So the SPX is still way overbought. I mean, we could get down 700 points to 6,000 if this thing, but right now you're still, this is a weekly time frame, so we're still looking good. I mean, technically, because you're almost at a double week support, 2 week support right here at 6,723, and we got that trend line going up. So I want to take that highest point right there and run it up to the next one and pull it down to right about there. So you're just barely below. Could come down a little bit more. $66.42's area. But actually this is your ideal, the triple top is your ideal support level. This is on the weekly. So somewhere right around in here. Around 6,400. Another 300 points down. That's the SPX. Then you got an inverse head and shoulders straight across. So around 57.65. That would be your low. That's the SPX. IWM. Take it that wick to that wick. So we're getting close to support on IWM, which is right around 233. Or it will come on down if that doesn't hold. 228. What was that one you talked about yesterday? VTS? I bet you it's down today. That's holding support from yesterday. RITM's holding up pretty well. Apple's been on a freak show here lately. So we got support right around there on Apple. Around 268. to the gap. $265 would be perfect. He's still trying to shut down. I didn't see what time it was when I did it. And we got, open. Open's holding up pretty well. Here's at AMC. The gay stock. Disney. Tesla got under 400. So we're at the gap, bottom of the gap on Tesla. These are my charts here, so I'm going to clean it up. You go to chart patterns. Moving averages, being in the now. So we're at the bottom of that gap. 396. I think we hit that right to the penny today. And Meta. Now they're not talking good about Meta at all. Ever since Zuck become a conservative, they don't like him. And we got Pepsi, Open, Apple, Disney, Amazon. Amazon's at support to stay bullish. If not, we got it head and shoulders right here at 235. So it'll come back to that shoulder line if it doesn't hold the top of the head. 236 area. How hard is it? Set an alert. How do you set alert? Yeah. Okay, I got it. I think I got it. So I'd have to put a trend line there. Okay, I got it. Create an anchor indicator. Create an alert. Sensitivity. Breakthrough touch. Note would be head and shoulders. Create the alert. So when it comes down and hits that sensitivity mark, that'll alert me. This is what I like about this right here. That's why when I learned I don't know if it was before I started using this platform, but once I saw this, I said, yeah, I was right. Sometimes they stop before they hit your ideal support level, and they'll reverse up there. So you send a sensitivity alert. This is on TrendSpider. Once it hits that there force, that area right in there, it'll alert you. Well, we're reversing here on NVIDIA. Damn it, come on. Still ain't. Snake, breakout, double back, double bottom, higher low. I'll get my water. I need to go charge my phone because I got to take that guy. That guy is doing the paint job. His car broke down on him. Oh. I'm just a little bit red for today. Looks like we're threatening with support again for a double bottom. Double bottom. The 6770s at $3. I don't know if this is good or not. I'm just doing it. Waiting for the boom. My name is Washboardjim. I lost my virginity when I was 16 years old. And I got a message the other day that Grandma was pregnant. Not mine, someone else's. For I'm a rambling man, yeah. Here we go, baby. For I'm a rambling man. 390. Oh, McDonald's, oh, McDonald, oh, McDonald had a farm. I want you to break out for Bobo. Oh, don't you be alarmed. Poverty's, oh, poverty, oh, poverty. Randy says, damn Jim Howard. I wish I was just like you, because your balls are bigger than mine. That's what Randy said. Snake, breakout, pullback, double bottom, boom. Oh, I forgot to say high or low. Oh, my darling, oh, my darling. We're at 380. Right there. Come on, you bitch. Now, what's going on here? We're at $3.60. I could sell them. Oh, now what am I missing here? The thing's up. And this account. Something ain't making any sense. Are you serious? This thing's going up. Oh, I bet you the timing on these ain't perfect, because this sucks. Oh, I got to do something here. This ain't right. Trend Spider's way behind, man. Now I'm pissed off. I was at 390. I bet you this thing's got a huge delay on it. If that's the case, I can't trade off this at all. That's it. TrendSpider has a big delay on it. Huh. Look at that. What is this? What the hell is going on here? Oh man, this has got a huge delay on it. 369. That's it. I can't trade with TrendSpider. I can only chart. It's got a 3, 6, 9, 15-minute delay. Oh no. Did you see what just happened to me? No shit. I can only laugh it off. Why didn't I ever notice that before, or is it? Oh boy. Unbelievable. I'm gonna call him up. See, man, you got a 15-minute delay on this thing. I haven't paid for it. I don't, you know, maybe I'm a sponsor of TrendSpider, but jeez. This thing's at 67.53. Right there. As it starts to come down on that candle. Well, not much I can do now. Three, 6, 9. That's 15 minutes. Three, 6, 9, 12, 15 minutes. I've seen the price going up to 390 and I'm going, yeah. Now it's at 135. That makes me look like a fool. Lucky for me, I've had 2 wonderful days because I'd be really pissed off right now. Walk away. Chew on a couple of croutons while I wait for this mess. That was a hard one. That's a hard rock. I'll break my teeth with that one. We're at $1 now. We got a triple bottom on SPY. Fed Most Salem says policy closer to neutral than modestly restrictive. limited room to ease without becoming over. Man, they're so full of shit. Banking system's in good shape. So the banks have to fail before they'd want to ease. They're in good shape because damn interest rates are at 19-20%. There's nothing good shape about that at all. If they were in good shape, the interest rates would be under 10. Need a great comeback on my calls. I'm going to use TrendSpider after hours. Croutons, they're almost as good as ice cream. We got 7 minutes to power hour.
It's still got a long way to go. We still need to return to that, having the whole pie growing. And I think all of these price wars and instant commerce and all that competition there is because a lot of these companies still are competing for the same wallets. We don't have new wallets coming into the e-commerce space. We think we could soon again, but we still need for that to happen. And when that happens, it's going to be a very positive story for almost all these names. We saw Tencent, which really, Tencent is really geared toward needs that overall consumer to be doing very well, and they just had positive earnings. So maybe that's a good sign of things to come. But right now, given all of this focus on instant delivery, it's really because they're competing for the same group of wallets.
Yeah, and Olivier, I'll turn it over to you. I mean, obviously the Alibaba investment and AI app, which is now trying to resemble more like ChatGPT, Q1 is what he's talking about and being utilized. That's good news for Alibaba. What about a name like Tencent? Was there something within the earnings there that stood out to you, and which name is your favorite of the four?
Yeah, so I mean, I agree with Henry. Alibaba is just kind of a monster. Let Alibaba cook. They're going in the right direction. They're doing all the right things. But to your point, Tencent is really interesting. It's they just had a 43% surge in international gaming in the last quarter. Their market valuation in the past year has gone up $280 billion. Their AI enhanced or AI enabled advertising targeting saw an increase of 21% last quarter. So they're doing a lot of the right things. And what's interesting about them is, unlike every other tech company of its type, it hasn't invested heavily in AI yet, or at least not in the infrastructure piece. It's working more in integration, which I think is kind of a sly way of getting into the AI business without necessarily moving too fast, without necessarily committing too many resources to it, but essentially integrating AI quickly and intelligently into revenue channels that are already mature, that are already working. So it's an interesting experiment, and it kind of goes against what everybody else is doing in the industry, both in China and the United States. So they're a really interesting company to watch.
Thank you, Olivier Blanchard, and also Henry Green. Thank you for being with us. And folks, the markets have really taken a leg down in the last 15 minutes or so. The Dow Jones Industrial Average now down nearly 800 points, and the S&P 500 is down 1.8%. So keep it here as we go into the closing bell here on Schwab Network. I'm Nicole Petalides.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage means expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com. York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
Good afternoon. It's 3 p.m. on Wall Street, and this is Market on Close. I'm Marley Caden, coming to you live from our Chicago headquarters.
And I'm Sam Byers, coming to you live from the floor of the New York Stock Exchange. Let's take a look at what is coming up on today's show. We'll get live earnings reaction from key chip applied materials after the close. We'll break down those numbers for live reaction as soon as they are released after the bell. We'll be joined by the CEO of Greif, an industrial packaging products company, to discuss its most recent quarter and how important tech is to the business. And in today's overlooked stock, we'll check in on Sealed Air's trend of bubble wrap, a bit of a theme going on here, as it reports say the company is in talks to go private. But for now, Molly, take us through what you're watching today.
Thanks so much, Sam. Cisco shares higher today after reporting a beat on both the top and the bottom line. This marks the fourth straight quarter of growth for the company. Guidance for the next quarter and for the fiscal year also came in above expectations. Disney, one of the worst performers on the S&P 500 today after posting mixed quarterly results. EPS topped estimates, but revenue missed as impressive direct-to-consumer offerings were weighed down by its TV networks. We'll go through that full report shortly. But Nike also having a good day following an upgrade and a 25% price target hike from Wells Fargo. The firm says that Nike's visibility into its sales and margins show the company is finally returning to growth. We'll get to those top stories and more, but first let's take a look at where the markets stand as we near the close today. A lot of red across the board here, down pretty significantly. The S&P down 1.6% right now at 67.
Damn, Dow Jones down 740.
Down more than 2% at 24,970.
It's power hour.
The Dow Jones trading 1.5% lower at 47,515, and the Russell 2000 trading 2.8% lower at 2382. As for the dollar, down about 1/3%, 99.06 right now. Gold trading 1% lower at 41.6930 a troy ounce. Crude oil higher on the day, 0.5% at 58.76 a barrel. And Bitcoin has fallen below that all-important mental number, that round number, 100,000, down more than 3% right now at 98,575. Now, before we get to some of those top stories, I do want to check in with Sam in New York and see what stories caught her eye today on the floor of the NYSE. Sam?
Well, we've got NVIDIA, Laura, and I'm just looking at that now, down over 4% as it stands, as the air continues to come out of big cap tech. So the company getting a pair of price target boosts ahead of earnings on Wednesday. However, that's not helping. Susquehanna upping the price target there to $230 from $210.
230
rating on the shares. The analyst citing the GB 300 ramping up in the second half. They're also encouraged by the visibility on Blackwell and Rubin revenue. Oppenheimer also raising the price target to $265 from $223 and standing by its outperform rating. The firm saying that they see several structural tailwinds driving sustained outside top-line growth in gaming, data centers, AI, and autonomous driving. Now, we, of course, have heard about workarounds used to get NVIDIA chips into China. Now, the Wall Street Journal has come out with a story about how one Chinese company is getting its hands on the chips via Indonesia. Now, China has been trying to reduce its reliance on NVIDIA, and Baidu actually unveiled 2 new AI chips today, but that stock is also coming under heavy selling pressure in the session. E-commerce heavyweight JD.com, however, has actually been lower after earnings. The company did report double-digit revenue growth of 15% above expectations. Profit were lower, but the number was actually better than feared. Now, JD has been investing heavily in the competitive food delivery wars, which has weighed on margins, but it's now signaling it may be able to ease up on spending that much in the future as that strategy has been paying off. So JD has also been benefiting from a government campaign to help people to get them to buy more new home appliances. It, along with its peers like Alibaba, have been offering steep discounts to target more cost-conscious consumers. Those shares are down, as I mentioned. Let's send things back over to Marley with Jenny Horn, who's in Chicago with some of today's top movers.
Thanks so much, Sam. Like you mentioned, here in our Chicago studios with Jenny Horn, co-host of Next Gen Investing, to talk about some of these big moves we're seeing. Let's talk about Cisco, moving to the upside today, up more than 4% following their better than expected earnings.
Yeah, I know we've pulled back, considerably, about 3% from the highs made earlier today, but we still are not sitting at least at all-time highs. We do still remain fairly off those levels, but we're pacing for at least our best day that we've seen in over 2 decades at this point. But again, giving back some of that strength in real time. And really seeing AI networking gear is surging as far as demand is concerned. So better than
back to 75.
Earnings and revenue that did also provide strong guidance for their second quarter. Networking revenue, though, was around $7.8 billion. That beat expectations, and that was actually a standout figure in the quarter. As we know, that networking segment includes the gear that is used in these AI data centers, and it's seeing this growth in enterprise demand for AI infrastructure that continues to really rise. So, we've seen this mentioned by several analysts, but networking hasn't been an AI play in terms of the optics and silicone, as AI orders at these hyperscalers right now has reached, around $1.3 billion. So many say this networking momentum can continue to be a pretty huge secular tailwind for a name like Cisco, which is never really part of the conversation as far as like a major AI player, but I think showing more and more it's becoming like an IBM where it's transforming its business model the way you typically have thought of this name. They're trying to shake off. So was it at several points today the best performing stock in the Dow? I believe it still is, but would be tracking towards its highest close we've seen since March of 2000. So all that to be said, pretty nice reaction to a earnings environment that has been very quick to punish those that have not been able to put up huge growth numbers.
Yeah, and I think this is showing that they're trying to take a meaningful place in this AI conversation, and like you said, not a name that we're generally talking about. Also showing that they're in the middle of this refresh cycle, I think was really helpful for them. But like a nice move to the upside, as you mentioned, they give back
/ES
market.
New lows
Under some major pressure today. Last I looked, shares down about 8% following a mixed quarter.
Yeah, and Disney, I will say that to the 8% move to the downside we're seeing today, there were things still to like. It
down $122 today /ES.
Growth really is where I would tend to look at things. You have basically your top line growing 0.5%. That was disappointing, frankly. Operating margins contracting now 35%. That's also a pretty big problem. So even though we did see that their Disney Plus streaming platform did not really see much weakness, still adding about 3.8 million subscribers in the quarter, which will actually be the final time the company discloses those figures. But that was well beyond, the 2.2 million expected, so that's huge. But operating income for their experiences division, which does include parks, that actually rose 13%. This is a pretty strong result, especially because we've heard from consumer spending that some of these trends of tourism have been slowing. Although that's really one read on it. I think this just actually further narrates the fact that tourism travel still has a pretty nice appetite right now for growth. But they did stand by their previous financial guidance, which forecasts double-digit adjusted earnings per share, and now 2026.
Can I tell you a story, Jenny Horny? Disney is woke. Why can't you people just keep it that way and quit pumping this stock?
Personally, very much mad at this lack of deal, but the rest of their earnings, I think it's just a lack of growth story for Disney.
Yeah, it's very interesting.
Lack of growth, you know why, don't you?
360 earlier today about how what these did show.
Who wants to take their children to a tranny station? Jenny.
Walk us through what's weighing them down today.
So Flutter, okay, which it's to me, just think of this name basically as synonymous with FanDuel, because that is how I tend to know them a bit more commonly speaking wise, but they have made some interesting decision to roll out now a sports prediction market platform, which has not been much of to the state of Nevada's joy, which has accepted the surrender of their now license in the state, saying the company actually intends to engage in unlawful activities related to sports event contracts.
We'll be right back.
Is immaterial for Flutter. We know that right now this has been about a larger state risk. So they said they'll be monitoring other state regulator responses to this development, specifically states which have written letters to licensees against sports contracts, as well as states engaged in this related litigation. So that is a whole nightmare that they have gotten themselves into. But also we've seen, some still overall, I'd say some favorability as far as like the appetite right now for sports betting, and we did see Flutter responding by moving again onto more of this like call sheet type turf, as we're seeing their CEOs believe they're in a great position still to fight off competition in sports betting while being able to expand into the prediction markets. So we do know that we saw a foray into these prediction markets alongside a profit warning. They did enjoy about a 17% increase in their revenues and a 6% rise in adjusted earnings on an EBITDA basis, but they've also seen, again, right now starting in October, that both Flutter and its, of course, main competitor DraftKings saw double-digit share prices falls as prediction markets have continued to challenge some of these traditional sports betting markets. You had to know this was going to be more than a two-horse race. It's pretty much been FanDuel and DraftKings for years and years and years, especially with the unmantling now of like ESPN bets, for example. I did think that you're always going to see competition emerge, but right now some also like legal issues they're facing, which could also be adding to some of the weakness today.
Yeah, certainly that new fan prediction tool that they're putting out with FanDuel flagging some concerns here between state and federal laws. But interesting, when you say like it's not surprising that we're seeing more than a few players in this game. For 2025, it's estimated that $160 billion will be wagered on sports betting. So just a staggering figure in terms of how much people are spending to bet on these sports. But our last one, my daughter's going to be so disappointed. It's her favorite store, Dollar Tree, getting a double downgrade.
Okay, and a pretty substantial downgrade at that. And I will say that unfortunately too much of my maybe money is going into the betting. I need to be shopping more at these discount chains, because not a whole lot of love from the sell side today, as we are seeing Goldman Sachs downgrading the shares by a double downgrade to sell from buy, cut its price target to $103 from $133. And we're seeing, some real weakness around this $100 level from those that are I'm a bit more, I would say, on the pessimistic side, obviously. But trading volume has also surged today. I can't imagine just tied to this note, but right now, stood at just shy of 2 million shares. Daily average is usually around 3 to 6 million, but given the time of year, actually, there's been a heightened interest in volume, which I just thought was interesting. But still, you have a significant downgrade, you have a significant re-rating of shares, and you also right now are highlighting the fact that we're still seeing this deal-seeking environment, which to me then says you're seeing a low-income consumer that's squeezed so much by continual inflation that is still your main target demographic. It's still over 60% of their shoppers. So I do know that they're trying to say they're positioning through these multi-price changes and better stores is going to be perhaps a long-term win. But right now, seeing that pressure with a degree of uncertainty with the lower to mid-income consumer, which is still a huge part of course, the U.S. economy.
Yeah, we continue to have these K-shaped economy conversations about whether we are in one or not, and the data seems to be interesting based on what we're saying about spending. Disney, people expect it to be down. We're seeing more people go to the parks. Spending seems to be resilient. People seem to be buying, but people still want deals. So we shall see, but not a great day for Dollar Tree, trading down about 3%. Thanks to Jenny Horn, co-host of Next Gen Investing, for being with us to break down those top movers today. I do want to check back in with Sam, though, and see what we have coming up in the rest of the show. Sam?
Thanks, Molly. Well, we'll check in with the team from the NASDAQ and discuss trends in the tech sector and the NASDAQ 100 as it is under heavy selling pressure today. Market on Fox will be right back.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring. You can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth.
I don't believe you.
Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks
CMG held up pretty good today.
including growth, value, income.
That's kind of interesting.
Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com. Welcome back to Market on Close. I'm Sam Binas on the
I don't know if we'll have a rebound today or not.
Over in our Chicago headquarters. Let's just get a quick market check-in right now. We've got about 45 minutes to go in the session, and we have seen some heavy selling pressure today.
Yes, we have.
Down now 1.7%. So we've seen some milestones as far as the S&P 500 breaking below 6.8 today. We've also had the Dow Jones coming off the record, excuse me, below 48,000. We've also had Bitcoin actually coming off too, below the 100,000 mark. And if you take a look at the Fed Fund futures as far as what the markets are pricing in with regards to that December rate cut, we've actually fallen below the 50% mark now. So it's not even a coin toss anymore. It is now really up in the air as far as being less than that now. So it's been an interesting day as far as the selling pressure is concerned, particularly when you look at mega cap tech as well. Max 7 being very much under pressure. We've got the Nasdaq down over 2% right now. It's been a big day, or at least a couple of sessions of rotation out of really what has been working for us with some of the tech components into more healthcare. In fact, the healthcare sector at a 52-week high. So some of those biotech companies have been doing quite well today. The Russell 2000 is down 3%. So we are seeing some pronounced selling pressure very much in the small cap trade as well. Here's a look at across the other asset classes and the futures products too. We've got the US dollar been holding pretty steady there at 99. Crude oil is slightly higher, but that has been under pressure off the back of some of the supply glut concerns moving into 2026 off the back of some of the official commentary and also the inventory data we've been getting. So we're at $58 a barrel right now. Bitcoin, as I mentioned, has slipped past down below 100,000 now, so we're at 98K. So keep watching that. So very much risk off as far as the crypto space is concerned. And then we've seen the 10-year yield actually picking up. We're at 4.12 right now. So as I mentioned, a bit of a rotation type of day out of what has been risk on in technology. So now we are coming off. We're at 2.7% lower for that sector. We're also seeing the air coming out of communication services today. Consumer discretionary is getting hit hard as well. Consumer staples, a little bright spot there. This is typically what we do tend to see in a sort of risk-off type of environment. Financials, which had a good day yesterday, still down 1.2%, although there are some names that continue to march higher. But utilities is down 1%, so is real estate. We're seeing energy just on the line to the downside. In fact, this was one of the sectors that was doing quite well, performing to the upside actually for most of the day. So it's just rolled over in the last hour or so. So we are seeing more of the selling pressure, as I said, spreading over to other sectors. Materials also lower, as well as industrials down 1.6%. Let's take a look at mega cap tech, because this is where we've seen some heavy selling pressure as well. Nvidia, names like that, down 4.3%. So we continue to see, as I said, the air coming out of some of these names, some of the AI valuation concerns creeping back. Microsoft down 1.7%. We are seeing Amazon down 2.5%. Alphabet is doing a similar thing as well. Apple is seeing the least declines, you could say, if you want to put it in a positive way, 0.2%.
Yeah, Apple's been performing well.
Most of the Mac 7, the tech names on the back foot today. I'm going to send things back over to Marley for now, though, over in Chicago.
Thanks so much, Sam. Joining us now is Kevin Davitt, the head of index options content over at NASDAQ. Kevin, thank you so much for taking the time to be with us this afternoon. Can we just start with some of your thoughts on this weakness that we're seeing? Sam was just highlighting some of the Mag 7 action and more broadly that we're seeing across sectors, even in the commodity space. What are your thoughts on the sea of red that we have today?
You're right. I think the way Sam highlighted it in terms of some broader rotation, and when we talk about risk off markets, generally what we are focused on is technology, communication services, and consumer discretionary. This past week or so has been interesting from a technical perspective. So last week, I know the
on held up.
The testing of the 50-day moving average in both the NASDAQ 100 and the S&Ps.
Oh.
We are right back within sort of spitting distance of that level on both indices right now. From my perspective, it will be interesting to see if that holds up. That is a technical level that has been supported since the April sell-off. But beyond that, it's been difficult to take too much away from challenging days because there hasn't
That
been
is,
follow-through for many
we're on
months.
that 50-day.
Yeah, we've certainly seen, we've had these challenging days, but then we seem to rebound, and we've been continuing through this rally, tech leading the market higher for most of that, despite this pullback we're seeing recently. But we also haven't seen a lot of PE expansion. So for you, what does that say about the quality of the earnings that we're seeing?
How did that happen?
Well, that has really been kind of the key takeaway from Q3 earnings and sort of from this year writ large. I'm not sure if we have the visual that I shared, but it illustrates it really nicely at the sector level. And technology, broadly speaking, in price return terms, is up about 23% this year. And their earnings per share growth across the sector has been right in line with that, right around 23%. So that translates into essentially no growth from a multiples perspective. Now, there has been a great deal of talk about expensive markets.
He is right. That SPY's right on the 50-day SMA.
A couple of minutes ago. There has been multiple expansion in other areas of the market.
It wasn't even
where earnings growth hasn't been quite as significant.
5 days ago.
And then if you talk about measures like the
last Friday when we had that sell-off, we hit the 63 and bounced up.
Sort of smoothing.
But stayed above the 50 with the head of the with that body.
So I suppose it depends.
And we hit it right here.
How you forecast
so
the coming years and whether this growth is likely to continue.
It's going to be quite interesting what happens tomorrow.
Made is that we'll get
if we stay above that 50
in the middle of next week.
Or we count on it going to the 63 on the SPY.
On the continued growth in this focus.
So we're definitely at a support level.
So Kevin, with all of that said, how should an investor focus on valuation versus fundamentals right now? And what does the lack of PE growth in the tech space contrasted to us seeing some PE expansion in other sectors signal to you?
Because your next dive down, it's quite a bit.
The story and the growth over the past couple of years has been so technology focused. And when we talk about valuations more broadly, really what the market is focused on is technology.
On the SPY.
I don't think there's a whole lot of concern about PE expansion in the
if we don't hold that 63.
Or you mentioned the rotation over the past handful of weeks into healthcare. Those areas of the market, in terms of their weighting within indices,
Jim, that makes
are
sense.
At levels that we haven't seen for 20 years. Now, how end users look to position or their level of concern
Today's not been my day.
Vary significantly, right? And the series of returns. So if you are nearing retirement or something, that's very, very.
So we got these painters painting the building over there. And I went over. They wanted me to go check on the stain job, staining the cedar. And you want to make sure that they didn't paint the copper, which they did not. and the guy, he can't hardly ever speak English. But we can talk. I mean, we can communicate. He wanted me to, he had car problems. His engine got hot. And he's up from Kansas City, Independence, Missouri. And he kind of beat around the bush and asked me if I'd take him to the store so he can get some tape and some paper to tape up the windows so he can stain the what I say, domers. So I took him up to the store and he said, "You're a good man. Can you take me to Wendy's?" I said, "Yeah, I'll take you to Wendy's." And he asked me if I needed anything to eat, and I said I just had 2 sliders and a potato salad and some cottage cheese, so I'm not really hungry. And I brought him back. I told him message me if he needed me again tonight, take him to the hotel, or because I guess the mechanic's working on his car. But you know, I like immigrants. I like foreign people. I've always had an attraction to them. Not an attraction, but I don't know. That's why I go to them foreign countries where I can't. The last one was kind of rough. I couldn't speak to hardly anybody. And when I heard an American speak or English, man, I run right over there and get to talking to them. A lot of people from England and what was that? There's some beautiful chicks from Belize. Not Belize, but yeah, it might have been. I can't remember what's there. I told this one girl, I said, "Man, you're beautiful." She looks at me, she says, "I don't speak English." So I walked by their table, and their guy that was with them looked at me kind of like, "I'm going to kick your ass." Give me a real dirty look, because he seen me up there by the salad bar talking to her. "I know speak English." So that's better. Glad you don't. Because if I was getting ready to ask you next, you'd probably get offended. Got a lot of double bottoms going on. I'd like to see Disney get under $100 and I'd buy it. We were there close today. What's this about Verizon? Verizon cut 15,000 jobs. Disney shares fall after revenue miss. Verizon to cut workforce by 15,000 jobs. Disney warns of potentially long YouTube TV dispute. Shares fall. SPY at the 63 is now 31 minutes to close. Less than 31 minutes. Yep. I can't believe that last trade I got in. I'm sitting there taking it off of TrendSpider and they're 15 minutes behind. And I see it looked good there. I mean, I was watching the candles going up and the stock was going up and I was going, yeah. Then all of a sudden the stock kept going up and my tasty trade was going down, down, down. I'm going, what the heck? This ain't right. It's either having a problem with tasty trade or TrendSpider, and then I realized, oh, shit. The real price is $14 less than what it is right now. What's going? That was I guess I won't be doing that anymore. I'll just have to trade off the platform. No, I'll have to set up Tasty Trade's chart because that kind of screwed me over. And I don't have it quite set up the way I like it. I got EMA on here, the 9. I got the Anchor VWAP. I got the Kettner channels. I could trade the Kettner. I could go back to trading the Kettner channels like I used to. And I got the simple move. Well, this here doesn't. The simple moving average. Oh, I need to change this. How can I change it? There's 200. Is that going to stay like that? So now I got the 200 SMA. I want to make that bigger. Can I make it bigger? Anchored VWAP. Is yellow. Then I got the EMA, the 9 style. Let's see if we got a different blue in here. More of a brighter blue. Solid 2. Save as default. And the 63. And what time is it? So let's see here. It's SPX. So we're at 7242. 7242. Seven 4253, 74260, 73, 75, 10. Yeah, this one's a little bit slower. It's now 238. What the fuck happened here? $9. The 6740s are now at 9. Well, they're flying. We're getting up to the 200. Bingo, baby. We're at the 200 right now. Well, I missed a poll here. Bulls will come back with vengeance. Oh. We hit the 200. So it's a wall. 15 more minutes.
In real time, with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. Schwabnetwork.com.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to Market on Close. I'm Marley Caden. It's time now for overlooked stocks. Shares of Sealed Air are rallying today on the back of a report the company is in talks to go private. Joining us now, George Phillips, the market's correspondent. More about Sealed Air and this potential news of them going private. George, walk us through what we know here, because shares are up more than 16% so far today.
Yeah, it's actually having a really good day for Sealed Air, and I think considering the market conditions, there are some bright spots. This is certainly one of them. But I didn't know this company beforehand, but I'm sure you're familiar, and a lot of people are familiar with their product. Essentially, it's a leading package solution provider. They provide things like food-grade packaging, automatic equipment solutions for food safety and like shelf life for food. But they're probably mostly known for things like bubble wrap, and especially the auto bags, which essentially are those packaging products you see in those Amazon boxes. So it's quite competitive industry space, I suggest, and maybe that's why if you look at Sealed Air, this year at the least, it's positive now after today's movement to the upside. But I did notice that some of the other players in the space, which include Sunoco products, Ranpak, Symbol Pack, as well as Avery Dennison, all these stocks have not performed very well last year and the last 3 years. So I think it's maybe indicative of the competitive landscape that these businesses are facing
indicative.
right now.
Use that word again.
Margin pressures, considering cost of goods sold, have been increasing for materials like timber, which is used for packaging of boxes, and of course all the other commodities associated with that. But today the news was really about the potential now of a takeover, or essentially going private through, of course, a valuation proposal by private equity. If you look at the Jefferies analysts, they essentially have a $40 price target on the stock, but they also state that the valuation of the company could be valued anywhere between $40 and $80 and $48, forgive me, based upon the expectations that if the private equity firm does make the purchase of them, that they're going to look at some benchmark historical valuation multiples. Some of the elements that they talked about, the analyst down at Jefferies is looking at the historical earnings multiple or EBITDA multiples around 9 to 10 times. Right now, it's actually trading at those approximate levels, considering the price action we saw today. But I did notice that this name is also trading at a discount to price to sales, around 1 time sales on a trailing basis versus about 1.5 times on a 5-year average. And the earnings multiple for this name is also trading at a discount of 11 times earnings versus 14. So there's a valuation element here as well, but I think there's also an element of maybe consolidation in the industry, considering the competition is quite rich. And like I said, when I looked across the board to many of their competitors, some of which I mentioned, they have not performed very well, at least in the last year as well as the last 3 years.
Interestingly enough, you're looking at them and knowing they're the makers of products that we use in our everyday lives. You mentioned the creators of bubble wrap, and also these the cryo seal bags, those cryovac shrink bags, and all the Amazon packaging, food packaging. As far as how they're performing, they're up 25% year to date. So I suppose it makes sense why they're the target. But this move to the upside does put them sort of in that range that Jefferies was mentioning as the potential bid. Do you think that this could potentially stick around, or will we see them dip back down as some of this quiets?
Yeah. Okay, so that's a good question. And so one of the things I've noticed in situations like this is, obviously this is still speculation, so you have to consider that. If this does not manifest, there's a possibility we would fill the gap back to yesterday's close. But again, if the valuation is somewhere between $40 and $48, and just based on some of those other metrics like price to sales and price to earnings, the stock could inflate relative to those to come in alignment with those 5-year averages. And I think that's why the analyst has that range, which is still quite large, between 40 and 48. So again, looking at this from a trader standpoint, using today's low as a possibility benchmark where the stock could settle and maybe essentially accrete higher slowly over time to get more in line with some of those higher end price targets between $44 and let's say $48. Again, considering that the stock is still trading at a lower price to sales and price earnings ratio than historical averages. Now, again, you have to consider that those averages in the last year relative to those 5-year numbers might be lower, because I did notice that sales on a trailing basis as well as on a forward basis for Sealed Air are still expected to be down about 1 to 2%. Versus historical average, which are positive 1 to 2%. So again, we're at an inflection point in terms of sales and earnings. I can see why it's trading at a discount to historical averages because of those numbers, but this could also create a situation where the valuation multiples inflate for the entire group. So that's something you have to consider. Again, it's still speculation, but looking at today's low, at the very least, a hold if you're looking at a potential continuation.
George, we appreciate you being with us to talk all things Sealed Air. Right now trading at 42.32, just off of the lows on today's range, 42.15. That's George Tillis. Thanks again. And we're nearing the end of the market session now. That means we'll be bringing Kevin Green in to break down the levels he's watching on the S&P 500. Plus, we've got earnings from Applied Materials due out after the bell. We'll break those down for you live.
Applied Materials, APLD. This one might be.
Real-time access, data-driven analysis.
Is it materials or digital?
Equities to global macro matters. Schwab Network connects the dots. Watch live.
I don't think it's this one.
Subscribe free at schwabnetwork.com.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Nectar Investing, 1 p.m. Eastern.
Only on Schwab Network.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get
Triple
your
bottom on the
watch list
SPY.
at 8 a.m.
We got
Eastern.
4 minutes to
Morning
trade
Movers
it.
Only on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and
Well-
stream live coverage wherever you are.
We're back here at Marco Polo's. I'm Sam Barnes on the floor of the New York Stock Exchange alongside Marley Caden over in our Chicago headquarters. So there's just a few minutes left in today's session. So let's welcome in Kevin Green, Senior Market Correspondent, to help close things out. And we are looking like we're hovering around those lows right now. KG, what are you seeing?
Yeah, I would agree with you. I mean, obviously, this has been a pretty weak day when you're looking at the market as a whole. Only about 24% of the stocks in the S&P 500 in the green, and it has been a little bit more of a risk-off tone, especially when you're looking at the NASDAQ names.
Yep.
Going into the close, we're already kind of in negative gamma territory. Basically, we are seeing some downward pressure in the market. A lot of the options positioning is bearish at this point in time. You are seeing dealers actually selling with the market at this point. But from a technical standpoint, if you're actually looking at this chart, we're basically just filling the gap that we saw pretty much on Monday, going into Monday or pretty much Friday of last week here. So testing a gap is not that bad of a situation here, but you are seeing some material breakdowns in certain sectors, certain portions of the market, especially when you're looking at crypto. If we're kind of looking into the close here, once again, we are kind of continuing to sell off. You're just trying to really hold that 67.40-ish area to the upside here. I'm not sure if we're going to be able to do it. We're 5 points off of it, and we're 4 minutes going into the close here. But overall bearish day. I would call it a gap fill day, at least for now. If you're looking at some of the
Gap fill day.
the Teslas of the world, and filling a gap as well. Pound here looks like it's a little bit under pressure, but if we're going to be along the 50-day moving average, I think, especially for the S&P 500, I think you can kind of treat this as a little bit of a distribution day. Maybe some buyers step in tomorrow.
And KG, looking specifically at the NASDAQ, we are seeing this massive tech pullback today. What were some of the takeaways that you saw from the action specifically on the NASDAQ?
Yeah, so if we're looking at the NASDAQ 100 futures chart, we've been looking at these anchored volume-weighted average prices here, both for the upside and downside. We actually have the upside, or basically from those highs, we have that in purple, and from the lows, we have that in orange. Now we're below that volume-weighted average price, which is in orange, which is actually not a great sign, because if you average up all of those prices, you add up all that volume, the average price is actually higher than where we are at right now, which could actually create additional selling to the market. But we are testing a 50-day moving average, and this is a 3-month daily chart. Every single time that we've hit that 50-day moving average, we actually end up higher the next day. There's only one time where we actually did close lower that following day, and then the next day after that, we then did close actually higher than those previous 2 sessions here. So you also have to treat this as a key area of support that buyers might try to step in. You start to break that 50-day moving average to the downside, close below it, close below this kind of wedge pattern here, this flag pattern. That's when you get a little bit more concerned that the market's going to roll over to the downside. You guys, innocent until proven guilty when you're looking at this technical setup for the NASDAQ.
Oh, really?
Seen healthcare has actually dipped below the line now. It had been holding up throughout the course of the day. In fact, hitting a 52-week high at one stage, that sector. But what are you seeing as far as volatility? I see the VIX has picked up. We're above 20 now.
Yeah, so if you're kind of looking at vol, VIX at 20.6 at this point in time, I'm actually looking to see if we actually close above that 21-ish area here, because we have not had a day, the next day, where we close above 21. The next day we usually actually see volatility crest lower. Outside of what we saw for May, and obviously that tariff tantrum situation that we had, usually once we get to around this 20 level, 21-ish area, volatility actually does come a little bit lower on a closing basis. That's only on an intraday basis. It can't go higher tomorrow, but on a closing basis, it's usually a little bit lower. Once again, that's going to be bullish for this market. So you want to be able to see us actually try to hold up these levels here. Maybe some buyers really do step in, and we break that 50-day moving average. We see vol moving a little bit higher, gets to 24, 25, closes at that level. I would get a little bit more concerned that the selling can accelerate here, especially in the tech space.
Well, Well, I mean, certainly the pattern has been that any sort of dip that we do see, we do see people stepping in and continuing to support the market the next day. So let's see if it is consistent with the trend that we've seen recently. But as far as what we've seen today, it's very much been a pullback across the major indices. We saw the S&P 500 falling past 6.8. We saw the Dow coming off that record, falling through.
Well, today, ooh, look at that. Back to the 200 right at the end of the day. She's 100% right. Today was definitely the pullback day. And I got red today. Definitely not my best day. And when I don't do, I had a lot of things on my plate outside of trading today that I had to take care of. So this morning, one good trade, then 2 bad trades, and then fucked up trade. So it ended up being a red day, not real bad red, but red. And just not my, kind of caught me off guard in a way, but it shouldn't have. The continued selling, it's hard for, I'm not used to that. It's usually a dip and a bounce, pull back, and then it recovers real strongly. So the days like today are far in between, but we are in I would say definitely stocks were a little overbought. I don't know about a bubble, but they've been calling it for a long time. It just finally now starting to perk around the bush. And tomorrow we could have a real extremely open up high and keep going. That's probably what will happen because it's doing it after hours. You got your after hour traders getting on it now. So I'm going to get out of here and relax. Like I said, I wasn't dialed in as good as I could have been today. Setups weren't holding up. And then when the resistance hit, I just didn't get out of the trade. I was up almost on every trade. I just didn't get out of them. That last one that got me when I was looking at TrendSpider and Tastyworks, I was up $90 a contract. And then I just kept watching the chart thinking it was going to go up more, and fuck. We were going up more, and then my ticket over here, my TrendSpider was just knifing, and I'm going, what the heck? This don't make no sense. It looked like it was in harmony there for a second. And then all of a sudden it just kind of went. The stock spiked and my stock dropped, and I'm going, shit, I'm down $1.25 right now. This ain't going to recover. So I said, I screwed myself. I think I just put it in the back burner that TrendSpider had a delay on it because I ain't paying for the. So, well, from now on, I'm just using TrendSpider as a tool to find support and resistance levels, but I ain't going to trade with it. Not at all. I'll just trade with Tastyworks charts. But not no more TrendSpider. I ain't going to sit there and watch TrendSpider chart and trade off of it. That'd be stupid. But that was my fault. Can't blame nobody but myself. So I'm going to get out of here and wait for that guy's message. I got to run him around. His car's broke down, and I ain't driving him back to Kansas City, that's for sure. No. Well, I'll catch y'all later. Again, I'd say I wasn't dialed in too good today. Randy jinxed me. Didn't you, Randy? Oh, Livid Goose says he's a wedgie warrior. Don't tell me you wear thongs. You don't seem like the kind of guy that would wear thongs. Woo! We know something new about Livid Goose. Looks like a country boy on the outside, but down in the inside, he wears thongs. No wonder you have a beautiful wife. Bug's one of my best buddies. I want everybody to know that. He's been with me for a long time. And Magnificent Options Trader, we'll see you later. Jim or JM all around. I keep going to call you Jim. I'll figure out what that JM means one of these days. Today I was not dialed in, so I was kind of glad you didn't follow me too much. The sell-off was brutal. They always say sell-offs, man, that before you know it, we're back at the top again. So, later dates. See you later, Wayne. Sneaky Snake song at the end of the day.
Washboardjim, he got a sneaky snake, goes boom, 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 goes boom, 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 sneaky snake, goes boom, 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 goes boom, 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 sneaky snake.
Catch you later.